account. And you can find me in Twitter, TikTok, Instagram by the name of Milele Organics. Even in Facebook, we are found.
My name is Stella Auka, and our company is called Broad Range Enterprise Limited. We started in 2017, and we have 5 employees for now. Some of them are delivery guys too, and the others are in the office. My ideal customer is a customer who is sensitive about their health, who are health conscious, and they don't want to eat junk. So that is my ideal customer. Another ideal customer of mine is a person who has life issues, sickness like cancer, like diabetes. We take care of those. We address that kind of group, and we are happy that the people are responding well. Nowadays, so many people are coming out of eating junk, they are eating healthy, and that's what I do for now. I bank with Stanbic in the business accounts, and then I have also cooperative bank. But my experience with the Stanbic has been a bit challenging, because when I really wanted them to hold me, they were not able to hold me. When I started to walk and I wanted to get out of my house, I was not able to. Reason being, my financial, statements could not allow me to take a loan. But then I was growing. They were not looking at the growth. They were looking at what I was doing or whatever income was coming in. So after I was not able to get from them, lucky enough I was adopted by KIE. They gave me a loan, which made me to move out of my house and set an office, a proper office, and get employees for that. So I didn't have a good experience when I was starting with the Stanbic. Whereas cooperative, I went there when I was a bit stable. So I've only had soft loans from them. But Stanbic, I was not even able to get a soft loan from them. I didn't get anything, but I still bank with them. First of all, I had a challenge with the government also. I thought that when I have a company registered, I'll just work there, they'll look at my statements and give me money in regard with what I was showing them. But I was not able to get, especially the women fund, because I needed to be in a chama. I was not in a chama because I was an employee, and I was just coming out as an entrepreneur. So I missed out on that. The second thing that I wanted to do was, I wanted to grow, and I wanted someone to hold my hand, which I was not able to get very fast. So I needed to have a security somewhere for them to assess me a loan. If I was just an ordinary person, maybe I couldn't have been able to get that loan. Just a normal woman in the village, because I wouldn't have a security to offer. Maybe it's only my husband who had the logbook or who had the title deed. So out of that, I thought maybe many people can miss out on that, especially the women. Lucky enough, I had a title deed, which I offered as a security for KIE, and they gave me a loan. I thank God for that, and I was able to repay very fast. The secret of paying a loan, you pay it fast, so you pay less. I have a range of products. As you see, my name is Broad Range. So we have a range starting from sesame. We have sesame bars, candies. We use sugar. But there are those who are sick and they don't want to use sugar. We just roast and give them like that. Then we have sesame butter. Not so many people know about this, and it's very nutritious. Then we have fried peanuts. We put fresh ginger, fresh garlic, turmeric, red pepper, gram flour, and then we deep fry. Then this
get going with the program. Once again, we do regret the inconvenience, but please bear with us. 9:30 we shall be starting. In the meantime, if you haven't had any refreshments, please feel free to grab them from outside. Karibuni.
So they made their orders, and from then the company began unofficially. Then later in 2022 we registered the company. Initially we were only doing granola, which is a mixture of oats, like I said, oats, nuts and dried fruits. And then we moved to trail mix, which is a mixture of almost, it's similar to the granola, but it has more nuts. And it's also meant for people who are looking for protein, and granola is meant for people who are looking for fiber. Then we have 3 employees that, though 2 of them come in on a contract basis, and then we have others in Nairobi who work on commission. And the company is a sole proprietorship. And we also do processed dates, and we have a new product which is a granola bar, which it is still a work in progress. As you can see, it's not labeled yet, but we are working on the labeling, we are working on certification and standardization. So that is our latest baby in the company. Currently, our customer base is varied. We have customers in different parts of the country, but we have a bigger customer base in Nairobi. Though we are based in Mombasa, but our biggest customer base is in Nairobi. And some of the milestones we have achieved is being certified by KEBS. We also have been able to list our products in one supermarket, which has a branch here in Mombasa and another one in Nairobi. And also we have, I think 2 weeks ago, we also are able to list in a grocery, butchery sort of setting. So we have 3 places now where we have listed our products. And then when it comes to the banks that we are using, we have several banks, Stanbic, we have Gulf Bank, and we have INM. But the services that I prefer personally, I am an old-fashioned person. So I'm not into mobile banking, but the reason is because a while back, though I was not very keen on mobile banking, but what closed that chapter for me was a while back I almost got scammed, and it was going to happen through my mobile number. And I realized that if I was actually operating the mobile banking, I would easily have been scammed. But then I was not. By the grace of God, I was not scammed. So mobile banking for me is not one thing I'm going into, so I'm more old-fashioned. The biggest challenge that we are facing is the issue of cash flow management, not because of lack of money, but because now we have gotten into the supply, or we are listing into the supermarkets. The payment period is usually takes a while. So as we are waiting for them to pay and we still have to keep on producing, there is a constraint of funds in the middle, but we are looking for ways that we are going to be able to manage that. And then also, one other thing that we can ask the banks or even the Kenya Association, the Kenya Bankers Association, is to support us with markets. Because when we go for markets, we get to market ourselves, we get to meet our clients, they get to taste our products. But if we are paying for the space, and especially for the space, it becomes very, very difficult for us to meet our return on investments. But we are still pushing ourselves, we still push ourselves, we still go out there. But if there is a way the association or even the banks can support with us, it will really help to improve our sales. We are on Instagram, it's at Gongolas_granola, Facebook, Gongolas Granola, and LinkedIn, we are Gongolas Granola. Yes. 0721-388-604. But if you look at this picture right here, our number is right there.
Check 1 2. 1 2 1 2 1 2 3 1 2 3 mic check 1 2 1 2 mic check nimetoa video
proprietor business that was founded through skill and passion in the textile industry. Our major clients that we support
1 2 1 2 mic check 1 2 1 2 3 1 2 1 2 3 1 2 1 2 3 1 2 1 2 1 2 mic check 1 2 1 2 1 2 1 2 1 2 1 2 3 hakuna
KCB Bank. And why KCB Bank? Because of accessibility, reliability, and personal relationship with the clientele. Regarding the payment modules, they are able to craft real-time payment modules for us and for the clients we are meeting in the market. Regarding digital payments, they have done well in providing modules for digital marketing. When it comes to financing, they support by being efficient in giving out the loan. They have supported me in giving me stock loan, and that's why I'm able to produce to my capacity. Biggest challenge in textile industry, rather the gap that we have in textile industry, is about skill. We would request the banks to support us in enhancing skill with the staff that we have, so that we are able to be efficient in our production and to be reliable with our clients based on the demand. And regarding banks with the clientele, I support or I encourage banks to understand the client's module, the outfit of the business that the individual is operating. When they understand the client, then they are able to meet the need of our client. Like for me, KCB have understood my model of working. They understand my market area, my market niche as I supply to the corporate, and as I go to the exhibitions, they're able to craft for me and support me in digital payment modules that support my marketing to my clients. My parting shot, thank you KCB for supporting us. We are who we are because of KCB. Westland Merchandise is along Mtambo Bamburi Road, off Malindi Road. That's where we are, in Bamburi. My phone number is 0724-530-170. We are open from 8 to 6 p.m. in the evening. We supply to the client on calls, and whenever they need us, we reach out to them. Regarding the social media, we are working out to go digital. Thank you.
My name is Joe. I'm the CEO of Bluefields Aquatics. We are based in Kilifi County, and our business is an export business. We export ornamental fish. But currently, we are looking at starting our local business of dealing with aquarium fish locally. What inspired me to start the business was that I was a salesperson for an export business, and I saw that this is a great opportunity that I can venture into and also help build the industry further. So, like I said earlier, our business is an export business, and most of our customers are based in Europe, the US, and parts of Asia. The biggest challenge with this business, any export business, is the issue of quality and the issue of trust, because there are a lot of conmen who you send money to and they don't supply. So most of our customers are facing a challenge of dealing with people who are trustworthy and the issue of quality. And most important thing, especially for us, is to help the companies to import high quality fish. So I think the biggest challenge that the bank can help is because of its network. The bank has access to different people and different companies, different people at different levels of business, and especially for small business owners. I think it will be really, really nice if the bank will go more to help connect different people at different levels in their business. I believe that if the bank can help, especially those people who are coming up, to meet with people who already made it, so that they can learn. Because if you get training from someone who is just a consultant, maybe he has not gone through the challenges that you're going through as a small business owner, that person can't relate, and that the teaching will more be theoretical than practical. So I think the bank, where it can really, really help, it's to connect the small business owner to people who are already at the next level. So that will be more like mentorship, or someone to hold your hand, because these people are going through the same challenges that you're going through. If it's market, if it's managing staff, if it's managing finances, cash flow, and stuff like that. So I think that can really, really help. Yeah. The biggest message to all banks is banks play a very, very important factor in growing the Kenyan economy, because as we already know that unemployment rates are quite high, and the only way we can try and mitigate that, it's through more people getting into business. And the biggest challenge that most people, there are different challenges, but the biggest challenge that we'll find small business owners, it's access to capital. So I'm happy to hear about the new model that you've come up with, and it will really help to have more small business people have access to capital, and of course access to other networks of people who can help them grow their businesses. Yeah, so you can be accessed through either Facebook, Instagram. The social media handles is Bluefields Aquatics Limited. You can reach us there. You can also email us on the numbers which are on the WhatsApp, the same on the website, which is still bluefieldsaquatics.com. name is Joe. I'm the CEO of Bluefields Aquatics. We're based in Kilifi County, and our business is an export business. We export ornamental fish. But currently, we are looking at starting our local business of dealing with aquarium fish locally. What inspired me to start the business was that I was a salesperson for an export business, and I saw that this is a great opportunity that I can venture into and also help build the industry further. So, like I said earlier, our business is an export business, and most of our customers are based in Europe, the US, and parts of Asia. The biggest challenge with this business, any export business, is the issue of quality and the issue of trust, because there are a lot of conmen who you send money to and they don't supply. So most of our customers are facing a challenge of dealing with people who are trustworthy and the issue of quality. And most important thing, especially for us, is to help the companies to import high quality fish. So I think the biggest challenge that the bank can help is because of its network. The bank has access to different people and different companies, different people at different levels of business, and especially for small business owners. I think it will be really, really nice if the bank will go more to help connect different people at different levels in their business. I believe that if the bank can help, especially those people who are coming up, to meet with people who already made it, so that they can learn. Because if you get training from someone who is just a consultant, maybe he has not gone through the challenges that you're going through as a small business owner, that person can't relate, and that the teaching will more be theoretical than practical. So I think the bank, what it can really, really help, is to connect the small business owner to people who are already at the next level. So that will be more like mentorship, or someone to hold your hand, because these people are going through the same challenges that you're going through. If it's market, if it's managing staff, if it's managing finances, cash flow, and stuff like that. So I think that can really, really help. Yeah. The biggest message to all banks is banks play a very, very important factor in growing the Kenyan economy, because as we already know that unemployment rates are quite high, and the only way we can try and mitigate that, it's through more people getting into business. And the biggest challenge that most people, there are different challenges, but the biggest challenge that we find in small business owners, it's access to capital. So I'm happy to hear about the new model that you've come up with, and it will really help to have more small business people have access to capital, and of course access to other networks of people who can help them grow their businesses. Yeah, so you can be accessed through either Facebook, Instagram. The social media handles is Bluefields Aquatics Limited. You can reach us there. You can also email us on the numbers which are on the WhatsApp, the same on the website, which is still bluefieldsaquatics.com.
My name is Amina Nimuleo Gunda. I operate as the General Manager for Raising Sun Bakery, whereby we produce our product by the name Raising Bread. We started the business in 2021, and there are so many things that inspired me into starting a bakery. Having a background in human resources, I thought it would be ideal to broaden my expertise and convert it into business, and that has made me this far. And it was during this time in 2021 when jobs became a bit tricky as COVID came in. So it was that opportunity which actually put me into drive into the market and see where bread would go in. In terms of banking, when I started the business, I didn't have, I would say I didn't have any capital to start with. So I started with the minimal that I had. By that time when I started, I had started banking with APSA, thinking that they will hold my hand into the business which I was starting in terms of progress. However, I found challenges along. Well, in this case, I would say there has to be two ways of weighing options, or whereby the bank has to look at us as SMEs, because business does not flow to perfection all the time. Business comes with challenges, and sometimes challenges might not necessarily mean that I'm doing bad, but sometimes challenges come in because of the external factors as well. Sometimes we get paid on time, and sometimes we get delayed payments. So sometimes those delayed payments create gaps, which again affect our banking systems. Okay, so the challenges we are facing right now is transportation of our product. We feel if we get another support to enable us acquire means to take our product into different counties, we will really appreciate that. To the banks, it is high time they need to have a different view with SMEs. A support, even if it's not 100%, but a backup would help, because any person who has started business has already started from somewhere, and it is that part of support which is needed to make a business person move to the next level. We are reachable on phone. Our mobile number is 0796016633. We are located at Mtopanga in Bamburi, and we operate 24/7.
Mangacha, the founder of Gogola's Healthy Foods, a company that was founded with a passion for creating healthy and encouraging healthy eating lifestyles. We registered the company in 2022, but we started our operations a bit earlier because during COVID, we were looking for something healthy to feed our families. And so we came upon granola, which is a healthy product, a mixture of nuts, oats, and dried fruits, and we started having these as a family. And then some of our friends were, we gave some of our friends as samples to taste, and they liked it, and so they made their orders, and from then the company began unofficially. Then in later in 2022 we registered the company. Initially we were only doing granola, which is a mixture of oats, like I said, oats, nuts, and dried fruits, and then we moved to trail mix, which is a mixture of almost, it's similar to the granola, but it has more nuts, and it's also meant for people who are looking for protein, and granola is meant for people who are looking for fiber. Then we have 3 employees that though 2 of them come in on a contract basis, and then we have others in Nairobi who work on commission, and the company is a sole proprietorship, and we also do processed dates, and we have a new product which is a granola bar, which it is still a work in progress. As you can see, it's not labeled yet, but we are working on the labeling, we are working on certification and standardization, so that is our latest baby in the company. Currently, our customer base is varied. We have customers in different parts of the country, but we have a bigger customer base in Nairobi though we are based in Mombasa, but our biggest customer base is in Nairobi. And some of the milestones we have achieved is being certified by KEBS. We also have been able to list our products in one supermarket, which has a branch here in Mombasa and another one in Nairobi. And also we have, I think 2 weeks ago, we also are able to list in a grocery, butchery sort of setting. So we have 3 places now where we have listed our products. And then when it comes to the banks that we are using, we have several banks, Stanbic, we have Gulf Bank, and we have INM. But the services that I prefer personally, I am an old-fashioned person, so I'm not into mobile banking. But the reason is because a while back, though I was not very keen on mobile banking, but what closed that chapter for me was a while back I almost got scammed, and it was going to happen through my mobile number. And I realized that if I was actually operating the mobile banking, I would easily have been scammed. But then I was not. By the grace of God, I was not scammed. So mobile banking for me is not one thing I'm going into, so I'm more old-fashioned. The biggest challenge that we are facing is the issue of cash flow management, not because of lack of money, but because now we have gotten into the supply, or we are listing into the supermarkets. The payment period is usually takes a while. So as we are waiting for them to pay and we still have to keep on producing, there is a constraint of funds in the middle, but we are looking for ways that we are going to be able to manage that. And then also, one other thing that we can ask the banks or even the Kenya Bankers Association is to support us with markets. Because when we go for markets, we get to market ourselves, we get to meet our clients, they get to taste our products. But if we are paying for the space, and especially for the space, it becomes very, very difficult for us to meet our return on investments. But we are still pushing ourselves, we still push ourselves, we still go out there. But if there is a way the association or even the banks can support with us, it will really help to improve our sales. We are on Instagram it's at gogolas_granola, Facebook Gogolas Granola, and LinkedIn we are Gogolas Granola. Yes. 0721-388-604. But if you look at this picture right here, our number is right there.
My name is Grace Makwata. I'm the founder of Graceland Merchandise. It's located in Mombasa County, in Bamburi specifically. And it is a sole proprietor business that was founded through skill and passion in the textile industry. Our major clients that we support, or the major client that we serve, we do uniforms for companies and hotel industry. And out of COVID, we got an inspiration of working on ready-to-wear items, and that's how Kitenge or Ankara products came in. Graceland Merchandise began in the year 2007, and we began by preparing uniforms for the hotel industry, who was our target market, and the companies. And when COVID came in, innovation was our target, or rather was our platform to rise up. And we are able to prepare our own fabrics. We are able to prepare our own fabrics from fabric to add value addition, that is tie and dye. We do value addition by doing embroidery. This is handmade embroidery. And we also do value addition through sequins. This is the product our latest product that we are able to do by doing value addition through sequence. Graceland Merchandise banks with KCB Bank. And why KCB Bank? Because of accessibility, reliability, and personal relationship with the clientele. Regarding the payment modules, they are able to craft real-time payment modules for us and for the clients we are meeting in the market. Regarding digital payments, they have done well in providing modules for digital marketing. When it comes to financing, they support by being efficient in giving out the loan. They have supported me in giving me stock loan, and that's why I'm able to produce to my capacity. Biggest challenge in textile industry, rather the gap that we have in textile industry, is about skill. We would request the banks to support us in enhancing skill with the staff that we have, so that we are able to be efficient in our production and to be reliable with our clients based on the demand. And regarding banks with the clientele, I support or I encourage banks to understand the client's module, the outfit of the business that the individual is operating. When they understand a client, then they are able to meet the need of our client. Like for me, KCB have understood my model of working. They understand my market area, my market niche as I supply to the corporate, and as I go to the exhibitions, they're able to craft for me and support me in digital payment modules that support my marketing to my clients. My parting shot, thank you KCB for supporting us. We are who we are because of KCB. Graceland Merchandise is along Mtambo Bamburi Road, off Malindi Road. That's where we are, in Bamburi. My phone number is 0724 530 170. We are open from 8 to 6 p.m. in the evening. We supply to the client on calls, and whenever they need us, we reach out to them. Regarding the social media, we are working out to go digital. Thank you.
My name is Joe. I'm the CEO of Bluefields Aquatics. We are based in Kilifi County, and our business is an export business. We export ornamental fish. But currently, we are looking at starting our local business of dealing with aquarium fish locally. What inspired me to start the business was that I was a salesperson for an export business, and I saw that this is a great opportunity that I can venture into and also help build the industry further. So, like I said earlier, our business is an export business, and most of our customers are based in Europe, the US, and parts of Asia. The biggest challenge with this business, any export business, is the issue of quality and the issue of trust, because there are a lot of conmen who you send money to and they don't supply. So most of our customers are facing a challenge of dealing with people who are trustworthy and the issue of quality. And most important thing, especially for us, is to help the companies to import high quality fish. So I think the biggest challenge that the bank can help is because of its network. The bank has access to different people and different companies, different people at different levels of business. And especially for small business owners, I think it will be really, really nice if the bank will go more to help connect different people at different levels in their business. I believe that if the bank can help, especially those people who are coming up, to meet with people who already made it, so that they can learn. Because if you get training from someone who is just a consultant, maybe he has not gone through the challenges that you're going through as a small business owner, that person can't relate, and that the teaching will more be theoretical than practical. So I think the bank, where it can really, really help, it's to connect the small business owner to people who are already at the next level. So that will be will be more like mentorship or someone to hold your hand, because these people are going through the same challenges that you're going through. If it's market, if it's managing staff, if it's managing finances, cash flow, and stuff like that. So I think that can really help. Yeah. The biggest message to all banks is banks play a very important factor in growing the Kenyan economy, because as we already know that unemployment rates are quite high, and the only way we can try and mitigate that, it's through more people getting into business. And the biggest challenge that most people, there are different challenges, but the biggest challenge that we'll find small business owners, it's access to capital. So I'm happy to hear about the new model that you've come up with, and it will really help to have more small business people have access to capital, and of course access to other networks of people who can help them grow their businesses. Yeah, so you can be accessed through either Facebook, Instagram. The social media handles is Bluefields Aquatics Limited. You can reach us there. You can also email us on the numbers which are on the WhatsApp. The same on the website, which is still bluefieldsaquatics.com. My name is Joe. I'm the CEO of Bluefields Aquatics. We are based in Kilifi County, and our business is an export business. We export ornamental fish. But currently, we are looking at starting our local business of dealing with aquarium fish locally. What inspired me to start the business was that I was a salesperson for an export business, and I saw that this is a great opportunity that I can venture into and also help build the industry further. So, like I said earlier, our business is an export business, and most of our customers are based in Europe, the US, and parts of Asia. The biggest challenge with this business, any export business, is the issue of quality and the issue of trust, because there are a lot of conmen who you send money to and they don't supply. So most of our customers are facing a challenge of dealing with people who are trustworthy and the issue of quality. And most important thing, especially for us, is to help the companies to import high quality fish. So I think the biggest challenge that the bank can help is because of its network. The bank has access to different people and different companies, different people at different levels of business. And especially for small business owners, I think it will be really nice if the bank will go more to help connect different people at different levels in their business. I believe that if the bank can help, especially those people who are coming up, to meet with people who already made it, so that they can learn. Because if you get training from someone who is just a consultant, maybe he has not gone through the challenges that you're going through as a small business owner, that person can't relate, and that the teaching will more be theoretical than practical. So I think the bank, where it can really help, it's to connect the small business owner to people who are already at the next level. So that will be more like mentorship or someone to hold your hand, because these people are going through the same challenges that you're going through. If it's market, if it's managing staff, if it's managing finances, cash flow, and stuff like that. So I think that can really help. Yeah. The biggest message to all banks is banks play a very important factor in growing the Kenyan economy, because as we already know that unemployment rates are quite high, and the only way we can try and mitigate that, it's through more people getting into business. And the biggest challenge that most people, there are different challenges, but the biggest challenge that we'll find small business owners, it's access to capital. So I'm happy to hear about the new model that you've come up with, and it will really help to have more small business people have access to capital, and of course access to other networks of people who can help them grow their businesses. Yeah, so you can be accessed through either Facebook, Instagram. The social media handles is Bluefields Aquatics Limited. You can reach us there. You can also email us on the numbers which are on the WhatsApp, the same on the website, which is still bluefieldsaquatics.com.
My name is Susan Muturi. I work at Mercy's Light Family. Mercy's Light Family is a teen pregnancy crisis center in Vipingo, where we rescue girls who have been raped and defiled. And when their cases are ongoing in court, we have them there. It's more of a safe house for them. So the NGO started to look into ways that they can be able to empower the women of the Vipingo community, at the same time empower the girls once they reach 18 years, to help them be independent once they clear out of Mercy's Light. So we started with this project, Milele Organics. Milele Organics does the production of pure virgin coconut oil, and we have another product called Milele Mango Jam. We don't have it right now. And then we have Upendo Fabrics, which the girls make these beautiful products. We make purses, we make bags, we make design clothes. So the girls, once they clear, when they come in, we train them. First of all, we take them through trauma healing, and then we help them with catering, tailoring, and doing different simple projects that they can be able to be dependent when they clear out of Mercy's Light. So one of them is tailoring. Remember, even if we don't have them at the center, they can be employed by EPZs around Vipingo. So apart from tailoring, we also do catering, and we also do pure virgin coconut oil. Right now, we have employed about 7 of them in the projects. We have 3 in Milele Organics, and we have 3 in Upendo Fabrics. We look forward to expand, to make more money, to be able to empower more women from the community, and also to empower the girls. So the biggest challenge that we face is market visibility. We try as much as possible to do marketing via social medias. We also participate in exhibitions, but purchasing coconuts, mature coconuts, is very expensive. Also being able to transport, purchasing everything, paying the workers, water bill, electric bill, it's just it takes a lot of money, and the profit margin then ends up being so small. So that is one of the challenges that we face. And also, as much as you empower the women in the community, you can remove somebody from the village, but you can't remove the village mindset out of them. So that is something we face a lot of times, because I've been working with these women since 2021, and you find out that they can't make the simplest decisions, like knowing where to get coconuts, like knowing what to do. They have to call and ask me, what can I do, what can I do? And I've worked with them for like 4 years. So that's another challenge that we face. Rather than that, we are good. What would I want from the bank? One, I would love them so much to start visiting rescue centers, not only children's home. There are so many rescue centers. Like ours is not a children's home, it's a rescue center. It's a safe haven for teen girls who have been raped and defiled. That's a different criteria. These girls need a lot of encouragement, a lot of trainings, a lot of people knowing that they have people that they can rely on. Remember, something valuable has been taken away from them. So trusting people is not an easy thing for them. So if they can come, train these girls, talk to them, empower them, all those CSR, bring us everything that you can be able to do. At the center, we have a very big budget. So unga is appreciated, oil is appreciated, clothing for the girls and the babies. So there's so much that the banking industry can do actually for the center. Milele Organics and Upendo Fabrics is found in, mostly we do our production in Vipingo, but we have shops that partner with us that put our products in their stores. We have one in Fort Jesus, Curio Shop. We have our products, both Upendo and Milele. We have Jahazi Coffee House in Old Town also. We usually sell our oil and our mango jam. We also have one shop around Mamba Village. Opposite, it's called Inspira. It's opposite a petrol station called Hansen. I don't know if it's Hansen or wherever. It's opposite first floor. And then we also do a lot of exhibitions. So, and my number is 0738-882-313. I have an email address, mileleoil@gmail.com. And you can find me in Twitter, TikTok, Instagram by the name of Milele Organics. Even in Facebook, we are found.
My name is Stella Auka, and our company is called Broad Range Enterprise Limited. We started in 2017, and we have 5 employees for now. Some of them are delivery guys too, and the others are in the office. My ideal customer is a customer who is sensitive about their health, who are health conscious, and they don't want to eat junk. So that is my ideal customer. Another ideal customer of mine is a person who has life issue, sickness like cancer, like diabetes. We take care of those. We address that kind of group, and we are happy that the people are responding well. Nowadays, so many people are coming out of eating junk, they are eating healthy, and that's what I do for now. I bank with Stanbic in the business accounts, and then I have also cooperative bank. But my experience with the Stanbic has been a bit challenging, because when I really wanted them to hold me, they were not able to hold me. When I started to walk and I wanted to get out of my house, I was not able to. Reason being, my financial, statements could not allow me to take a loan. But then I was growing. They were not looking at the growth. They were looking at what I was doing or whatever income was coming in. So after I was not able to get from them, lucky enough I was adopted by KIE. They gave me a loan, which made me to move out of my house and set an office, a proper office, and get employees for that. So I didn't have a good experience when I was starting with the Stanbic. Whereas cooperative, I went there when I was a bit stable. So I've only had soft loans from them. But Stanbic, I was not even able to get a soft loan from them. I didn't get anything, but I still bank with them. First of all, I had a challenge with the government also. I thought that when I have a company registered, I'll just work there, they'll look at my statements and give me money in regard with what I was showing them. But I was not able to get, especially the women fund, because I needed to be in a chama. I was not in a chama because I was an employee and I was just coming out as an entrepreneur. So I missed out on that. The second thing that I wanted to do was, I wanted to grow and I wanted someone to hold my hand, which I was not able to get very fast. So I needed to have a security somewhere for them to assess me alone. If I was just an ordinary person, maybe I couldn't have been able to get that loan. Just a normal woman in the village, because I wouldn't have a security to offer. Maybe it's only my husband who had the logbook or who had the title deed. So out of that, I thought maybe many people can miss out on that, especially the women. Lucky enough, I had a title deed, which I offered as a security for KIE, and they gave me a loan. I thank God for that, and I was able to repay very fast. The secret of paying a loan, you pay it fast, so you pay less. I have a range of products. As you see, my name is Broad Range. So we have a range starting from sesame. We have sesame bars, candies. We use sugar. But there are those who are sick and they don't want to use sugar. We just roast and give them like that. Then we have sesame butter. Not so many people know about this, and it's very nutritious. Then we have fried peanuts. We put fresh ginger, fresh garlic, turmeric, red pepper, gram flour, and then we deep fry. Then this roasted, this is roasted cashew. We roast and we have them in different packaging. The small packaging, the big packaging, the jars. Then out of this also, we have cashew nut butter. We make cashew nut butter out of the cashews. Then we have roasted peanuts, where we roast and also turn it to butter. You can see this is peanut butter. And then we have almonds. This is not grown in Kenya, but people who have cancer and have health issues, ask about it. And therefore I started making, because when you are doing a business, you don't do it for yourself. We do it for others. So when they started asking, I roast, and then I crush and package like that. Media handles are broad range in everything. Facebook, Instagram, you will find us with broad range.
My name is Amina Nimuleo Gunda. I operate as the General Manager for Raising Sun Bakery, whereby we produce our product by the name Raising Bread. We started the business in 2021, and there are so many things that inspired me into starting a bakery. Having a background in human resources, I thought it would be ideal
check, mic check, 1, 2, mic check, 1, 2. Ladies and gentlemen, good morning. If you're still outside, kindly make your way into the hall. Our keynote speaker and his delegation are making their way shortly into the hall and would like to start our program. Once again, we truly regret the inconvenience of having to wait right from the time we had designated to kickstart our program up to now. Nonetheless, we are ready to progress with our conversations for the day. So if you're still outside, kindly take this moment to grab whatever it is that you're getting and coming into the ballroom, because we would like to start our program for the morning. I'm told the governor of the Central Bank of Kenya is here with us and will shortly be making his way to join us. Shall we settle down, ladies and gentlemen? Let's take our seats. If you're still outside, kindly make your way in. We'd like to progress with our program. Once again, a warm and hearty welcome to the 14th Annual Banking Research Conference. This, as always, is convened by the Kenya Bankers Association. And this year, the theme of focus is navigating risks and leveraging opportunities in micro, small, and medium-sized enterprise financing. So those walking in, kindly take your seats. Shortly, our keynote will be making his way in, and we'll be good to start our program. Just to give you some color into what we do anticipate, we shall be starting off with welcoming remarks coming from the Kenya Bankers Association. I've actually had sight of the Chief Executive Officer who's here with us. And thereafter, we shall have our keynote address, after which we shall have a panel discussion, and that will be on MSME policy and monetary dynamics, implications for financing, lender opportunities, and barriers. And that panel constitutes representation from the Equity Bank of Kenya. We have FSD Kenya. We also have the Central Bank of Kenya, where the Jared Osoro, who is a member of the MPC, will be sitting in with us. And finally, we shall have the Kenyan National Federation of Jua Kali Association. So quite a diverse panel there, and that's something we certainly do look forward to. Those still at the door, kindly just make your way in and settle down, and we would like to continue with our program for the morning. Let's take our seats, ladies and gentlemen. Our keynote speaker is here. That's the Governor of the Central Bank of Kenya, Dr. Kamau Thuge. Karibu sana. He's accompanied by the chairperson of the Kenya Bankers Association, that is Mr. Paul Russo, and also we can see the Chief Executive Officer of KBA, Mr. Raymond Molenja. Karibuni sana. Thank you so much for joining us. Let's give them a round of applause as they make their way into the hall. Please, karibuni sana. You may take your seats. Thank you so much for joining us this morning. Governor, we would have you at the center, please. Yes, please. Sorry for that. Ladies and gentlemen, one more time, it's my distinct honor to welcome all of us to the 14th edition of the Annual Banking Conference. Kindly mute the music at the back there, please. Thank you very much for that. Asanteni sana. I do regret the inconvenience of having to keep you this long, but nonetheless, we are good to kickstart our program for the morning. Are we excited to be here? Are we excited to be here? Yes, formally welcoming you to the 14th Annual Banking Research Conference convened by the Kenya Bankers Association. The theme of focus this year is navigating risks and leveraging opportunities in MSME financing. I'd like to once again recognize the presence of the Governor of the Central Bank of Kenya and the leadership from the Apex Bank, Karibuni sana. I can see captains of industry across the floor. I can see academia well represented, the fourth estate as well. Please feel most welcome. Thank you so much for joining us this morning. In the interest of time, I'd like us to rise on our feet and have the first stanza only of the national anthem, and then we shall continue with our program. So let's rise, please. You may be seated. Thank you very much. Friends, it's now my distinct honor to welcome on stage the Chief Executive Officer of the Kenya Bankers Association, Mr. Raymond Molenja, to kick us off. Let's give him a round of applause as he makes his way here.
Good morning. So first is to join Julians in apologizing for keeping you here, and then also apologies to the governor for having kept you all morning. We were supposed to be here at 8:30, and governor, you've been gracious enough to be able to be patient and wait for us to be able to finish the conversation that we are having with the National Treasury, which is a continuation of actually the theme of this conference. So, karibu sana, Daktari Kamau Thuge. The mandate of Dr. Thuge is to ensure that our monetary policy is sound and ensure that we have proper pricing for the country. And then also he has a mandate to ensure that the economy is growing. And again, we need to have hard cash. So Governor, karibu sana to this conference, which is the 14th that we are hosting as KBA. And we are very excited because when we started this journey, it was majorly academic research. But we've come to a point where now this conference we normally hold it to be able to ensure that we find solutions to our present problems. The current challenge is how we finance our small and micro businesses. So just joining Julian's again to be able to acknowledge the governor's presence. In the room also we have our KBA chairman, Paul Russo, the group CEO of KCB. We also have our vice chair of KBA, Betty Korir. We have our governing council member CEOs. We also have partners led by FSD Kenya that we've worked closely together. Our researchers, we don't forget you. We are very grateful for having put in a lot of work throughout the year to be able to make this event be able to be successful and make it a reality. To all our stakeholders, all our colleagues within the banking industry, all bank CEOs for our member institutions, we are honored to have you be able to be part of these conversations, to be able to see how we finance the micro and small businesses. So talking about the theme, we bringing scholars, practitioners, regulators, policymakers to find a solution to this challenge on how we power and be able to provide more credit to our MSMEs. We've just come from an event where the statistics indicate that 90% of businesses in Kenya, 98% are micro and small businesses. Now the challenge is, that's the market we have as Kenya. So if you're a financial institution, that is the market you have, and we need to find solutions as to how we can get loans to these segments to be able to be in business. Otherwise, we get ourselves out of that business segment, and you're only remaining with 2% to be able to serve. So in the 2 days that we'll have these discussions, let's focus to be able to see what can we do. There'll be discussions on credit guarantees. There'll be discussions around how to improve our credit scoring. There'll be discussions even around pricing, and we are at a very good stage where we are transitioning through our pricing on how we price our credit. So we'll want to share ideas as to how we can better be able to structure so that we can be able to serve our market. And then also as KBA, and I know the chairman will be able to touch on this, we have given our commitment to really lend our hand on MSMEs. And we had given a commitment that this year we'll double what we did in 2024, which was 75 billion to these micro and small businesses. We gave ourselves a commitment to double that. I hope Chair can be able to tell us where we are on that particular journey. And because of time, allow me to stop here and thank you again for your patience. Thank you for honoring our invite to be here for this discussion. And just to indicate that we've transitioned from pure research to now actionable strategies to be able to ensure that we are solving the challenges that we have amidst us. So I'll thank you once again, and allow me at this point to be able to invite our chairman, Mr. Paul Russo, to be able to give us his remarks, and thereafter he'll invite the governor to be able to speak to us. Thank you.
Thank you, Raymond. Our chief guest, Dr. Kamau Thuge, the governor of the Central Bank of Kenya, the members of KBA Governing Council, the CEOs of member banks, KBA CEO Raymond Molenje, colleagues from different banks, colleagues from government agencies and development partners, esteemed researchers, academics, and thought leaders, ladies and gentlemen, good morning. Let me join Raymond, apologizing for starting this late. It's bad manners for bankers to do something like this, but not an excuse. We're next door discussing credit guarantee scheme and setting up a credit guarantee entity owned and managed largely by private sector, and that will be by banks anyway. So it is important for us to set that agenda going forward. As I said in that meeting, Governor, if we believe SMEs are critical for this country, then we must put our money and we must put our skin in the game. And the way to do it is to make sure that that company comes to life, hopefully by end of October. Let me take this opportunity once again to warmly welcome you to this annual forum. I believe this event is essential as it brings our industry together to develop fact-based solutions that improve banking products and enhance customer experience. From the outset, I wish to extend our sincere gratitude to our chief guest, Dr. Kamau Thuge, for joining us this morning. The CEOs in the room will know that there is just shortage of time. And if we are struggling with time ourselves, you can imagine about the time for the governor. So Governor, we truly appreciate. Governor, that presence also for colleagues from different banks is important because they come here first in the first instance to hear from yourself. Many of them see you in different forums, speaking to particularly CEOs. I think this is a fantastic opportunity for a number of our colleagues here. Ladies and gentlemen, the conference is far more than just a calendar event. It's a critical forum where we confront difficult questions, share experiences, based insights, and shape the solutions that will define how our financial system fuels Kenya's growth. This year's theme, Banking and Economic Growth Dynamics, Navigating Risks and Leveraging Opportunities in MSME Financing, strikes at the very heart of our national economy. SMEs employ millions of Kenyans, contribute nearly 40% of our GDP, and are central to households' income and livelihoods. Yet, they do experience, in my view, the most challenge in getting financing. From a macro perspective, our progress is commendable. As an industry, we committed last October to supporting MSMEs with 150 billion Kenya shillings in financing every year, starting from 2025 over the next 3 years. As Raymond has said, I'm pleased to report that by mid-July, we had not only met but exceeded that target, disbursing slightly over 153 billion Kenya shillings. It is my hope that this momentum is sustained throughout the remainder of the year. Governor, I think if there is anywhere we get a challenge from every key stakeholder, and you've challenged us as well, is lending to private sector. And if we continue this momentum and with the turn of the numbers that you had reported, I'm sure we will get back, and our dream, Governor, is double digit. And that's how I throw banks under the bus. There is no space for us not to get to that double digit. It's not one institution, it's not CBK, it's not GOK, it is a collective. Because when businesses thrive, when private sector lending grows, we as institutions will thrive. So it isn't just for those businesses, it isn't for the nation, we're also doing for ourselves. So as we gather today, we cannot forget to mention some of the groundbreaking reforms that the industry has recently witnessed. For the first time, we have a market-determined benchmark that brings unparalleled transparency and fairness to loan pricing. Borrowers will now clearly understand the factors driving lending rates and the contribution of the individual credit history to the overall cost of credit. And it's good that Julian is here and is the one emceeing this event. Governor, this gentleman asks us very hard questions on these matters. But I think, and as we've agreed, it's a collective, isn't it? We want transparency, right? But we also want to increase lending to private sector. And if we have to increase lending to private sector, we have also to understand that those rates must be coming down. Now that is very difficult for banks, Governor. Because a few people keep asking me, Paul, so is it control of rates? No, it's not control of rates at all. We're just saying there's transparency because risk-based pricing brought that transparency. But we also have to transmit monetary policy decisions. And Kenya Bankers Governing Council has agreed we must work together. And it's been a fantastic working relationship to try and bring this to life. So I commend industry for working with the regulator to finally bring this to life. It therefore means the good repayment behaviors will be rewarded with lower rates, and long underserved segments like MSMEs, women-led businesses, youth, and persons with disabilities can access credit on a more predictable and equitable terms. We recognize that access to affordable finance remains one of the most significant barriers to small businesses. By adopting the Kenya shilling overnight interbank average, now called Kesonia, and embedding transparent risk-based pricing, Kenya is aligning with global best practices. Equally important, this reform strengthens the transmission of monetary policy, as I said earlier on, ensuring that the central bank's decisions on interest rates are felt more directly and efficiently by households and businesses. For us in the banking sector, these reforms are not merely about compliance, they challenge us to reimagine customer service, to improve in how we extend credit, support resilience, and leverage technology to include segments previously left behind. This is precisely why gatherings like today's are so essential. They provide the space to move beyond slogans and obtain evidence that drive decisions which cause sustainable transformation. Over the next 2 days, looking at the program, you will explore credit guarantees, digital finance, sector-specific needs, and sustainability-linked lending. You will see how data from gender-disaggregated dashboards to advanced credit scoring models can fundamentally reshape how we assess MSME creditworthiness. For me, the takeaway is clear. Our success as banks will be measured by how effectively we translate these insights into tangible actions. Let us pick up the compelling research evidence and use it to ensure that a small businesswoman in Gikomba, and I would say in Marsabit as well, a young digital entrepreneur in Kisumu, a farmer in Kitale, finds it more easier and affordable and more predictable to access credit they need to thrive. As we begin, I encourage us all to engage in honest debates, collaborate openly, and keep our focus on the ultimate prize, a banking industry that serves as a steadfast partner to MSMEs and a dynamic engine for Kenya's sustainable economic progress. With those remarks, it is now my pleasure to invite the chief guest, Dr. Kamau Thuge, to deliver his keynote address and officially open the conference. I thank you.
the Chairman, Kenya Bankers Association, Paul Russo, members of the KBA Governing Council present, the Chief Executive Officer, Kenya Bankers Association, Raymond Molenje, CEOs of commercial banks present, ladies and gentlemen, good morning. It's a great honor for me to join you this morning for the 14th Kenya Bankers Association Annual Banking Research Conference. Let me take this early opportunity to first congratulate the KBA for organizing this conference for the 14th year in a row, and second, to thank the KBA for inviting me to come and deliver the keynote address. The focus of this conference, banking and economic growth dynamics, navigating risks and leveraging opportunities in MSMEs financing, aptly captures the policy objectives of the CBK and indeed those of the government. And I commend the KBA for its continued collaboration with the CBK on critical issues in the banking sector. Ladies and gentlemen, a necessary condition for sustained economic growth and development is a stable macroeconomic environment. The Kenyan economy remains resilient to global geopolitical as well as domestic shocks, with real GDP growth of 4.7% in 2024 and 4.9% in the first quarter of this year. The economy is projected to grow by 5.2% this year and further 5.4% in 2026 on account of a strong performance of the services and agricultural sectors, supported by a recovery in credit to the private sector. Overall inflation is well anchored within the target range of 5 plus or minus 2.5%, having declined from 9.6% in October of 2022 to 4.5% in August of 2025. This inflation outcome reflects the impact of monetary policy measures, stability in the foreign exchange market, and improved weather conditions. We expect inflation to remain within the target range going forward, supported by stable food and energy prices, as well as the continued stability of the exchange rate. The foreign exchange market has remained stable, supported by a narrowing of the current account deficit, reforms in the interbank market, and investor confidence in the economy. The current account deficit is estimated to have narrowed to 1.6% of GDP in the 12 months to June of 2025, compared to 1.6% of GDP in the 12 months to June of last year. This reflects improved exports of goods and services, strong diaspora remittance inflows, and lower oil imports. The capital account and financial account inflows more than financed the current account deficit, resulting in an overall balance of payment surplus and a build-up in foreign exchange reserves. Last year, we started the year with a reserve of 6.5 billion, and we were able to build reserves by the end of December to about $9.3 billion. This is the highest level of reserves we had up to that point. And of course, since that time, with the improvement in the current account, we have been able to go into the market, purchase more foreign exchange, and now we are at about 11 billion. And I expect that the current account transactions will continue to record a surplus going forward, and therefore that will afford us another opportunity to keep on building our reserve position and really to strengthen our external buffers. The banking sector plays a critical role in supporting this robust growth and contributing to price stability. A stable and resilient banking sector is an engine of growth through credit intermediation. I'm happy to note that the banking sector remains profitable, stable with adequate capital and liquidity buffers, and generating public confidence. supportive regulatory environment, robust supervisory practices, stable macroeconomic conditions underpinned by improving business environment continue to contribute to this stability and resilience. There are, however, developments in the domestic and global economies that require us to be more vigilant and to take measures that mitigate against emerging risks. For instance, technological innovations in the financial sector have increased efficiency, developing products that are relevant and identifying potential customers and their needs. However, digitization of financial services has also elevated cyber risk exposure to banks and to their customers alike. This is the time to beef up cybersecurity defenses to mitigate cyber risks and thereby ring-fence the stability of the financial sector. Towards this end, the CBK has undertaken measures to ensure the banking sector remains strong and continues to finance the economy. And these measures include raising the core capital requirement of the banks from 1 billion shillings to 10 billion shillings over the next 5 years, refining the monetary policy implementation framework towards an inflation targeting regime whereby we establish a corridor around the CBR and open market operations are designed to ensure that the interbank remains very close to the policy rate. The review of the risk-based credit pricing framework to enhance transparency in credit pricing and promote new financial products, which while enhancing monetary policy transmission. The issuance of the Kenya Green Finance Taxonomy and Climate Risk Disclosure Framework for the banking sector to guide investment and mitigate climate change risks. And finally, other initiatives have included unlocking the functioning of the foreign exchange market, getting rid of the dual exchange rate, and the introduction of the electronic B-match for enhanced transparency and more efficient price discovery. These initiatives, ladies and gentlemen, put the banking sector at a strategic position to effectively meet the financing needs of the economy, including the MSMEs. As we gather today, the MSMEs contribute to employment of over 70% of Kenyans and account for over 30% of GDP. This contribution can be increased if the MSMEs have access to finance, a good business environment, including regulations that are supportive of MSMEs. Addressing financial needs of MSMEs is even more urgent due to providing employment to the youth as well as producing essential goods and services. And in light of the ongoing reduction in the CBK policy rate, it is my expectation that banks will further reduce their lending rates so that credit to the private sector can increase along the lines that Paul just talked about, and to increase from the current growth of 3.3% as of August to over 10% by the end of the calendar year. And I really challenge you to aim for this and achieve this target. The gain in financial inclusion registered in our country has been supported by conducive legislation and regulations as well as innovation. As of 2024, Kenya's adult population access to formal financial services was 85%, way above the 27% that was recorded in the baseline survey of 2006. While this transformation is impressive, we note a large population comprising of women, rural residents, youth, people with disabilities, and farmers face higher level of financial exclusion. There are also people who think that the financial sector is not meeting their needs And this is mainly reflected in the low financial health score of only 18% in 2024, which is down from 39% in 2016. There are also consumer protection challenges, including lack of transparency in credit pricing, unethical debt collection practices, among others, which have come with unintended consequences. All these issues, distinguished participants, must be addressed through data-driven policies, deliberate strategic initiatives, and partnerships between the private sector and the public sector. To address the above challenges and further increase financial inclusion from the current 85% to 90%, the CBK, in collaboration with the KBA and other stakeholders, have developed a National Financial Inclusion Strategy 2025 to 2028 that we expect to launch shortly. I think one of the things that the strategy is ready, has gone through the key stakeholders, and I think the idea was to launch it maybe before the end of this calendar year. I'm looking at FSD, at Tamara Cook, and she's shaking her head, saying yes, we're supposed to launch it, and that's the target. But we had a discussion about it yesterday under the Financial Stability Committee, and we thought it might be useful to have further public participation. So we do intend to, again, just circulate it to the public for further comments before we launch it. So this strategy is anchored on deepening access and usage, strengthening market conduct, consumer protection and financial literacy, developing and fostering inclusive and green finance, promoting rural agricultural finance, and improving access to finance for women, youth, MSMEs, persons with disabilities, and forcefully displaced persons. The realization of the objectives of this strategy requires concerted efforts of all stakeholders, and I strongly believe that our partnership with KBA and other key stakeholders will be decisive. Let me conclude by once again reiterating the importance of this conference to our country and the banking sector. The blend of senior and young scholars, policymakers, practitioners, and researchers signify the importance of this conference. I'm confident that the conference will enhance understanding of the issues that constrain the banking sector from contributing effectively to economic growth and lending to MSMEs. I'm also confident that deliberations will yield solutions and identify areas of collaboration to harness the full potential of the banking sector in supporting MSMEs. I know I've mentioned very briefly the new risk-based pricing model, but I think it would be remiss on my part if I didn't say just a little bit more on this new framework for setting interest rates. And I want to echo Paul's point that this framework is not about controlling interest rates. We all know the impact of controlling interest rate. We have tried it before. It didn't work, and we are not going back to that regime. Now, the key mandate of the central bank is one, to ensure that there's stability in the general level of prices, which of course is inflation, and we have interpreted that mandate to mean that we target an inflation rate of 5% plus or minus 2.5%. The second mandate of the central bank is to ensure financial stability. And we believe that we have broadly achieved the two objectives. I think inflation now is, as I said earlier, is 4.5% in August. And I think some of the actions that we have taken in terms of even raising the capital requirement of the banks further strengthens the financial stability of the financial sector. So the third mandate of the central bank is subject to achieving price stability and financial stability, is to help the government in achieving its growth objectives. And I think that's where we are. I think we took some very strong monetary policy measures in the last 2 years, and it bore fruit. We were able to stabilize prices, we were able to stabilize the exchange rate, and I think it's now time to pivot from stabilizing to now encouraging production. And that's why we have reduced the policy rate, I think seven times in a row, by 350 basis points. And when we were raising the policy rate, I think all of you will agree with me that the banks were very quick to respond to an increase in the policy rate by raising their lending rates, which was the intention. The intention is to reduce aggregate demand and bring aggregate demand towards production, and therefore reduce excess demand, and that's how you address inflationary pressures. But when we now started to lower the policy rate, we could see there was some reluctance on the part of the banks to lower their rates. And as I said, we have lowered the policy rate by 350 basis points since August of last year. The Treasury bill rates have declined by 50%. Yeah, Treasury rates were about 16, 17%. They are now, even the 91-day Treasury bill is now below 8%. Yeah? But the average lending rate of the commercial banks has only reduced by 200 basis points, from 17.2 to 15.2 on average as of August. And so therefore, there was this asymmetry. When policy rate goes up, banks raise their rates. When policy rate goes down, banks are reluctant to lower their rates. Now, I know the previous risk-based pricing model may not, I know they had some shortcomings, and one of the shortcomings was the fact that there wasn't a common reference rate. There wasn't a common base rate. Each bank had their own base rate. And so it introduced some vagueness. There wasn't much transparency as to how the banks would be setting their rates. And so that's why this new framework, which is Kesonia. Kesonia is, just stands for the Kenya shilling interbank, overnight interbank average, plus a K. This Kesonia will be the common reference rate for all variable rate loans, except for the foreign currency denominated loans. All other loans will have the base as the Kesonia. And all banks will also have the same reference rate, which means under our current monetary policy, as I said earlier in my formal statement, we do have a new monetary policy framework. We set the policy rate. We have a margin now on either side of 75 basis points, but every time when we change the policy rate down, we go into the market, inject liquidity, and make sure that the interbank rate also goes down to where the policy rate has been reduced. And since the interbank rate is actually the Kesonia, what will happen in future is that every time the policy rate goes down, Kesonia goes down, and all variable rate lending rates also go down immediately. So there won't be an excuse by the banks that for whatever reason, there's quite a number of excuses. So this time there won't be an excuse. Once we lower the rate, then the banks should also lower their rates. And I really do believe that Kenyans prefer this kind of a transparent way of setting interest rates. And if I were a CEO of a bank, I would move as quickly as possible to implement this framework. I know we have given you 3 months for new loans and 6 months for existing loans. But if I were you, I would move as quickly as possible to implement this framework, because Kenyans want a transparent framework. And Kenyans will choose to go to the banks that have a transparent framework. So the longer you wait, you might find that your customers will be moving away from your bank to a bank that is having a transparent way, and to be able to explain to Kenyans how their interest rates are being determined. So I urge you to call for board meetings, get your framework approved, and then you send it. You start implementing. You don't have to get any permission from the central bank. You just need to inform us after the 15 days of the board approval that this is how you're going to be setting your interest rates. So, with those few remarks, it's now my honor to declare the conference officially opened and wish you productive and insightful deliberations. Thank you very much.
Let's appreciate the Governor of the Central Bank one more time. Thank you very much, Governor, for your reflection on the subject of the day, and also more specifically on risk-based pricing. You know, my good friend Paul Russo said, I normally ask tough questions on this subject. Paul, I should remind you that there's something we say in the newsroom, that our job is to comfort the afflicted and to afflict the comfortable. So you happen to be on the latter side with a light touch, Paul. Good to see all of you here. Thank you so much. Because of the interest of time and the governor has to transition, we want to do something very quickly. The first one is I would like to recognize the presence, and let me just get this very first right. Sorry. I'd like to recognize the presence of the Executive Director of the Tanzania Bankers Association. Madam Tuse, are you with us in the house? There she is. Let's appreciate her. I'd also like to recognize the presence of the Director of the Africa Economic Research Consortium, Dr. Abi. Where are you, sir? There he is. Let's appreciate him as well. Asante sana. We want to do some very quick photo ops with the governor, and I'd like to invite the governor back on stage, please. The first one is the governor, all CEOs in the house, the chairman of KBA, the vice chair, and the CEO. So governor, please join us on stage. Chief executive officers in the house present, please make your way here. We will do it right at the podium here. So my camera crew, please join us. And we also need the chair, vice chair, and CEO of the Bankers Association. Let's have that photo moment taken. Right there. Thank you very much. Another one. Very good. Thank you. Let me remain with the governor on stage. Let me remain with the governor. The rest, please, let me usher you back to your seats. I'd like to call on stage Madam Tuse and Dr. Abi. Please come on stage for a quick photo moment. That is Tanzania Bankers Association. Karibu sana. Yes, let's have that photo opportunity. Raymond, please, you can join us. All right, let's have that one taken too. Thank you very much. Governor, one last photo. Please, you may resume your seats. Let me remain with the governor. How many authors do we have in the house? Authors for the papers we shall be presenting? I'm trying to see whether I should put you on the stage here or down there. Please come. Authors, make your way here, including the head of research from KBA. Please come. So my camera crew, guide me. Do we do it down there or up here? The authors are saying they want it up here. All right. Please. These are the guys who will be taking us through the technical rigor today. Oh, yes. Sorry for this. Since we have seats on the podium, let me have the governor and a few seats and the rest will stand at the back. I think that's in order. Let's have some flow this side. All right, that looks neat. Oh, sorry. Let me. Asanteni sana. Please, you may sit now, governor included. Asanteni sana. Thank you for that. Thank you very much. That was the opening session of the 14th edition of the research conference convened by the Kenya Bankers Association. You may take your seats. You may take your seats. As I call my panel on stage, I am told that the governor is pressed for time, so governor, we will understand if you must leave at this point or further down the road. It is to your discretion. Thank you so much. Let's appreciate the governor one more time for joining us this morning. We have to release him to attend to other duties on his schedule. Asante sana, and to the larger CBK team for being part of this. That sets the stage for our panel conversation this morning, and that conversation is on MSME policy and monetary dynamics, implications for financing, lender opportunities, and barriers. First of all, my tech team, I need microphones at the front here. Meanwhile, let me call on stage Madam Tamara Cook, CEO FSD Kenya. Let's appreciate her as she joins us here. Let me call on stage Felix Ndunda, Kenya National Federation of Jua Kali Associations. Please join us. Mr. Jared Osoro, economist and member CBK Monetary Policy Committee. Please join us on stage. And finally, Moses Nyabanda, MD Equity Bank Kenya. Karibu sana on stage. You know, panels are meant to be conversational, so that's why we arc the seats that way. Are we getting more mics? All right, I can see 2 so far. All right, it looks like I will have to use this one. Just cut the music, please. Thank you. My panelists, because of time, we will make this more of a quick fire and less of a panel. So we'll be whipping through the questions in a very first manner because of where we are with the schedule. Maybe let me start from, because we're talking about MSMEs, let me start with the Federation of Jua Kali Association. Bwana Felix, what is the experience of the association's members in accessing credit, loans from the banking sector?
Yeah, so thank you very much. My name is Felix Ndunda from Kenya National Federation of Jua Kali Association, in charge of membership and youth services. So one of the challenges that our member organization face when it comes to access to finance, especially with the formal banks, is the issue of collateral and also the issue of credit ratings. Because you find that most of the formal banks look at the informal sector as financial risk. But there is where it lies the opportunities. And also some of the products that the formal banks have, they have a mismatch with what the formal sector members require. So those are some of the challenges that we face as the informal sector.
If you noticed, I asked him about the experience, and he straight went for the challenges that they face, which is very interesting. And that's the story of MSMEs. Now that we've heard from the MSME side, let's hear from the banking side. Bwana Moses, you're being told essentially you're too much focused on collateralized financing, and majority of the players don't have the assets to go that route.
Thanks, Julian. I'm sure that this is on. Thanks, Julian. What Felix has described is a challenge as the banking industry we have to rise to. The traditional banking setup was built up out of a collateral model. But hearing the statistics that even Raymond mentioned this morning, that 98% of our businesses are SMEs, the ballgame must change, Julian. And in here is then how can we use as much data, and we're in an age where data is very much readily available for us, to deeply understand the kind of borrower that's coming in. And banks have a challenge right now to ensure that we're able to mix a lot of the data. Your spend on what you spend on Safaricom, what you spend on your POS, the transaction flow that you do have, should be very rich data for us as banks then to look at, then what's your credibility as a borrower? Because every time a bank, I guess, goes through a lending process, they want to understand credibility. There's been that shortage of information. So information asymmetry, everyone defaults then to, let me cover myself using collateral, and that's where we found ourselves. We need to ride on the wave of the information age and use as much data points around an individual as possible. Related to that, Julian, is then how do we also support the SMEs to capacitate themselves? I think we have a moral obligation as banks to ensure that we do walk with the SMEs the journey. Do we need to help them strengthen their governance? Do we need to help them make a better pitch? Do we need to improve on financial literacy around them? If you combine all those together with various data points, then the need for collateral reduces. And I can give you an example. A lot of our agricultural clients, and equity is big in agriculture, we are able to figure what will be your estimated yield, for example, for tea or coffee. Where are tea prices at this point? And I'm happy to give you a haircut on what my estimated is and lend you based on what's the estimated output that you expect. So there are various innovative ways that banks should be able to come in.
Thank you very much, Moses, for that. Now let's hear from an external party, and that is FSD Kenya. You do a lot of research on this space, on formal financial inclusion. Where are the pressure points? Because as you've had, collateralization and listing on credit reference bureaus is a big problem for MSMEs.
You know, there's so many statistics I could bring out, and I really appreciated the governor referencing the FinAccess survey and some of the data that was already included there. You know, because we're in a room with banks, I just wanted to start with one statistic, which is that according to FinAccess, for those people who say their primary livelihood is business, only 35% of them even have a bank account. Far fewer have a bank loan. And even though 35% have a bank account, only 6% of them actually have a business bank account. So they may have an account with a bank, but is it recognized that this is a business? You know, you've heard mentioned that many of us were at the guarantee scheme breakfast this morning. And one of the challenges when that was first launched in 2020 is the requirement was for a business to be guaranteed under that scheme, they had to be registered. And we know so many businesses are not registered, and men are much more likely to be registered than women. And so I think, you know, if we look at I like what you said about data, and it's really important, and part of that data is the credit reference bureaus. I've been in 2 events over the last week around that credit information sharing mechanism, and it's really important that we change the narrative, that the credit reference bureau is not about blacklisting. It's about collecting data on good performance of loans and enabling that data to be used to qualify people for better loans, longer term loans, and cheaper loans, as we also heard as another policy objective. Maybe I'll stop there.
Thank you, Tamara, for that. So we've heard from the players, but we have central banks still with us. And Jared, you have vast experience in supporting credit markets, and not just in Kenya, at a continental level. It seems from what we are hearing that there's a decoupling in the sense that MSMEs are saying you are frozen in time in terms of the lending models. We have new approaches we think you should be able to deploy to extend credit to us. Where do we stand from a credit market standpoint?
Thanks, Julian, and that's a very tough one because it's a cyclical thing. So where to start is difficult to say, but let me just say a few things that can give you a perspective on how the credit market, especially in the context of SME, is shaped across many markets, including Kenya's market. The first is to acknowledge that there's no market that is perfect, and that's a reality. And those imperfections are even more when it comes to the credit market. Now, when it comes to some of the attributes of those imperfections, there are 3 things that come out easily. The first one is that typically in bank-led financial ecosystems, even though, as we had earlier in the morning, that many enterprises are actually SMEs, there's a deliberate leaning of credit towards the big corporates. That's one imperfection that declares itself. And then, of course, on the back of that is the fact that there's an element of market power that plays out both on the demand side and on the supply side. Let me give you an idea of how the demand side looks like. Now, if you have corporates that are able to attract not only access to credit, but also in competitive terms, that usually comes almost at the expense of looking at SMEs as an avenue for credit. That's just one side of the market power. The other side of the market power is where now the lenders themselves view their portfolio to be much more profitable from a cost standpoint by leaning more towards the big corporates. So that is an imperfection that I think glares itself in many of the markets that I see across the continent. The other is really this idea of talking about SMEs without acknowledging the fact that they are not homogeneous. Yeah. There are some SMEs that you can't distinguish them from the owners, and they're at a very young stage of development. Those SMEs, and as Tamara and others will confirm from the numbers, are accessed more by access to credit than the cost of credit. So when you hear people talk about SMEs are constrained by lack of funding, then you probably have just lumped the problems of SMEs together. As you graduate, as you become bigger, then the issue of cost becomes an issue. That's another imperfection that actually arises, because we tend to assume that SMEs are just the same. They are not homogeneous across markets. And the final one is around the issue of in the event of a shock, when there's a market shock, and that shock reveals itself in the quality of the assets in the financial system deteriorating. It doesn't matter whether the quality of deterioration of the quality of assets in the financial ecosystem is arising from SMEs. What you tend to see is that credit to the SMEs stop flowing. There's what you can call almost a sudden stop. So those are the kind of imperfections that you see across many markets in Africa when it comes to SME financing. So that if you want to address their problems, then you have to start looking at the idea of market power, the idea of the non-homogeneity of the SMEs themselves, and what happens when there's a market shock. And I think that's really how a conversation around meaningfully intervening in SMEs requires you acknowledging that that's where the pain points are.
So clearly we can't use a broad brush to paint everyone in the landscape as MSMEs.
Precisely.
Let me come back to the Jua Kali Association. Now, banks always raise this issue with me whenever we have the conversations, and Paul did mention in one case that even if we wanted to support MSMEs as much as we want, when these guys come to us, their books are not in order, or they are not existent at all. So that is flagged as a challenge from the banking side towards your side. Is it a big problem? And as an association, what do you do to support your members to get ready for banking financing?
Thank you very much. Yeah, that is a very big challenge, and that calls for also the banks to have a strategic partnership with MSMEs. And I can proudly say, as an organization, we have an MOU with KCB Bank, whereby such kind of financial literacy are able to be extended to our members. And through that, we're able to see some of our members being able to access some of these credit facilities through banks. I can happily say that right now we have our members accessing some credit facilities through KCB Bank called retailer financing, which lowers the requirements, especially when it comes to collateral. And and that's what I'll call on banks, is that also banks should have a targeted market proposition, especially when they're dealing with MSME, so that even when they're coming up with products, they're co-designed with MSMEs, so that even when, there's a difference when your books are in order and how to access those finances. Because some, they have their books in order, everything is okay, but still when they come, there are some bottlenecks which hinders them. So even as we progress with this conversation, also banks should come up with very practical, sustainable, and impactful solutions to the MSMEs, especially MSMEs run by the youth, because that's where the really big challenge is. Yes.
Moses, hearing what has been said here, is there a product design market fit mismatch in terms of how banks are targeting MSMEs?
Thanks, Julian. And just reflecting what Felix has mentioned, and Jared, in terms of also the stratification. I think at the earlier stage, the only thing you can rely on is data. And the easiest way to support those businesses has to be a combination of two things: capacitation and hopefully driving lending in a digitized way. Because that way, then I'll be able to collect data much quicker. So I can start with you, Felix, small, and build you up. So I don't need to ask for your books. I can just look at your repayment schedules, where we started, how your business is growing. And with time, as we work on capacitation, then we're able to build a product for you as you get to mature. For the next category of SMEs, then these are probably established businesses, then we have to look at it a little different, because there you need to figure, how do you credit score? Credit scoring has to also change. We've traditionally looked at monthly repayments, what's coming through. That doesn't work for SMEs. We now have gig economies where flows are like this. So again, it takes quite a bit of effort for us as banks to set up systems that are able then to capture that. Then we are able to design something. If we leave it as it currently is, we probably won't be able to cure what it is we are dealing with today.
Tamara, I'm sure you want to chime in on that point of books, readiness, and how we design solutions for MSMEs.
I wish I had all the answers on that. But I think it is interesting that I told you 35% of businesses have a bank account. Only 35% of them keep records. And so I don't know if it's the same 35%, but I bet it may be. We also see that only 18% of businesses have a pay bill or a till, and that's one of the ways to create data, right? You were saying if you can digitize the payments, it helps digitize the data, and then you're more able to credit score. You know, when we ask through FinAccess banks or ask individuals who own businesses, why don't you have a bank account? One of the things they say is, I can't afford it. The other thing that they say is, banks don't have products that meet my needs. And we see people who have never banked say that, but we also see people that used to bank and have left banking because the products don't meet their needs. And so I think what Felix was talking about and others is not having kind of a standard vanilla. They're not monolithic, right? Being able to have flexible products that allow flexible repayments, flexible, understands those dips in business cycles. And so I think that's one of the options. I also think there's policy changes that could be made. So since we have central bank represented, and it's good to have central bank in the room, one of the conversations we just had was around guarantees. Guarantees are something that can unlock finance for MSMEs, but if a bank still has to do 100% risk rating for that loan, it's not going to unlock it in the same way. Also, traditional collateral, you're allowed to kind of do a lower risk rating, but maybe movable collateral or other types of ways of kind of thinking about that loan, the banks don't have the same ability to reduce that risk. And so it's good to make changes on the policy side that make it easier for banks to lend. And also it's important to look at the data to understand what are the needs that MSMEs have for this more flexible, affordable type of financing options. Thank you.
That's a good way to segue to Jared, because the question then is, what reforms from a policy perspective will then act as a catalyst for roping the MSMEs into the formal financial market?
Okay, I think I'm glad we're in a room full of bankers. It's first to acknowledge that banks will play a very critical role so far as lending to SMEs are concerned, but they are not the only game in town. The financial ecosystem that speaks to SME and lend to SME is bigger than banks. So the reform is really to make sure that you have a system that looks across the entire financial ecosystem to include the non-bank lenders into the fray of SMEs. Because when SMEs say that the banks don't understand them, and that's what probably I heard from Felix, that sometimes they don't understand them, where do they go to? They probably go to other lenders. Some of those lenders may be having challenges, including the need for them to reform. We see the space of digital lenders who could be giving money to SMEs requiring reforms. So acknowledging that there are other institutions that complement lending to banks is one of the areas that I think you have to start thinking about. The second is really to know that reforms are continuous. So you experiment with reforms and see how that supports the SME lending and how that will enhance the portfolio growth. But it will not be complete if you think about the reforms only on the lender side, on the supply side. There has to be reforms on the other side also, from the demand side. How are the SMEs operating? Is the environment around which they operate conducive for them to meaningfully have what we can call effective demand for credit? Because when you hear people talk about SMEs are not being lent because they don't have collateral, we've already jumped a step. A bank is going to lend to you not because you have collateral, but because you have a business proposition, and therefore effective demand, and therefore collateral gives you the lender the comfort to be able to lend. So there's a reform that you need to think about on the demand side that I think are going to be very critical. And I think many of those reforms cut across many areas. The information infrastructure, people are talking about data. How readily available is it? What quality of data is it that is going to support lenders understand the business they're lending to? And then, of course, there's what you can call the incentive or their lack of to formalize the SMEs. If you have a system that disincentivizes SMEs from formalizing, then I think you're robbing them of opportunity to actually access more credit from the financial ecosystem than they actually do right now. So I think when you're looking at the reforms, continuous, look at it from both the demand and supply side, and look at it in terms of how comprehensive it is in terms of covering the entire financial ecosystem, acknowledging that there are other lenders beyond banks that are in the space.
Jared. Jeez, what happened? Allow me to push back on that point on effective demand, because I was having a conversation with the MSMEs and they raised a very interesting point, that there's a peculiarity in the Kenyan market. Whereas you can justify that you have effective demand for your business through invoices, the invoices will not necessarily translate into cash flows, because we have other challenges in this market and you know about them, pending bills, etc. So how does the banking sector then take cognizance of this, Jared? And really just your thoughts on how that can be factored in.
I look at it from a very basic standpoint. Effective demand means you have the ability and the willingness to repay the loan. You could be having an invoice that indicates that you could actually be able to, pay in the future when that invoice is ordered. I believe banks have structured products that recognize invoices as a comfort for them to be able to lend. But if that invoice is not paid, and the history of some invoices not being paid, then in that instance there's no effective demand. So I think it's a case of acknowledging what truly is effective demand to avoid a situation where there's the moral angle that Moses talked about, but that not translate into the banks realizing the returns out of lending to SMEs or building up into what you can call low quality assets that go into that space. I can give you an example of the kind of things that needs to be considered when you're thinking about effective demand lending to SMEs. Think about SMEs in the agri space. There's a study that was done by the World Bank, Kenya Forecast in 2019 on agribusiness, and it was actually ascertained that in terms of the pain points of agri-SMEs, lack of credit and the cost of credit is number 5. There are so many other things up there that needs to be considered, including do you get support at the production level, extension services, these public good-oriented things, infrastructure, post-market support that makes you be able to meaningfully run an SME as a business. The fact that you own a piece of land and you're able to plant crop does not necessarily mean that you have effective demand for credit. So I think it's how you look at what effective demand means and how that fits into the kind of demand and supply kind of attitude you have towards the reform that I've already alluded to.
Okay. I have one question before I invite any questions from the floor. So after this round, just be ready in case you have any. You'll shoot up your hand, introduce yourself, and throw your question. How much is pricing or the cost of credit a pressure point for SMEs in accessing credit? Let me start with the Joe Akali Association, then we hear from FSD.
Yeah, I think one of the hindrances is the high cost of credit, especially when it comes to the MSME. And that's what edges out MSMEs, especially when it comes to growing up their business. And this issue of financing to MSMEs, I think is a conversation that it takes two to tangle. And maybe I can go back to my last statement is that we really need to work with the financial partners, especially the banks, to see how do we come up with products that really target MSMEs. Because you see, there's a difference when you say SMEs and MSMEs. Many people fall under the category of M, which is the micro. And that is where so many of the likes of myself are edged out. And that's when banks have intervention, they really don't have that impactful to the MSMEs. And that's why, and what Moses has just alluded to, is that when you come, for example, to the gig economy, you find that, if you look at a young man who is in the gig economy, their bank statement is not consistent because, business is not consistent. So I think going forward, also banks should assess someone as who they are and see how they can be able to help them progress and build their business. But if we continue with the same good stories, many micro will still be having these stories 10, 15, 30 years to come. Thank you.
Tamara.
It's a complicated question because, the cost of not having a loan can also cost somebody a lot. And so one of the things that we see is that banks will say, well, they were willing to pay that high interest rate, so it's okay if it's a high interest rate. But they're willing to pay it because the alternative is not buying and then not selling and then not feeding their family, right? And so I don't think that we should use willingness to pay as an indicator that the price is okay. But we do know that speed and convenience are really highly rated by MSMEs. I think also as we think about the price, it's about matching it. It's not, so when we ask people, why don't you take loans, affordability is one of the issues, but affordability is a complex topic because they're saying I can't afford it every month or I can't afford it this month. And so really it goes back to that flexibility of being able to pay things over time. I appreciated the governor mentioning this morning, and sorry for the tease to the banks, you raise your rates quickly when our rates go up, but you don't decrease them. And I was in an event with one bank who was engaging with their female MSMEs in the audience, and they not only asked this kind of a question, they said, we've seen how much money you made last year. Why aren't you paying us more on our deposits, and why can't you cut our interest rates? And I really loved that the MSMEs in that room were able to really be sophisticated and say, we want to partner with you. We're willing to pay for the services that you give us, but we want to kind of share this a little bit more. And so I thought that was, I won't say which bank, but it was a lovely, lovely conversation.
Jared.
Yeah, let me just, maybe this may sound a bit controversial, but I'll say it nonetheless. Obviously, the cost of credit is an issue to SMEs. But let's just do a thought experiment. Assuming an SME with a myriad of challenges because of SMEs being what they are, is assessed by a bank, and because of those challenges, they're not being given credit. Where does that take you? It takes you to a point where even if interest rates were to be very low, that is not going to make an SME qualified to get credit. I'd rather this SME is assessed, and that's why we have this called risk-based pricing framework. The risk is acknowledged and actually quantified, and therefore used as a mechanism of saying that if I'm going to lend to you, this is where I think your risk is, so you'll access the funding. As opposed to an SME saying, I'd rather not get the money if the interest rate is not at single-digit level. So I think cost is important, yes. Interest rates is important, but I think it should not be seen as the main pain point for SME. It should be seen in totality of so many other things coming into play. And that's why I say it differs what type of SME you are. Some are constrained by access, mere access, so they don't lose a business opportunity. Others now, as they grow, then now the cost becomes an issue. So I think it's not as straightforward that, it's cost, and therefore that's the main thing. The other thing is really to step back and ask yourself, when it comes to SME, why do we have to assume that the only funding the type that they can get is credit? Are there other funding avenues that I think the SMEs can benefit from? It's a question that people can answer in the room, but I think funding should not necessarily be seen automatically as credit. And finally, some SMEs actually don't get financial credit. You can get suppliers credit, and then you're able to do business. The issue is, what is the opportunity cost when you get credit that's not necessarily financial? It probably ends up being more expensive. And those are some of the dynamics in terms of credit that you need to consider, as opposed to narrowing it simply into an issue of price.
Moses, your thoughts on that issue of pricing?
Yeah, definitely a very topical one in the last couple of months. Why have, I guess, banks struggled to get rates to where, I guess, the expectation, and you've had the challenge from the governor. One of the bigger issues that we need to come, I guess, as a country, is the data asymmetry. If we get that right, Julian, I think it's a big way to move. Whenever at Equity, we capture guys from a refugee, for example, almost at the most bottom. And our work is to figure how do we capacitate you, bring your literacy to a level where you become bankable. Because there's a portion in where you're not bankable for real. You probably will rely on friends and family, you'll rely on a shopkeeper, you'll rely on the invoice financing. It's how do we build our data sets across this so that when I'm pricing for risk, and it's good the conversation now is around risk-based, I can truly assess you. Right now, I can tell you majority of banks, we've bucketed people. Micro, you'll be at the highest loan price, irrespective of who you are. Your business size is ABC. If another one, you're a startup, same specs, you'll be bucketed the same, irrespective of the opportunity. The people who pay the least are the people who have the best information. So if I have a blue chip, they'll most likely play the least. Yet, in true sense, the risk profile may not be the same. I could have a very guaranteed cash flow arrangement, which makes my business probably even less risky than that blue chip. So we need to sort information asymmetry.
Thank you, Moses, for that. Any questions from the floor? I'm happy to take 3 quick ones and we transition into the next because of time. There's a hand. Do we have roving microphones? Yes, please. There's a lady at the extreme end. Please introduce yourself, to which institution you're affiliated, and just shoot your question. Or comment as well. Any other apart from that one? All right, that will help me redeem time too.
Yeah, good morning. My name is Geraldine Lukanya Makunda from FSD Kenya. And it's a hard question back to Moses Nyabanda. So we have this thing, the We Finance Code, where we're trying to get all the data for MSMEs sitting together. And I know that's the question you're asking. But my question back to you is, what ideas do you have that can make this work? How can you deal with the information asymmetry? You know, everything about the MSME, all the data around their, whatever you said needs to come together. Thanks.
Moses, before you respond, I can see a hand here. Let's just take a batch of questions and we close it there. Here, right at the front here.
Okay, good morning, everyone. Okay, I'll just make a comment, an observation. And I like the approach of Mr. Osoro, looking at both the demand and the supply side. Over time, as banks have attempted to resolve this, they've poured a lot of money into SMEs on an unsecured basis. And they've actually picked huge losses, which become unsustainable. And to me, that is the question we need to answer. Because over time, as the bank shareholders put in money and picking losses, then they tend to share away for putting in more money. In the meantime, the SMEs have stuck at the corner. And that's a structure that he's talking about. How do we address the demand side so they can also come to the table and make themselves lendable in a sustainable manner?
All right, let's take those two. Moses, there's a question, then there's a comment, Jared, on the demand side, and how do we address that issue?
Geraldine, we've been favored by where we are technology-wise. So I'll tell you what we're doing at Equity Bank. We have 14 million customers at Equity Bank Kenya. For the first time, I've been able to put all that information in a data lake. And there's development now of new credit scoring tools to enable me capture a lot of the nuances that previously I never used to have. And I believe by the time we close this year, we'll have probably a better profile of majority of our customers just using the data we have internally. We then need to figure out what other data sets sit outside the bank that may be useful for us. Will that be data set that individual customers share with us? Is that data set that we'll get from external sources, including where Tamara sits, etc.? With that, then I'll be in a position to have a fairly enriched data source that I can then start even enriching individual customer profile. Previously, it became very hard to have data set for an MSME individual. I could have it at a corporate level for corporate business, because I gathered that data, I had systems to do that. On the mass side, that was a real challenge. But we are now in a position where clearly we should be able to achieve that. And hopefully it's a very different story next year as we look to do this. And I loved that the new risk-based pricing came in, because it has pushed us also to figure out how do we do this thing at an individual level. Thanks, Gerald.
Thank you. Jared.
I think I'll just comment on the demand side a bit, and also I'm tempted to jump in on the data side also. I think it's a fair comment to make that there are real serious issues on the demand side. The focus has been more on the supply side. Now, if you have observed the market and the interest that the SMEs have attracted, for a very long time, commercial banks have been attracting resources from DFIs, lines of credit that are dedicated to SMEs. And many of those lines go unabsorbed. The absorption challenges are real, not because the banks don't want those resources, but the demand side is a problem. And that speaks to how the focus has to be balanced between reforming the banks so that they can be able to address SME issues, but also looking at some of the things that actually make the SMEs themselves not access the resources that are dedicated to them. And that's the point that I'm making, and I think it's a fair point to make. So who is going to champion the demand side issues? Of course, the banks have a role to play there because that's the customer base, but there's also a public side to things. Other initiatives, be they of policy nature, be they of financial literacy, whatever you want to call them, so that you acknowledge that there's a demand side issue that actually will not make this story around funding SMEs be complete if it's not addressed. Now, on information asymmetry, you're obviously not going to have perfect information. It's actually enabling the lenders to have information that makes them comfortable, that they understand the people they're lending to. That's the only way you can look at how to bridge that information set. I know everybody's talking about artificial intelligence and all that. I think investing in artificial intelligence so that you don't have to rely on information that you collect in a certain way will help in terms of bridging that information gap that could be existing. Then you start seeing maybe that information supporting the appraisals of these SMEs and avoiding pigeonholing the SMEs into brackets and then seeing more credit flowing in that space. So it's a journey, but I think acknowledging that you can use technology to harness information and complement the information that is already available with the banks and elsewhere.
Thanks, Moses and Jared. Let me quickly invite my panelists to give me their closing thoughts because we have to transition to the next. And let me start with Felix, then I come to Tamara, then Moses, then Jared.
Yeah, so thank you very much. So I think this issue of MSME financing spurs grows outside this room because also it entails, people like KRA. Because why am I saying that is because there's a time whereby many MSMEs removed their pay bill and buy goods on their businesses because they were told that, KRA will come and collect, taxes or everything. So I think it takes a lot of collaborations to be able to help MSMEs grow from where they are. And for me, I think this is just a start of a conversation together with the banks. And one thing I want to call on the banks is that even as you're doing your strategies and the risk assessment, first of all, have a conversation with MSMEs to get to understand where they're coming from and how do you collaborate going forward. And maybe if I just say something on what the lady said about MSMEs, banks, churning out a lot of finances, but in return they go on losses because banks have not, where they are losing it is because there is no proper collaboration with SMEs. So even when you're churning out your money, there is no clear proposition where you're channeling it and how will be the impact going forward. So I think as we go forward is let the banks come with a strategic and sustainable and practical ways in helping SMEs. And I can say as an organization, we are in the forefront. Actually, I'm one in the program where KBA is doing is called the NUC Accelerator, just trying to sharpen the skills of SMEs. And yes, so I think this is a start.
Thank you. Tamara?
I think my parting shot is really about the theme of the conference. You know, it's about navigating risks and leveraging opportunities. And I think that's really highly related to the concept of financial health. You heard the governor say that financial health in Kenya has fallen to only 18%. For business owners, it's slightly higher at 25%. But the reason it has fallen so dramatically, especially for business, is that their ability to invest in the future, invest in those opportunities, has shrunk. They're so busy trying to get by day to day and dealing with the shocks that are coming their way that they're not able to take that long-term view. And so, you know, if I had a magic wand, the one thing I would do is create financial solutions that are collaborations between the MSMEs and the banks to identify these solutions that can help MSMEs invest in longer-term future opportunities. Thanks.
Thank you. Moses?
Thanks. We have a twin problem that we have to deal with: credit risk and demand. Jared has said quite a bit. If we tackle demand, a lot of the credit risk issues disappear. And I think as a country, as an industry, we need to figure how do we tackle the demand issue. And the demand issue boils down to productivity and the markets. If our markets are not available, are our neighbors' markets available? We go back to the basics to drive productivity. When you and I grew up, productivity on things like agriculture were probably at the highest. All those have come down. So we have to tackle those two.
Jared, your closing thoughts.
Banks are looking for opportunity. SMEs are looking for opportunity. There has to be a convergence, and that convergence has to be appreciating the risks on both hands, measuring those risks. There's a science to it, but there's also an art to it. So I think it's a case of how those opportunities are aligned so that, they benefit each other and the economy consequently benefits. I think that's really my parting shot.
Thank you very much. Let's appreciate the panel for their insights on this topic. So the takeaways from here are, one, co-creating solutions. Banks, MSMEs, let's sit together in a room, have a conversation, and co-create products which actually speak to the needs. Two, pricing is not an end in itself. There is a whole ecosystem around it which affects the question of credit, and the demand side is something we need to talk about. Two is data asymmetry. We need to look at it, find the friction areas, address it, and unlock credit. And finally, is that we are all scouting for opportunities, whether banks or MSMEs, and therefore, let's find the concentric area and be sure how we can take this forward. Once again, let's appreciate the panel. Asanteni sana. And rise for a photo, please. The cameraman, this is right here with us. Let's take that quick shot. And then we shall have gift appreciation from the Kenya Bankers Association, handed by the Vice Chair, Betty Korir, to each of the panelists. A step to your right, please. Yes, there. Let me invite Madam Betty Korir to come.
Want to be in the picture?
Oh, sure. Please, come and take another one. Let's have an appreciation to the panelists presented by the Bankers Association. That side, please. And that's the final one. Thank you very much. Asanteni sana. Please, you may resume your seats and of course watch your step there. Ladies and gentlemen, we want to go very quickly into a health break, and that right now it's noon. We are expected to be back here at 12:25 to kickstart our session, which will be on MSME partial guarantees in Kenya. And that, the presenters is Rogers Ochenge, Kenyatta and Strathmore University. The discussant is my good friend, Dr. Radha from the University of Nairobi, IDS, seated right there. So please, let's take a health break, grab something. 12:25, let's be back here for the next session.
DJ T-Face Obara. DJ T-Face Obara. T-Face. T-Face, Obara, sure. DJ T-Face, Obara, sure. DJ T-Face, Obara, sure. DJ T-Face. DJ T-Face, Obara, sure. DJ T-Face, Obara.
Come they smoke cannabis. Doctor say make a pop one of this. Make me fly like say I'm Aladdin. Come bring some kind melodies. Oh mama myself no do pass like this. So many things inside of my jeans. I slide down DBTs.
My name is Susan Muturi. I work at Mercy's Light Family. Mercy's Light Family is a teen pregnancy crisis center in Bipingo where we rescue girls who have been raped and defiled. And when their cases are ongoing in court, we have them there. It's more of a safe house for them. So the NGO started to look into ways that they can be able to empower the women of the Bipingo community, at the same time empower the girls once they reach 18 years, help them be independent once they clear out of Mercy's Light. So we started with this project, Milele Organics. Milele Organics does the production of pure virgin coconut oil. And we have another product called Milele Mango Jam. We don't have it right now. And then we have Upendo Fabrics, which the girls make these beautiful products. We make purses, we make bags, we make design clothes. So the girls, once they clear, when they come in, we train them. First of all, we take them through trauma healing. And then we help them with catering, tailoring, and doing different simple projects that they can be able to be dependent when they clear out of Masters Light. So one of them is tailoring. Remember, even if we don't have them at the center, they can be employed by EPZs around Vipingo. So apart from tailoring, we also do catering and we also do pure virgin coconut oil. Right now, we have employed about 7 of them in the projects. We have 3 in Milele Organics and we have 3 in Upendo Fabrics. We look forward to expand, to make more money, to be able to empower more women from the community and also to empower the girls. So the biggest challenge that we face is market visibility. We try as much as possible to do marketing via social medias. We also participate in exhibitions, but purchasing coconuts, mature coconuts, is very expensive. Also being able to transport, purchasing everything, paying the workers, water bill, electric bill, it's just a lot of, it takes a lot of money and the profit margin then ends up being so small. So that is one of the challenges that we face. And also, as much as you empower the women in the community, you can remove somebody from the village, but you can't remove the village mindset out of them. So that is something we face a lot of times because I've been working with these women since 2021, and you find out that they can't make the simplest decisions, like knowing where to get coconuts, like knowing what to do. They have to call and ask me, what can I do, what can I do? And I've worked with them for like 4 years. So that's another challenge that we face. Rather than that, we are good. What would I want from the bank? One, I would love them so much to start visiting rescue centers, not only children's home. There are so many rescue centers. Like ours is not a children's home. It's a rescue center. It's a safe haven for teen girls who have been raped and defiled. That's a different criteria. These girls need a lot of encouragement, a lot of trainings, a lot of people knowing that they have people that they can rely on. Remember, something valuable has been taken away from them. So trusting people is not an easy thing for them. So if they can come, train these girls, talk to them, empower them, all those CSR, bring us everything that you can be able to do. At the center, we have a very big budget. So unga is appreciated, oil is appreciated, clothing for the girls and the babies. So there's so much that the banking industry can do actually for them, for the center. Milele Organics and Upendo Fabrics is found in, mostly we do our production in Vipingo, but we have shops that partner with us that put our products in their stores. We have one in Fort Jesus Curio Shop. We have our products, both Upendo and Milele. We have Jahazi Coffee House in Old Town also. We usually sell our oil and our mango jam. We also have one shop around Mamba Village. Opposite, it's called Inspira. It's opposite a petrol station called Hansen. I don't know if it's Hansen or wherever. It's opposite first floor. And then we also do a lot of exhibitions. So, and my number is 0738-882-313. I have an email address, mileleoil@gmail.com. And you can find me in Twitter, TikTok, Instagram, by the name of Milele Organics. Even in Facebook, we are found.
My name is Stella Auka, and our company is called Broad Range Enterprise Limited. We started in 2017, and we have 5 employees for now. Some of them are delivery guys too, and the others are in the office. My ideal customer is a customer who is sensitive about their health, who are health conscious, and they don't want to eat junk. So that is my ideal customer. Another ideal customer of mine is a person who has life issues, sickness like cancer, like diabetes. We take care of those. We address that kind of group And we are happy that the people are responding well. Nowadays, so many people are coming out of eating junk, they are eating healthy. And that's what I do for now. I bank with Stanbic in the business accounts, and then I have also cooperative bank. But my experience with the Stanbic has been a bit challenging because when I really wanted them to hold me, they were not able to hold me. When I started to walk and I wanted to get out of my house, I was not able to. Reason being, my financial, statements could not allow me to take a loan. But then I was growing. They were not looking at the growth. They were looking at what I was doing or whatever income was coming in. So after I was not able to get from them, lucky enough I was adopted by KIE. They gave me a loan, which made me to move out of my house and set an office, a proper office, and get employees for that. So I didn't have a good experience when I was starting with the Stanbic. Whereas cooperative, I went there when I was a bit stable. So I've only had soft loans from them. But Stanbic, I was not even able to get a soft loan from them. I didn't get anything, but I still bank with them. First of all, I had a challenge with the government also. I thought that when I have a company registered, I'll just work there, they'll look at my statements and give me money in regard with what I was showing them. But I was not able to get, especially the women fund, because I needed to be in a chama. I was not in a chama because I was an employee and I was just coming out as an entrepreneur. So I missed out on that. The second thing that I wanted to do was, I wanted to grow and I wanted someone to hold my hand, which I was not able to get very fast. So I needed to have a security somewhere for them to assess me alone. If I was just an ordinary person, maybe I couldn't have been able to get that loan. Just a normal woman in the village, because I wouldn't have a security to offer. Maybe it's only my husband who had the logbook or who had the title deed. So out of that, I thought maybe many people can miss out on that, especially the women. Lucky enough, I had a title deed, which I offered as a security for KIE, and they gave me a loan. I thank God for that, and I was able to repay very fast. The secret of paying a loan, you pay it fast, so you pay less. I have a range of products. As you see, my name is Broad Range. So we have a range starting from sesame. We have sesame bars, candies. We use sugar. But there are those who are sick and they don't want to use sugar. We just roast and give them like that. Then we have sesame butter. Not so many people know about this, and it's very nutritious. Then we have fried peanuts. We put fresh ginger, fresh garlic, turmeric, red pepper, gram flour, and then we deep fry. Then this roasted, this is roasted cashew. We roast and we have them in different packaging. The small packaging, the big packaging, the jars. Then out of this also, we have cashew nut butter. We make cashew nut butter out of the cashews. Then we have roasted peanuts, where we roast and also turn it to butter. You can see this is peanut butter. And then we have almonds. This is not grown in Kenya, but people who have cancer and have health issues ask about it, and therefore I started making, because when you are doing a business, you don't do it for yourself, we do it for others. So when they started asking, I roast, and then I crush and package like that. Media handles are Broad Range in everything. Facebook, Instagram, you will find us with Broad Range.
Okay, good afternoon and welcome to our next session. My name is Tiriongo Samuel, the Director of Research at Kenya Bankers Association. It's a great pleasure to host you today. Again, we will not stop apologizing for the delayed start of the day. Now we would wish to transition to research papers that have been prepared by our authors. We recognize the effort that the authors have put in putting together the papers that we will listen to. today and give feedback. So we'll go straight into our first presentation in the interest of time. At least one paper before we break for lunch, and then resume shortly after lunch to just make sure that we are back to our program as scheduled. So our first paper this afternoon, but before we go into the first paper, allow me to recognize the presence of Professor Mudida, the Director of Research at Central Bank of Kenya, who joined us. I think he's just excused himself, but even as he leaves, we want to recognize his presence. We do not take it for granted, the collaboration that we have with the Central Bank of Kenya, and look forward to more of this collaboration. So we also want to recognize the Director of Research at Tanzania Bankers Association. I think earlier we recognized the CEO, and now we want to recognize the presence of Tanzania Bankers Association Director of Research, Mr. Dan Tandasi, who's traveled all the way to be with us during this session. So our first paper today, brought to us by Dr. Rogers Ochenge from Kenyatta and Strathmore University, is on MSME partial credit guarantees in Kenya, what 28,000 loans reveal about risk and pricing. So again, it ties back to the theme. Even the discussions earlier in the morning session was about establishment of a credit guarantee company. And we have a number of papers lined up for us to talk about credit guarantees and how these have implications on financing of our MSMEs. So the paper will be discussed by Dr. Radha Upadhyaya from the Institute of Development Studies, University of Nairobi. And allow me to invite Rogers to make a presentation, and he has agreed that the presentation will be brief enough to fit the time allocated, but elaborate enough to convey the messages that are coming out of that paper. So Rogers, please.
T-Face, Obara.
Okay, thank you, Dr. Tiriongo, and everybody who has made time to be here for the presentation. I almost called my friends, we take a photo at that, or we take after that. Okay, so in the interest of time, so my name is Rogers Ochenge. I'm from Kenyatta University and also associated to Strathmore University. I'm here to kickstart a debate on an interesting, but quite not really new, but an interest angle to supporting MSME financing. So let me begin by quite an observation that has been made quite for some time now about the importance of SMEs, and I don't think I need to spend a lot of time. In the morning, I think one of the speakers mentioned that 98% of our firms are SMEs, so I really do not need to spend time here motivating the importance of SME. But also, this is from the World Bank Enterprise Survey 2018, access to credit comes as a key, in fact, second key constraint of firms in Kenya. And so once again motivating why we should be interested in SME access to finance. So, SMEs have a few characteristics that are of interest to this study. One, of course, is the insufficient collateral, the high risk of default that they are exposed that characterize this sector. Of course, high transactional cost, and more importantly, the asymmetric information. What is the outcome of this is that, of course, limited access to finance, and we have seen that in the World Bank survey. They will be generally rationed, they will be charged high interest rate, and they may not have access to long-term financing. So the outcome of, the result of this is that we end up with an underdeveloped SME financing market. And this might require some intervention because we have some form of market failure here. So how does then a credit guarantee scheme works? I know because most of us here from the financial industry, we probably know, but just so that we are on the same page on what is our working definition. So in that picture you are seeing there, on one hand we have SMEs, and on the other hand we have banks. In between, you see hurdles which SMEs must jump to get to the other side to get help. And down there, then we have a third party, that's a credit guarantee scheme, which unlocks these hurdles and allows SMEs to access credit. And so the credit guarantee scheme comes and says, I know, and says to the bank, I know you may not lend to this SME, but can I guarantee that in case she defaults, I will be able to cover part of the loan. So, and hence the idea of partial credit guarantee schemes. So there is debate about these programs or these schemes. Globally, the evidence seems to be mixed. On one hand, there seems to be consensus that these partial credit guarantee schemes can reduce risk and can also expand lending. However, what is not clear is what's the impact in terms of pricing? Does the credit, the expectation is that the credit guarantee schemes should be able to lower interest rates to this, so that these SMEs can borrow at a lower rate than if the schemes did not exist. How does this guarantee scheme perform across sectors? That also is not conclusive. But also, there is an observation that if these credit schemes are not well designed, then they can fail. So, in the context of Kenya, we wish to understand whether high impact yet underserved sectors are benefiting from these credit guarantee schemes. Are borrowing costs meaningfully reduced? How do guarantees interact with collateral? Those are some of the key questions. So let me move to, therefore, the key guiding questions for this study. So one, we expect hypothetically that credit guarantee schemes should lower default rates. So the fact itself, for example, that an SME knows that he has an arrangement and he would want to work hard so that he doesn't default and lose that opportunity of, again, because this is a repeat game. So is that the case? Does the data indicate, does it agree with that? Number two, do these partial credit guarantees lower interest rates for MSMEs? Thirdly, are guarantees and collateral substitutes or complements in lender pricing? And then lastly, just a few observations on comparing the Kenyan guarantee scheme with international best practices. So let me quickly just go through the literature that anchors this study. So it's credit rationing. So even profitable MSMEs might be denied loans because of information asymmetry. Banks don't know, they can't perfectly assess these firms. Particularly or specifically, banks struggle to distinguish safe from risky borrowers. That's best known as adverse selection. But they also worry that after the loan has been granted, repayment might not occur, and that's the idea of moral hazard. The result of these information problems is credit rationing, not because banks do not have funds to give these firms, but simply the risk cannot be priced efficiently. So how does these credit guarantee schemes help? Of course, they share credit risk with banks. So by covering part of the potential losses that could arise, these schemes are able to reduce the downside risk and therefore encourage banks to serve borrowers that would have easily not been served. Guarantees also improve credit worthiness because if the SME was to come with the assets and the income that they command, they may not be able to get the loans, but now there is a third party standing ready to offer something that is pledgeable. So this reduces the agency problem that banks would have, and so this allows banks to extend credit confidently to the SMEs. So we achieve two things by these schemes. One, of course, financial inclusion, because we have additionality of loans. We have more SMEs coming into the loop. Interestingly, that also means that now banks are not just lending to a few borrowers, because that can increase systemic risk. They have a diversified loan book. That in itself is good for stability from a systemic, from a macro perspective. What does empirical evidence? Empirical evidence does indicate that indeed countries that have well-designed PCGs see higher loan volumes. It has also been found that guarantees can actually reduce defaults especially looking at the evidence coming from Latin America. Some few things concerning this is taking into account sectoral risk differences. For example, we know sectors such as agriculture, community and social enterprises, because of the volatility of income and also you know, the higher default rates that are likely to, their risk profiles are quite different, and therefore in designing the credit schemes, this needs to be well taken into account. So yes, guarantees expand finance. This is the kind of what the literature is saying, but effectiveness depends largely on the design of these schemes. So our first question is whether, one of our research questions is the impact of guarantees on loan pricing and borrowing costs. What does theory predict? Guarantees reduce loan losses, and because of that, lower risk should mean lower capital provisioning. I know one of the debates or one of the key things is, if I'm a bank, I'm loaning out to these risky clients or SMEs, but then there is a guarantee, then I should get capital relief, okay? So this is what theoretically we should expect, and therefore, in principle, therefore, this benefit should be passed to the borrower. Is that true in the data? That's one thing that we'll try to respond to that. The literature indicates that in some cases, actually, banks keep most of the benefit, passing little to borrowers. And therefore, we see persistently high interest rates, even to these MSMEs. So we have a chance again to get some fresh evidence from the data that I'm going to share. So for the sake of time, let me quickly go to the data set, and then how I tackle these research questions. So I got access to some data sets. I'm not going to mention the guarantee scheme of about 28,356 loans that have been guaranteed for the last 10 or so years, since 2013 to 2024. So the data that I got access to is what amount was loaned, the sector classification, the interest rate that was charged, the collateral status. Was this loan collateralized or not? Then the guarantee coverage ratio, and then whether the loan defaulted or has defaulted at any time since its inception. So it's a rich microdata, but I just want to mention one caveat, even as we interpret the results that I'm going to show. It would really be interesting to see if we have comparable loans that are not guaranteed. This is something we do not have advantage to, and so we are cautious in terms of the results that we get. Nevertheless, we can gain some insights from the data set, from this rich data set. So we have all those variables, and so the first question is, do these PCGs lower default rates? So we have the default rate as our dependent variable, and other control variables, plus the coverage ratio collateral, sector, loan type. So from this, we can learn two key things. One, which sectors actually default most, and then two, does the coverage ratio influence defaults? So that's the first key. Because I know we have researchers here, because the default rate is a ratio between 0 and 1, so it's bounded, so we use what we call a fractional logit to run our estimation. The result of that, before I go to the results, some stylized fact to appreciate what we learn from this data. Number one, there has been, especially since 2020, you can see a spike in terms of the guarantee coverage. That's one. Then two, we also see that the wholesale sector has almost half the loans that have been given out so far. Number two, agriculture and community services emerges as two sectors that are highly covered under this scheme, but also that have relatively high default rates. And so what do we make out of this? One is that indeed this particular program is covering sectors that are highly risky, which is a good thing. Now, we also see quite heterogeneity in terms of sectors dispersion and also in loan pricing. We see some sectors, some loans that are issued at interest rates above 35%. But we see even within one sector, loans are issued at very different interest rates. So that's just one stylized fact from this. Yes, guarantees might increase credit volumes, but they do not impact loan rates or borrowing costs at, there is wide disparity in terms of this. And could it be that the banks have not really integrated this scheme into the pricing framework? Maybe just an open question. The same thing happens to the loan facilities. So from the data set, there are many, like when an SME is taking a loan, what are you taking that loan for? Is it for working capital? Is it for asset finance? And all? Is it trade finance? And so on. And we also see the heterogeneity. So for example, the term loans get the highest interest rates, which is not really surprising. But we also see there are sectors that are covered even up to 90% on average, like trade finance. Collateralized, sorry. 90% of those loans for trade finance are collateralized. Again, another open questions. Because if you look at their default is low, could this be a case of over-collateralization? Again, another open question. Anyway, so what determines default in this sample of guaranteed loans? Number one, those sectors are against agriculture. So for example, community defaults more than even agriculture. But the other sectors are less risky than agriculture. So the base sector is agriculture. But then of interest here is the coverage ratio. So the coverage ratio indeed does reduce default. This is across the loans. This is a cross-sectional model. And then also collateral also reduce default, which again is pretty standard. So the key message from this is that indeed, yes, to the answer to our research question, yes, they do, guarantees do reduce default rates. Now, what about the second research question is about borrowing costs. So we have interest rates against, interest rate is the dependent variable, and those variables you are seeing there, default rate, coverage ratio, collateral, and then sectors indicate. So what we have here is just the marginal effects. So for example, default rates is quite strong, which means this is loans are well priced. If you are likely to default, you are given a higher rate, and coverage ratio reduces, guarantees reduce borrowing cost, although not as strong as default rate or collateral. But then of interest is the last row, an interaction of coverage and collateral. And the message from that estimation is that guarantees and collateral act as substitutes, which means if already a loan is collateralized, the guarantee has little impact in lowering interest rate. That's the key message from that regression. So guarantees and collateral act as substitutes. Now, what would be the ideal situation? The ideal situation would be that if a loan is collateralized and again it is guaranteed, that should reinforce each other and get a lower rate. This is not what we see, at least in the data set and the specification that we use. Now, the last research objective was trying to, now we know that Kenya National Treasury recently introduced a public scheme, the Credit Guarantee Scheme. It was launched in December 2020 and was piloted with about 7 partner banks. And by December 2023, about 4,000 loans had been issued worth 6.18 billion. And 71% were new SMEs that had not at least borrowed from the bank. So this is really quite encouraging. But the lending is still concentrated on trade sectors. Now, of course, currently the scheme is housed in Treasury. I'll make a few comments on that. So, away from the public, there are a few other credit guarantee schemes. We have African Guarantee Fund, we have Propaco, we have DFC, we have a few other that this is not exhaustive, but that is just to be aware that there are still other schemes. So, what we found from international best practice, I'm going to make a few observations. One relates to governance. Who should be a credit guarantee scheme? Should be an independent legal entity, should transparently indicate the funding, because if you are going to guarantee, that means you have funds to pay off to the banks if the SMEs cannot pay. So there should also be clear supervisory interface. So examples of some best practices, we have one from Korea. Korea have a public credit guarantee scheme, which is independent, which is an independent institution. It has clearly set solvency safeguards. It has differentiated coverage ratio. So, in fact, beginning 70 to 85, I was seeing, in fact, I was reading the Kenya National Treasury had as low as 25%. We have another good case from Morocco that is a dedicated public financial institution, higher ratios for women and micro farms. So what can we learn? What lesson do we learn from here? Perhaps convert the public SGS into an independent entity and then have formally the central bank oversight, because they have advantage given the oversight the other financial system. Number 2 is product design. That's another key design issue about these credit guarantees. Having differentiated coverage ratios, I've mentioned about that. High coverage plus structured allocation. So for example, you will see, in fact, the data that we used had an average of 50% coverage. So that means the SME goes to the bank and this guarantee scheme says we will pay 50% of the defaulted amount, and the bank will bear the 50%. Now, that is also a design issue. Maybe we should have a menu of different ratios. So, also, what are the fees? If I'm a bank and I'm going to receive this credit guarantee, the fees, are they risk-based? And then also ensure contractual pass-throughs so borrowers benefit from lower cost. So, what should separate one best bank from the other? A bank, and I'm going to talk about one example of Chile that Chile has. But here, how do we ensure that the benefits of these schemes are passed to the borrowers? There has to be some incentive mechanism to do that. Then allocation mechanism. This was quite interesting. So, which banks should be supported under this scheme? To avoid rent seeking, there should perhaps be an auction. This is what the FOGAPE, which is the credit guarantee scheme in Chile, does. So banks submit bids. So a bank says, I want to participate in this scheme, and this is the coverage ratio I would like. Maybe just cover 20% of this, or cover 60%, and then banks can compete on that. So that's one lesson that maybe we can pilot the auction-based and also performance-linked allocation. So in conclusion, sorry I have taken a little bit longer. I had so many things to say. Hours are the ones that are few. And so we analyzed 28,000 MSME loans under the Kenya's PSG program, and we examined sectoral risk and loan defaults, the impact of guarantees on borrowing cost, and then benchmarked against international practice. So, what are the key findings? So if we can summarize: one, the sectoral heterogeneity in risk. For example, agriculture community have the highest default rates. Manufacturing, electricity happen to have the lowest default rates. We also observed that both collateral and guarantees reduce risk, although collateral is still stronger in this. Number two, borrowing costs shaped by loan structure, not so much about the guarantee scheme. So there are structural issues still perhaps that we need to solve so that we allow the guarantee scheme also to have an impact on borrowing costs. And then we also have highlighted the design gaps that we can learn from global best practice. So in terms of policy recommendations, a risk-based guarantees design, differentiate coverage ratios across sectors, higher protection for higher risk, high impact segments, and then also improve pass-through to the MSMEs, introduce pricing benchmarks, let banks show that they can, the best banks that pass through the benefits to credit to SMEs are the ones that are benefiting from the scheme. Then of course I've talked about the institutional reforms, the competitive allocation, that's the auction-based, the independency of this to also ensure there is going to be fiscal stability. Thank you so much. In conclusion, Kenya's PCGs expand MSME finance, but there is still a lot of potential that remains underutilized, and also trying to align the schemes to with global best practice. This will give us will bring about stronger financial inclusion, SME growth, and support for Vision 2030. Thank you.
Thank you. So I quickly invite Radha to give her discussion of this paper. Then we'll open it up for Q&A. Radha, please know that you're sitting between us and lunch.
So good afternoon, everyone. Yeah, thank you. I'll try to keep my comments quite brief. My name is Radha Upadhyaya. I'm from the Institute for Development Studies, University of Nairobi. And I want to thank the KBA for always hosting such an interesting seminar. And Daktari and I, even 2 years ago, I commented on his papers. So I always very much enjoy reading his work. I don't know if my comments can be... Okay, so whilst I'm waiting for the slides to load, I just want to say I can start with the initial, what I was saying, my first few slides. So first I want to say that I really appreciated this paper because it actually really highlights a key challenge. Today's whole day, but as the governor said this morning, we have high financial inclusion, but poor financial health, and we have not cracked the nut of lending to MSMEs. So all these papers, around this are really trying to tackle a problem that's very pertinent in Kenya, and I really appreciate the Kenya Bankers Association and the authors for doing it. And also to whoever shared the data with my colleague, I really want to thank that. It's very relevant. The data is real world data. So it's not just a model, and I really want to appreciate whoever the financiers who shared it. Sorry, there seems to be an echo, I hope. My main comments, which I'll go in detail, are around the theoretical and conceptual frameworks. So as Mwalimu explained, the main idea is, do these partial guarantee schemes achieve an intended impact? But I feel that it really needs to be more of a development of the theoretical and conceptual framework and kind of a theory of change of how you think the impact should be. And then when I go into the conclusions, I must say the findings are not unexpected. And whilst Mwalimu focuses on the comparative study in institutional design, I feel that this necessarily may not be the answer. Quickly, again, the title refers to pricing and risks, but the main issue that was discussed is defaults and borrowing costs. So I think this again ties down to my need to really focus in onto a theoretical framework. So once your research design is very clear, the independent and dependent variables are clearer, it will automatically kind of make the paper flow better and have a bit more kind of idea of like what is the key reasons why these partial guarantee schemes have not led to reduction in borrowing costs for the borrower. I feel that the theoretical framework needed a bit more development. When you read the paper, which is well written, there's a focus on things like information asymmetry. I'd like to contend that partial guarantee schemes do not reduce information asymmetry. The reason we need them is because banks have not been able to reduce the information asymmetry. So when you say that these are the channels, we really need a careful thought on what we see as the channels through which partial guarantee schemes can have different impacts. And when the dependent variable is access or defaults or borrowing costs, each has a distinct, maybe differentiating, mediating variables. And then that sort of conceptual framework then needs to be used to justify the model. Whilst I'm not saying that the fractional logic model is wrong, we can't just say you're using it because this data is between 0 and 1. Yeah? You need to have a theoretical reason why you're using that model. And for the borrowing costs as well, so it's not clear to me why no macro factors were included in the fractional logic model. And I'm not saying it's right or wrong, but I think it's like if it came from the theory, it would make more sense. And also, in the OLS model, I'm also not 100% clear how endogeneity is dealt with, because you have things like interest rate as independent variables. So there needs to be some sort of better explanation of that. And particularly in both the theoretical framework and the writing, there needs to be a discussion that this paper is looking at impact kind of on two sides. On the demand side, so banks don't want defaults, so it's trying to answer that question. And sorry, that's the supply side. And then on the demand side, borrowers want lower costs. So often these two sides get kind of confused when we're thinking of this kind of whole impact of partial guarantee schemes. So, and there needs to be a clear link of how the Kenyan context and the institutional design of the Kenyan context is taken into and shapes the model. The literature review, I know this is a new area, but I feel it needed a bit more depth, even the papers that were discussed. For example, one of the papers cited, similar to Kenya, has very limited pass-through of the partial guarantee schemes to borrowing costs. And this paper, according to the author, the reason is guarantee fees, administrative cost, and sector risk perceptions. But then we kind of make this jump to institutional design. So I feel, again, coming back, if we have these conceptual frameworks correct, and then we see, when we say institutional design, are we still talking about guarantee fees? It's a bit unclear. So in the Kenyan context, there's also limited pass-through, and then we say that's because of institutional design. But this jump of why, guarantee fees or administrative costs, there's some may or may not be part of this design, is very important. And so I feel there needed to be explicitly a more, in the literature, a discussion of what is institutional design. I personally feel there's a big problem with calling anything international best practice. Yeah? There's nothing international that's best practice. Any kind of global standard, if we adapt it to Kenya, we need to see what is relevant for our context. So the literature review also has kind of completely ignored some of the political economy factors shaping partial guarantee schemes, and I think we need to move beyond some of these kind of institutional design as this sort of holistic thing, but also try to say what are the Kenya-specific factors. Again, this may not be possible to do in every paper, but we need to highlight it and keep it in mind. There are macro factors like high government borrowing, which constrain lending dynamics. We need to at least highlight the importance of that. And then micro factors. Who monitors the monitor? I've done some other work on patient finance, which is long-term understanding finance, and this is tangential, but in that paper we showed that when banks get lines of credits from DFIs do not monitor the banks. They just assume that the banks are doing the right thing. So similar to this, it's like there's, this oversight gap, this idea that we just have this transparent institution kind of hides the really detail that we need to go into of the context-specific macro, micro, and other political economy factors, which mean that the partial guarantee schemes have at least not led to the effect that we were expecting. Some comments on the data. Again, kudos to Mwalimu for accessing this data, convincing people to give it. I know data is not easy to find, but there was like almost 20% of the data set was removed due to missing and inconsistent values, and that's not insignificant. Like that really needs to be explained. There's quite a lot of descriptive statistics in the paper, which is really nice, but I feel there needs to be a bit more discussion, particularly of figure 1. There's some parts, like there's a fourth figure on default rates, which I just don't understand that. And then there's a discussion on the lending landscape and the partial guarantee landscape. I felt that that should come like at a preceding level. So then that landscape influences how you design the conceptual and theoretical framework. On the default model, again, I'm a bit, again with data, it's a bit hard. There's a 0.2% reduction in default. Now, whilst this is statistically significant, I don't feel it's economically significant at all. And we all know how much government, private sector, FSD Kenya, Treasury time has gone in designing these schemes as a solution to the lack of access to SMEs. So the author himself says, this would help with higher volume lending. I don't think this is high volume lending. So before we interpret this as a very positive outcome, we need to be really careful by saying, actually, no, default rates, 0.2% reduction, that's not great. Why? Yeah. And on borrowing costs, I feel actually there should be a bit more clarity of what was the expected hypothesis for each of the independent variables. And I feel there needs to be more robustness checks, because the standard errors are quite small. And I feel a lot of the correlation is presented sometimes more in a causal way, but just to highlight that this is correlation. This is not an experiment. Mwalimu himself said we haven't compared this to where there were no guarantees, so we just need to be careful about what we write. Now, comments on the findings, and this is why I love KBA conferences, because it's the bankers here and people are not scared to tell the bankers what they think and what the challenges are, and bankers are prepared to listen to them. So the outcome is not unsurprising. Collateral is still king, and banks show limited pass-through to lower costs. So to add to this, we need a bit more explanation of why these patterns persist. Yeah? And I would suggest that maybe you need to complement these quantitative results with some qualitative results for interviewing both the bankers and the borrowers. So my final remarks, thank you again to KBA for ensuring that papers like this are presented in this seminar. It's a very timely analysis. There needs to be more of a very clear theory of change, theoretical framework, clearly explaining the two models. I think we need a bit more discussion of what is institutional setting. So the institutional setting is the key explanatory factor that's been given to explain the low transmission, but it's too general, like independent, transparent, have an auction. I think some of those things are too, again, a bit too borrowed from other contexts and other countries, but don't necessarily explain why we've had limited pass-through and lower borrowing costs. And one of the suggestions is to complement it with qualitative insights. I think it'd be really interesting to extend this analysis to see that the firms that got these credit guarantees, how it affected their performance, so firm borrower performance. And in terms of policy implications, again, I feel this is a suggestion for every KBA paper that I have every year. Instead of saying, these are my policy suggestions, say, these are the policy suggestions for banks. Like today, if there's a banker here who's working on the partial guarantee schemes for their particular bank, what can they do? What is the suggestion for the regulator, the suggestion for a market actor like KBA? So I think policy suggestions need to be more specific and from the actual data. But again, thank you very much to this paper. I really enjoyed reading it, very rich analysis. Thank you.
Thank you, Radha, for a very comprehensive discussion. I want to request something in the interest of time, and I think we've also been requested by the hotel that we proceed for lunch. Now that we have another paper on credit guarantees coming up in the afternoon, we would want that also to be presented, and then all comments can be given at the same time and directed to whichever paper that you deem you want to comment. So I beg your indulgence again that we proceed for lunch, and then when we have received the next paper on credit guarantee and MSME financing later in the afternoon, then we can actually give comments for that one and also for this one. Secondly, there will be a small change in the program, again in the interest of what is emerging, the pricing concerns. I know even the governor emphasized this morning around the new innovation in pricing. So the KBA internal paper that would have been presented today initially in the program at 2 p.m., we are considering to do a sort of presentation just to highlight what are the building blocks to the new pricing model, with one very basic reason. The 100 of us that are seated here today can quickly be our ambassadors as we go out there if we develop an understanding on the pricing framework that is coming. So soon after lunch, we will have a session on the risk-based credit pricing, and then we again revisit the paper on credit guarantees and then generate comments together for this paper and that other paper. So I wish as well as we proceed for lunch, and then it is, what's the time now? I'm looking for 1:27. So could we come back by 2:20, 20 minutes past 2, And then we start off from there, and then in the hope of picking and getting to our program as scheduled. Lunch will be served on the third floor, Acacia Restaurant. And all of us, as we exit the room and go up to third floor, will be given meal cards so that then we can enjoy our lunch. So enjoy your lunch and see you at 2:30 for us to resume the rest of the program. But look forward to very exciting session in the afternoon. Enjoy your lunch. Thank you.
Dr. B on these, ladies and gentlemen.
Okay, so we welcome back to our session. As promised earlier in the day, we would now want to focus on the new framework of pricing that was recently announced by the central bank, which was effective from 1st of September. And we thought we needed to take advantage of this opportunity, at least to paint some picture that we can all understand where we are and where we are going, and then act as ambassadors even as we go to our respective institutions, as we sensitize other teams. We've been able to engage a number of teams around this. Credit teams, we have also engaged last week with, not last week, earlier this week at Kenya School of Monetary Studies with credit risk compliance, some legal teams for purposes of just aligning on this. So I want to take you through this presentation. It's a two-part presentation. So I'll provide some highlights of the initial thoughts from a policy standpoint, and then our colleague Andrew Njeru would now be able to also provide a lot of detail, really from the standpoint of what does it mean for pricing. So from the onset, the engagements around benchmark prices, and I think our chairman did allude this morning that there were concerns around each bank using their own base rate, differentiated base rate, which is determined within each bank. So you can imagine an industry with 40 plus different benchmarks, or at least different, defined differently. Even for customers, it's not easy to compare rates from one bank to another. So as we considered this, and of course, the journey around pricing started all the way from pre-capping period. And of course, even the National Assembly felt that prices were too high and capped interest rates in 2016. And then we all know the consequences of interest rate capping is that it reduced lending to the segments of the economy that were considered to be perceived to be risky. So essentially, because at the time, I think the central bank rate was around 10%, and National Assembly said it's going to be the policy rate plus 4. So no lending rate would go beyond 14. So what that meant is that if my risk would place me at a rate above 14, technically I would be denied credit. And we saw a slump in credit from double-digit growth rates to single-digit growth rate, because a whole segment of the borrowers that could not be priced within the range of 14 and below could not access credit. And that is what led to the repeal of the interest rate capping in 2019. And then after that, the banking industry went into what is called a banking sector charter, which is actually anchored on 4 pillars. One of the pillars is customer centricity. Another one is the adoption of ethical practices in lending. And another one is transparency and accountability. And then the final one is risk-based credit pricing. So with risk-based credit pricing, each bank was asked to prepare their own risk-based credit pricing model and then seek concurrence with the central bank. In seeking concurrence, of course, the discussions were around justify why this base rate, justify why this premium, and even to some extent have a sense of under what conditions should you go beyond a certain rate. So we again had differentiated risk-based pricing models across banks. The rates were, the models were, I think virtually all banks received approvals for those models to be implemented. But then they all carried different base rate, because typically a lending rate would have two components, broadly, a base rate and then a premium that is added to the base rate. So we take the base rate to say, to mean a risk-free rate, and then the other component that is added then becomes the premium, the risk premium. The base rate can also mean a reflection, an average reflection of the cost of funds in the banking sector. So the focus and concern at the time was, how do we enhance monetary policy transmission? Because the models did not necessarily reflect the monetary policy rate, which is a central bank rate. Many of them were cost-driven because of the cost of operation of a bank would then define the extent to which they would, where they would place their base rate. Okay, so because of the lack of linkage with the monetary policy rate, there were concerns whenever the central bank would adjust the rate. We were not seeing a commensurate adjustment in the lending rate in the market, because ideally the models that were under practice were not necessarily anchored on the central bank rate. So there were concerns on the side of monetary policy rate, and I'm sure you've heard even the emphasis from the governor this morning that our main headache, the central bank's headache, was how do we make sure that there is transmission of monetary policy? And again, of course, banks have been blamed from one time to another that central bank has moved the rate, but you have not moved your rate. So on one side, CBK, on the other side, banks, on the other side, customers also asking questions around how do we know where the rates would be? Because with predictability, then customers can actually plan ahead much more effectively. And even agents in the economy would also be well aligned. Then there was also need to do enhanced transparency in the sense of, do customers actually know what drives their lending rates? Then do policymakers fully know what drives lending rates from a data standpoint in terms of can we associate a certain lending rate to a particular cost that can actually be addressed? Because when policymakers understand, then even mitigative action can actually be suggested or taken. Then, of course, there was need to adoption of a unified base rate became apparent that we needed to go to that direction. And of course, the reason is because if you have differentiated base rates, how would customers compare rates across banks in terms of their understanding? Remember, one of the other pillars of the banking sector charter was customer centricity. So for us to entrench customer centricity, there is need for customers to really also understand if everything we do is centered on customers, then they need to know what's going on in the banking sector. So that became the motivation of how best do we explain, can we get a unified base rate? Because it's also tied and linked to global practices, particularly in advanced markets. You find that they always have a reference rate that is uniform. And that makes it much easier then for even banks to explain out the costs that why lending rates would be at the positions that they are. It would also be important for us to understand the computation of the new unified base rate, its application, and then the timelines that have been given for transition in this space. So from a monetary policy standpoint, concerns around CBK's interest was to see policy decisions transmitted through the market. And of course, banks then would not be blamed whenever there is a movement in the central bank rate and it's transmitted fully onto the lending rate. It's much easier to explain to customers. And of course, the public would be able to really appreciate the drivers of the cost of lending, and generally economic actors would act according, because then they can anticipate and say, we've seen the central bank rate move in this manner, so we expect lending rates to move in this manner, and therefore then it actually creates very strong expectations around for the economic actors, and of course they would be aligned accordingly. Now, I just wanted to explain what the governor did mention in I hope it's visible to all of us. What we have there are 3 lines there. The red line is the central bank overnight rate. The gray bar, the gray shaded area, is what's called the interbank window. So from August 2023, the central bank adopted what the governor described as a journey towards inflation targeting. But then what that meant is that now they would target a particular interest rate. So they would target to make sure that the central bank rate adjustments are transmitted to the market. How would that be? The choice of the interbank rate is usually standard practice, even in advanced markets, that the very short-term rates, because the interbank rate is the rate at which banks lend to each other on an overnight basis. So if today banks collect checks from different institutions, and a bank can view that out of the checks that we've collected to pay, we are unable to service them, then they would go to the interbank market and borrow and then repay the following day. So it's a wholesale funding market, and you take it like, for instance, you have a wholesale market, and now you need to do retail. You go retail market. So from the wholesale market, it's a general reflection of the cost of funds. So from August 2023, there was a corridor that was created around the central bank rate, 2.5% plus and minus the central bank rate, that the central bank would endeavor by all means to ensure that the interbank oscillates within that range, remains within that range. Now, there is the action that the central bank has to take to make sure that the interbank remains within that action. It means that when there is an attempt for the interbank to go outside that rate, say for instance by going you're able to see the periods when the interbank rate was way up towards the upper limit of that particular corridor, it sends a message that there is pressure in the market because rates are going up, so there is liquidity pressure. So at that point, then the central bank would actually invite banks to bid for money, and then there would be, and in that process, then the central bank would be able to inject money into the banking sector, and that causes then the interbank to slowly ease, because there is it's a market of it is a balance of supply and demand. So as it eases off, it's easing off towards the central bank rate. The reverse would also happen, that when the interbank rate is going way below, like towards the upper limits of that corridor, then that means towards the lower limit of that corridor, it means there is too much money in the system, and therefore its price is actually going down over time. So as a result, then for you to align the interbank to the central bank rate, you need to withdraw part of the money from the liquidity. Now, there was a commitment on the side of the central bank that will endeavor to make sure that the interbank rate is aligned, oscillating very much closely around the central bank rate, so that for any adjustment now on the central bank rate, it is mirrored on the interbank rate, and therefore you have actually enabled the transmission of policy, because the central bank rate reflects where the policy is, and the interbank rate is a market outcome. So by influencing the market to such an extent as to cause the interbank rate to oscillate around the central bank rate, they have triggered the transmission. And because of that improvement, you can see that the pink line is getting closer and closer towards the central bank rate. That means there is even much more improved refinements on the side of the central bank in ensuring that the interbank has actually oscillated much more closer to the central bank rate. And as a result, the central bank in June 2024, last year, actually even narrowed that corridor further because there was no point of keeping it wider and wider. It even narrowed it to 150 basis points, 1.5% on either side. And even much more closely, recently it actually narrowed it even to plus or minus to 0.75. So there is improvements in the extent to which interbank rate depicts what the central bank rate is actually showing, so that as policymakers take that decision, then we actually see it one-to-one being reflected on the interbank rate. So from the transmission side, that part is sorted in terms of interbank rate. So the focus now was to look at how do we create a base rate around this rate that has been linked to the central bank rate. And that's why there was a suggestion then of we go and tap on the interbank rate that is now linked to the central bank rate. So that's exactly what happened. So it was now just a matter of agreeing on how is it computed. Initially, we had the suggestion that we can do 2-month average of the interbank rate, but finally, because of that would be backward looking, what was agreed was now we can do a compounding, like each day, because as I mentioned, the central bank, the interbank rate is generated every day. And that interbank rate that's generated every day is what is now called the Kesonia rate for the day. Now, it would mean that that rate is an annual rate. If you see a 10%, if you see a 12% on that rate, it means that 12% is an annual rate. So you need, because the loan matures on the following day, you need to prorate it and actually have what matures on the following day well prorated. So it's take the interbank average for the day that central bank used to publish every day as now the Kesonia for that day. Kesonia stands for Kenya shilling overnight interbank average. So it's just a renaming to coincide with global, the naming of the global, the benchmarks like the SONIA for the UK, the SOFA for the US. So all that is actually governed by global risk-free rate practices that are known for benchmarks, establishing benchmarks. So, so besides that, there was also the element, as I mentioned, of transparency, which is actually attached, linked to the pillars that we had. And then the reason why Kesonia came into being is that we needed to avoid differentiated rates across the industry. And as we avoid differentiated rates, we are adopting one unified rate that would be easier for to be understood in the market, and therefore even customers can compare across. And then the other benefit, as we have seen, it's linked to the central bank rate. So it assures us on the side of transmission. Then the interbank market, of course I've mentioned about now that the interbank rate is tied to the central bank rate, that's why the consideration was around you can alternatively use the central bank rate as a benchmark for your facilities. Where it is not practical to use the interbank, you can use the central bank rate. So Kesonia, in terms of computation, for the lending rate now, lending rate would be now that unified base rate, which is now called Kesonia. So no bank has has influence on that because it's an outcome of trading that happens across all the banks, which may actually involve even up to 20 transactions. And sometimes it goes all the way to 60 billion a day is traded from one bank to another. Now the average for that day becomes the Kesonia, and then there's a premium K. Now that premium, that is where the focus is, because Kesonia will be published by CBK. So for all banks, you pick a Kesonia that has been published, but a bank would then be, there would be need, the pricing model for a bank now would actually be pricing the premium K, because that's where it brings the whole differentiation that we'd want to see. And that premium K would include a credit risk. Now the customer's risk positioning. The chairman this morning did mention about the transition that we are having, and now that the customer has an ability to understand what drives their cost, and therefore they can actually take measures to influence how much the lending rate they get from the banking sector. The Kesonia also reflects one-day trading. What happens to money that is issued for 5 years, for 10 years? So then there is an element of term risk because there is a time value for money. There is also inflation that actually eats into money as we look at over longer horizons. So then there is a term risk that needs to be loaded on that Kesonia. Then there can also be the cost of operation related to lending. Now, in the cost of lending, banks would incur costs definitely in terms of assessment of customer negotiations and things like that. And then, of course, even salaries that are tied to the credit officers, the systems that have been deployed for lending. And beyond that also, banking is a business enterprise. So there is a shareholder behind banking that is expecting a return. So there is a modest return that would be expected by shareholders given out of the investment that they have made. So that's the lending rate. But there is something called the total cost of credit that now you look at other costs, the fees and charges, and these fees could be origination fees like legal fees, insurance fees, valuation fees, okay, negotiation fees, commitment fees, of course, all these fees. And in the event of a default penalties can also be applied because you can never load it on the lending rate. It is, it's in the event of a default, then a default penalty is actually applied. So that is the sense that the consideration around understanding of how the pricing now has changed, moving away from, so that what is called Kesonia now here was different from one bank to another, so there were too many moving parts. You cannot compare because premiums are changing, base rate is changing, a bank has a rate of 18%, but out of that, base is 14%, another one has the same 18%, but the base is 12%. So comparing that becomes very, very difficult. So a customer gets confused in the process. Now, Kesonia would only apply to variable rate local currency loans. Dollar-denominated loans, Kesonia would not apply because dollar, then the SOFR would apply. Pound-denominated loans, the SONIA would apply because there is a policy behind the pound-denominated facilities. So it only applies to variable rate and not fixed rate loans. So, and the fixed rate here that we're talking about is fixed for the duration of the loan. If it's a 1-month facility and it remains with the same terms in terms of rate for the duration of the loan until maturity, that's a fixed rate loan. If it's a 10-year facility, the same terms to the end of the period, then that remains a fixed rate loan. The implementation timelines, 1st of September was the beginning of the period, because what happens now is that banks, as I mentioned, the pricing models that banks have to prepare are actually based on the premium K. And as banks prepare this premium K, of course, they are it has to be in a structured way, and then banks approach their respective boards for internal approval before they roll it out. Now they have from 1st of September to 30th of November to prepare those models. And those models are centered really around the premium K. So how do you assess your credit risk? How do you pick your term risk? How do you determine your shareholder return? How do you determine the cost of lending related to the costs related to lending? And how do you onboard them on the model? So between now and 30th of November, banks will be preparing those models and get approval from their respective boards. Then from 1st of December, they start issuing variable rate local currency, all variable rate local currency loans based on this framework that has now been adopted. And they would also be transition of the existing loans, because there are loans that are benchmarked now on different base rates. The transition of the existing loans, the loans that are currently in their books, by 28th of February next year. Banks are expected to have completed the transition by that time. Okay? This is just a demonstration. I hope the Kesonia rate is really just a renaming of the interbank rate, apportioned for each day divided by 365, and then you would need to take, it's like you're doing the difference between a simple interest and compounded interest. Okay? So if you took a loan today, the next repayment would be on the 18th of October. So you are compounding. What you would pay is not known beforehand, but until about 5 days to the 18th of October. So what happens is that there is a compounding of all the interest, and then 5 days to the 18th of October, you get a notification from your bank that what is now due for the month of October would be this much, based on the computed compounded interest for the entire month. So that means technically that, of course, there would be need for banks to align with their systems to be able to generate those notices in good time, and then it's communicated to customers. So it becomes also a challenge, on our side in terms of developing the systems, because now the schedules for repayments of loans would also have to be restructured in a way that communicates to customers that your rates would actually vary from month to month, because it moves with Kesonia. It also moves with the changes on the components of premium K. So, but you'd be able to understand how are these components moving from time to time? How has my credit score worsened or improved from time to time? And how has it affected my cost of credit at the end of the day? So it's just take it like it's a deviation from simple interest towards a compounded interest. Now, to govern this process, and I think picking from best practices again, the experiences with the SONIA in the UK is that there would be a working group. The working group would be the group that would actually look at what are the implementation challenges that institutions are facing, particularly in aligning to this new framework. Are there improvements in the computation techniques that would actually deliver much better outcomes than what we are seeing? More like a committee to be relooking into the whole aspect of implementation of Kesonia, and then making recommendations on what needs to be done to ensure that it remains credible. Remember that it's a key component in contracts, loan contracts, and therefore it must be governed with the utmost credibility that it requires, because it's actually affecting people's cash flows and how much they pay on their loans. So there would be a risk-free rate working group that is chaired by the industry and also with participation from the central bank, just to ensure that there is alignment between industry and the central bank for purposes of ensuring that at the end of the day, the central bank would be like the facilitator and administrator of the Kesonia and of course publishing the rates that would be coming out. So it's also expected that since the Kesonia now that we have is daily, we soon, just like the Sonia, we will now have a 3 months, soon 6 months, and maybe 12 months as we go along, so that you are able to get a benchmark for longer dated credit contracts that would be considered by a particular institution. Now, the interest of us bringing this conversation to the conference is because it's an opportunity for us to learn something about how best to price the premium K. Remember, we talked about credit risk. How do you assess credit risk? How do you assess term risk? How do you assess cost of lending related to, the costs related to lending? How do you assess shareholder return? I want to invite my colleague Andrew Njeru to give us a presentation, really based on his experience having worked in the credit markets in Kenya for a long period of time. And then we can ask a few questions before we progress to the rest of the program. In the meantime, you are free to clap for me.
So good afternoon. I'll take us through this one component called Premium K. So I don't know how much time I have. 20 minutes, okay. So 20 minutes, I'll try and rush, but make sure I cover all the important aspects. So this Premium K, as you can see, according to the circular from Central Bank, the banks are allowed to cover the costs of lending, salaries, allowances, directors' remuneration, other expenses, including repairs and maintenance, depreciation, occupancy, rental expenses, contract expenses, and any other expenses. And it's important to note that you can include any cost related to credit risk mitigation. If you have, for example, credit guarantees that were mentioned in the morning, you can have them apportioned to the respective portfolio. Because sometimes the credit risk guarantees don't cover everything, but you might have things like cost that you pay for guarantees, whether it's USAID or credit, this guarantee from government, or African AGF. I think they are known to be one of the ones that it should be there now. Yeah, it's there now. Yeah, so then return to shareholders, a very important component. Just to clarify, return to shareholders should be the expected return, not the actual. So if your bank is making losses, you shouldn't give a negative return. You don't give a discount. Basically, it's what you target from your strategic process. Borrower's risk premium, it's perhaps the most detailed component. I'll spend more time discussing that one. Then, of course, the total cost of credit has to be all those added together. And just to clarify, the total cost of credit, that one has to be part of the total cost of credit disclosures. Banks do have two levels of detailing the cost of credit. One is the interest rate you quote to the customer. And then at the end of the day, you have to quote the total cost, including other things that Sam mentioned, the valuation fees, the legal fees of charging the collateral, and all that. So it's very important to mention that this pricing is at the apex of credit risk management. If you can price a customer and give them their own price, it means you have basically covered the entire spectrum of credit risk assessment and management. And that, of course, is not in isolation. You should have the governance structures, the policies, processes, the models, of course. Credit risk models fall under the models, the people, the authorities, and the systems. Why I had to bring this one in is to make sure that we understand that it is important to have documented processes for credit scoring. Who does it? How often should it be done? Do you back test it? Do you have a validation process? Do you validate within the bank, or you call an external party? Both are allowed. And of course, the governance controls. You don't want your sales team to be determining how the credit score is done without being checked. They can actually develop the models, because I've seen some banks in other markets where sales teams actually came up with the credit score. But of course, they have to have people who check them. Yeah. Obviously, the factors that influence credit pricing, of course, cost of funds, you have the risk premium, competitive factors, of course, the loan structure, whether it's revolving or reducing balance. You have the yield curve. Basically, the term of the facility will determine the pricing. Monetary policy also has an indirect role, direct and indirect, because it can affect your cost of funds, but also they may want to implement specific actions that will happen and that will affect the market going forward. And then, of course, market structure. There are two aspects, and this is discussing the premium now, the credit risk premium. Each customer is expected to have a score and a risk attached to it. And that is the biggest difference between the current update from central bank and the previous. Each bank is supposed to give each customer their own pricing. It will no longer be allowed to have like a portfolio pricing, one pricing for everyone. So, and that is where now credit scoring comes in. There are two approaches. Credit scoring is done for consumer borrowers and smaller borrowers. Then you have credit rating, which I'll discuss later. Yeah, let me just go step by step. So credit scoring basically is a statistical process to assess the credit worthiness of a loan applicant. Basically, it predicts default. And it is very objective because you have to use logistic regression. And then, of course, you have to use some expertise to determine what aspects are most important for the borrower. Of course, it helps even your own processes of credit approval so that a credit officer doesn't have to look at everything to make a decision. So once you determine scientifically what is important, then the system will just compute the score for you, and then you decide the cutoff at what point you need to give a loan. Now beyond that, we are saying pricing for each customer has to be different. Obviously, if you have a bit of statistical background, you know there's something you call target variable. You have to determine what determines default. Is it 90 days? Most of the time when you're doing credit scoring, you don't work within 90 days. Sometimes you even work with up to 30 days or even shorter. Between 30 to 60 is usually ideal because you don't want, again, to wait for too long before you determine what's the default. Yeah. Typically, you would find credit scores that are given by the Bureau are between 0 to 100,000. We use logistic regression. Eventually, you'll end up scoring all your customers and end up with a distribution like this one. You'd see an average score, like for this case, around 550, 540 something. And then you would determine at what point you want to lend at. And that determination is done by looking at the default rate by score. As you can see for this graph, for illustration purposes, there are very few defaults at the higher scores, and then pretty high, up to almost 100% at 325 score. Obviously, you don't want to lend at this rate where the default is 100%. But depending on your risk appetite, and I'm encouraged by the comments from central bank, they are not setting the price anymore. So if you have a high risk appetite, you can even decide to lend to someone who has a likelihood of default at around even 7, even up to 10. But that depends on your risk appetite. Critical success factors for credit scoring, your data has to be very accurate. You have to validate it. If the data is being picked by a system, it's a very good thing. It's always good to deal with the features that are so similar. High correlation is a major issue. Then of course, it's always good to split data between training and validation samples, so that once you build a model with the 70% of the data, you test it on the rest of the sample to avoid overfitting. So eventually, a scorecard would come up with would be just, for example, giving points for each, let's say, age category, income category. Of course, the higher incomes have higher points. The length in employment, of course, that would be something else you look at. And then eventually, you have the score. And then you have to band it. A question that has been coming up is whether we need to have a pricing for each score. It may not be feasible, and it's also not very stable, like on month-on-month basis, because the scores can change, but not significantly. So you band them, create bins. We call it bins or bands. So like the 300 to 350 would be the highest risk, and then you would have the 300 would be the highest risk, and the default rate is around 94%. Then you'd have some higher bands not having much defaults. And eventually, this PD is what will determine the actual default you load on the pricing of the customer. But it's good to mention also something else, that that would explain the transition from that class, that band, to default. But obviously, we know that a portfolio also has a reverse migration. We call it Q rate in the FRS 9 terminology. So you can also adjust to get the net migration so that you tamper down the rates. I'm saying it's important to tamper down the rates because sometimes the PDs you come up with can be too high and unrealistic. And it's very common in the industry that the original PDs for 1 year transitions are too high. If you load on the customer, they might not even be able to pay. So it's good to check and see the Q rate. And beyond this, if you have a mature IFRS 9 process that has scoring, you can actually determine the actual expected credit loss per band. And that can actually drop the figures again. But that depends on this, obviously, on your maturity level for your company, for your bank. So this graph was just to show how loans move from the very good bucket. A few of them will go to the lower grade, and then from the good to moderate, like that, to marginal, and then to poor. Obviously, you'd have the majority of the loans transitioning within the same bands, especially the very good risk bucket will have most of them remaining where they are by the end of the year. And also the second, let's call it a good risk band, you'll find the majority actually remain there. But there's also the reverse migration from the poor to the other bands. So this is just a score, one of the scores I think done by one of the bureaus. And I think it's good to mention why bureaus are important. I think credit scoring by the bureaus has now been a practice for quite a while. It's not perfect, but it's much better information than you can ever expect. So you can use the scores to actually decide how to assess your borrowers. All of us, I'm sure we are bankers here, so we submit the data to the bureaus. We are all required by central bank. So most of all your customers will actually be scored by the bureau. So you can buy the score from the bureau. You can even buy for the last 2 years and then do back testing to see how these customers behave over time and see whether they are predictive. If they're not predictive enough, you can decide to add a few more rules using the data you have, because you know the scores from the bureau only consider the repayment behavior, the days past due, and very few other key factors. But you have other data like income, you have how the account is operating, resting balances, you have days in credit, days in debit, day zero balance. Day zero balance is a very critical number. A customer who runs the account to zero is not a good one, because I don't think anyone can allow you to get your money up to 0 cents. Is it possible? Even on mobile, you can't get up to 0 cents because there are some bank charges, taxes. But you find a customer having zero balances, so it tells you it's a major flag. So once you get the bureau scores, you can actually overlay with your data so that you push customers where you think they should be. And especially to factor in the data that is not the bureau, but you have. Bank account data, that is basically the operational account, the transactional account, not the loan. And then you have a lot of data right now from telcos. I'm sure we get these statements from customers. I don't think there's a bank that is not asking for M-Pesa statements right now. So if you have M-Pesa statements, there's some very nice data aggregators who can help you make sense of this data, and then you build on top of the credit scores from the bureau. But that is only if you don't have a score internally. If you have a score internally, you can just use it, and if it's predictive. So that was just to show the transitions. Credit rating is the alternative assessment, but for businesses. Scoring is for individuals and salaried people and maybe micro and digital. Rating is where you have financial statements. Rating is critical for corporate lending because you're able to look holistically at the business. For corporate lending, you have time to understand the customer. That's the trick, and that's the advantage of credit rating. Because if you have financial statements, these corporates even have strategic plans. You have even an understanding of their market, their positioning in the market. Are they big enough? Are they influential enough? Do they have pricing power? Like now you've noted what's happening in the cement industry. The industry players have started getting pricing power from consolidation, something that happens in the US. Because once the market becomes very consolidated, you start having pricing power. So those are the things that are considered in the credit rating. But financial statements are the major component, and it takes almost 50% of the score of the rating. Gearing ratios are very critical: liquidity, return on assets, return on equity, cash flow held, and it's very critical to also give appropriate weight to what matters the most. One of the ratios I've noted to be very critical is the current ratio, and you'll note that actually all auditors will qualify your books if your current ratio is below 1. If your current assets are below current liabilities, auditors will automatically qualify your books. So when you see a customer, even in the stock market, if you see a company delaying financial statements, most likely their current ratio is negative. And the auditors have refused to sign off without qualification. And then the management are pulling back and saying, no. And that is a trend, actually, from my experience. So those kind of ratios should have pretty high weighting. And then, of course, the company risk profile. The age of the company matters a lot. How is the corporate structure? Is it run by the family? Is it run by an expert? Is it run by one person? Do you have a key man risk? All those things. Banking relationships is very critical. This is very, very important. You can even decide to have a much higher weighting than 10%, and then you reduce others. So financial and banking relationship should almost be at least 60, but can actually go up to 70, 75. But if you were to ask me by there, I would just take financials and banking. I close the chapter. But you have to fight the RMs, so it's good to consider other things also. Because I've always considered, for example, management quality. If you can't deliver results, what words can actually change that? If you tell me the management is good, have an expert, what can change that if your results are showing something different? Yeah. Of course, SWOT analysis is very critical. Weaknesses, strengths, opportunities, and threats. Industry risk, I think I've mentioned industry risk. Which industry is it? Is it highly competitive? How is the regulation? Is your regulator telling you to cap prices? That would affect your... Yeah. So very critical when you're doing the ratings. Statements can be very unreliable, especially for the smaller SMEs. So you find most banks pushing the smaller SMEs to scoring instead of rating. And then delayed financial statements is a major risk. You can have statements that are 3 years old showing things are not too bad but not too good. So you need to start giving penalties for late financials, especially if they go beyond 18 months. Right now we're in August, so statements of last year should be available now. Audited statements for 2024 should be available by now, meaning the last statements you had were for 2023, which is pretty long ago. So if they delay by more than, let's say, a quarter from June of this year, assuming the closure of the books is December, by the time you're reaching June, that is the maximum allowance you can give. So beyond that, every quarter you can start penalizing by reducing the risk rating and taking it down. I don't know whether I have that rating somewhere. Yeah, these are the ratings. So you would have a situation where if you delay financials and you are rated A, you delay by a quarter, that's 18 months plus 1 quarter. You push it them to triple B, and then you keep pushing like that. And because you're doing that and it's affecting the pricing, the customer is likely to respond and give you the statements. And most of the time, by the way, you find the customers not giving you statements. It's not like they don't have them. Sometimes they just don't feel it necessary for you until they need money. But as risk managers, you really want to know what's happening. So on the ratings, other issues, subjective assessments, especially on management quality and competitiveness, they are common, but you figure out how to deal with them. Something like the sector you can standardize. So if you're in the sugar sector, I know the score for the sugar sector, so that you don't have different scores for each sector, each customer, so that you standardize it and it's automated. So if you come, like for example, you're from the sugar sector or you're from, let's say, cement industry, a score is given to you automatically. Bureau scores can also help you. Yeah, I think I had mentioned the other things. So the other alternatives available for assessing the probability of default, that's the likelihood of default. Altman's Z-score is very common. There's one even for emerging markets which you can use. And we had done a paper with Kenya bankers, and it shows some very predictive, though with some noise. With the size of farm, smaller farms, if you look at companies with assets around 5 million to 50 million, the average score, I think the columns are interchanged, the average score is about 5. You can see it's very high. There are larger firms, the average score is around 2.69, which is very common because the score is heavily driven by the return on assets. And smaller firms have much higher return on assets, and even their current ratios are always better. And of course, their reliability is a little less. So for larger corporates, you can actually use the Altman Z-score. And then you map it to PDs and take the number to be a predictor of default. And looking at this slide, you can see the Z-score for the ones 0 to 1.75, the majority of them, where is this? The default rate for the 0 to 1.75 is around 8%. So it tells you that the higher the score, the lower the default. Though not very accurate because of the challenges you have with the financial statements. But it's an indication, it's very indicative for the larger companies. MSMEs, no, it's not indicative. So KMV Martel model is another one, very nice alternative for predicting the default. The original formula was to assist with predicting default for publicly listed companies. Obviously in Kenya there are very few, because the whole idea is if the shares are very volatile at the stock exchange, it's an indication of risk. So you compare that with something they call distance to default, which is almost like current ratio, but it's basically short-term liabilities plus half of long-term. You compare that with the current assets. So short-term liabilities plus half of long-term, you compare that with current assets. So if that gap is narrowing, then you know there's a problem. So that is what is considered, and then you come up with a PD. I think you can find some materials. So, but then what we did with Kenya Bankers, we amended this formula. We tried to see what we can use instead of company shares, and we used the inverse of how the account is conducted. If account has a lot of fluctuations, the bank account has a lot of fluctuations, it's a very good indicator of good financial health. So we proxied that, and it was very predictive, almost, I think, around 76%, heading to 80% ability to predict default, which is pretty good on balance of probabilities, even using the other measures that are used for credit scores. If you can target to identify almost 80% of your portfolio as to predict at least a year before they default, that is really good. So I won't say much about that one. I think I've mentioned about MSMEs. Credit scoring can help. If you don't have enough data, go to the bureau. But don't use the bureau data as is, complement with what you have. Because if your customer has a lot of negative information from your bank activity, how they're behaving, or even from the telco data, you can downscale a customer's score from higher to lower levels. I'm not sure whether it will be possible to go the other way around. If a customer is already defaulting at the bureau, do you want to take them to a better risk band? I think we are bankers, we are more conservative. And for a good reason why bankers are conservative. We are conservative because the upside for a bank is limited, but the downside is then you can lose everything. That is what differentiates banks from venture capital. You know, venture capital, you can put in X amount, but your returns can even be 5,000%, as we are limited by the interest rate, which can never even be more than 20% or maybe 25% per year. So eventually, you would, if you have ratings, you'll have all your ratings with the default rates. As you start for the commercial side, corporate side, you might have very few defaults. So you'll find like not many customers are defaulting even within the first 2 years. So one approach is to map to an external rating agency like the Moody's. This is an example of Moody's ratings. I think it was for real estate sector. So you can just, once you rank all your customers, you can pick the defaults as they are. You can also try to adjust to raise them up so that they mirror your non-performing asset ratio for your portfolio so that they become a bit more realistic. But as you can see, the lower ratings have incredibly high default rates, 16, and this is common even locally. You'll find that the best risk ratings will have very low default. Yeah, so this slide was just to show the alternative for migration. So if you have your expected credit loss data from your IFRS 9 process per risk rating or per credit score, you can actually use it just to tone those figures down, because sometimes the PDs can be pretty high and they become unrealistic. And it's very common that you go through this process, even approval by central bank, and then you realize, hey, we can't use these PDs. And one of the reasons why you can't use the PDs is that on the corporate sector, on the corporate and check-off, to be honest, banks, we are price takers. You can challenge me on that. It's very hard to determine what to charge the customer, because the customer will always get a counter offer from the next bank. So that's why you have to make sure that these PDs are also a bit realistic. You tone them down, but at least they give you some indication of the direction of risk, and also to help you avoid the very high risk. If the risks are too high, you want to avoid that. Corporates, of course, it's good to consider even the collateral so that you have the final expected credit loss by customer, because the risk is pretty high, and if the mitigation is good, very high, good quality, you can decide to be also give much finer pricing. Yes. For short-term products, I think most of them are usually fixed, but we tend to use to assess them based on the vintage, based on the quality of each bookings. This graph shows the quality of the bookings, the quality of the disbursement, depending on the months from the date of origination. The green bar shows that the December cohort of approvals had a much higher risk than others, which is common. You would find that borrowers tend not to pay the loans taken in December over the holidays. So they have to struggle with the month of January. So, but then you can't use 1 month, so it's good to aggregate and get an average for all the months. Then that defines your risk. So if you look at on the left, you'll see probably the average will be around 0.6. So that would be your cost for the short-term products. Okay, so now I'll discuss cost of operations. So central bank is very clear. You have to make sure that you apportion costs appropriately between the loans business and the other non-loans business. So if you have these are just an example. If you have the total operating costs at around 72 million, you must subtract the loan loss provisions, because provisions are now allocated at the individual customer level. So you'll have your net of 58. Then you'd look at all your incomes and then separate them from loans related and non-loan related. So subtotal for loans related, about, let's say we have 110 million in gross revenue, then the other incomes are around 72. So you want to apportion all your costs based on that. So total cost I have 58, so I apportion on 60 to 39 basis, 60, 40 basis. Then that proportion is what then I use to apportion the costs. So low cost of operation for loans only, I end up with around a figure of 5.22. This is just for illustration purposes. So that is the cost you load to the customer. Something it's good to mention that for the costs, you can segment if you are able to. Some banks have really reached a very high level of maturity in terms of segmenting costs. They're able to allocate costs, let's say, for example, between corporate, retail, checkoff, SME, or consumer lending, SME, and mortgages. So if you can do that, you can actually split the cost further. But if you are starting, you don't have that luxury. Some segments may have higher cost of funding, especially corporate, and some segments like microfinance and MSME might have much lower cost of funding. You'll find that they are deposit rich. Technology costs, if you have some origination system costs, you can actually assign them directly. Credit guarantees, I think I mentioned earlier. Credit guarantees, you can actually allocate them to loans which are covered by that guarantee. For MSME, I think I mentioned you may not have enough data for defaults, so you can decide to have fewer buckets. Let me just go to that slide. So on the risk bucket side, so you'll have like, let's say 4 risk buckets, risk bucket 1, 2, 3, 4. The red bar, I hope it's red on the screen. Yeah, it is. It shows the credit risk. Obviously on the risk bucket 5, the credit risk is so high, you can't even pass it over to the customer. But the beauty of this model, if it works out at Central Bank has envisaged it to work, you might be able to take additional risk than you are not able to, than you were able to take before. The smaller banks especially have one distinct advantage of being able to give close attention to the customer and understand the customer. Because of the volumes are not too high and they have the time and the resources. And because of the high resource involvement and the high risk, they can actually take a little higher risk, let's say up to bucket 3 or even bucket 4. Yeah. So I'm just showing the total, all the components there. There's one component I think I need to mention, CRR. There's an opportunity cost of holding idle funds at Central Bank. And I think that currently it's 3.25 CRR. Yeah, so you can actually consider that your opportunity loss is about 0.37. You can top it down, top it up. Cost of funds is another component which seems not to be mentioned in the circulars, but it's implicit in the interbank rate. It kind of assumes that interbank rate is your cost of funds, but it's not. Statistically, it can't be. It's an average. So you'll find a huge portion of banks on one side and others on the upper side. So you can use your actual cost of funds to charge the customer. So I think that is it on that bit. So there's also an option of an expert credit scorecard for MSMEs. If you don't have enough data for MSMEs and the data from the Bureau maybe it's not pretty reliable, it's not helping you to decide what to do, you can create your own expert credit scorecard to determine what matters the most to a customer, especially if you don't have financial statements. Banking behavior, of course, default experience, the default history, days in credit, days in debit, average credit balances, average debit balances, all those things, they're very, very critical. Even the length of the account having good cash flows. The longer an account has good cash flows, let's say from 18 months and above, it tells you the stability of the business. And just that one element alone, we used to develop a product that disbursed more than 100 million with defaults below, the defaults are actually below 0.5%. So everything you lent out, you are losing less than 0.5%, just because of the history of lending and the quality of cash flows, balances, and yeah, the balances that you have in the account on monthly basis, on daily basis actually. Yeah. So you can build that and then add anything else you need to create a very good scorecard, expert scorecard that can help you differentiate for MSMEs. Borrow heavily from your experts, and especially the person who seems to be the most conservative. They can give you very, very important insights. One thing I need to mention, a credit score is not the same as a limit. A credit score is not a limit. You can have the same credit score with the richest person in this country, but you're not worth the same amount. You're not worth nearly the same amount. It's something that it's very easy to confuse, especially if you're not careful. So a credit score just tells me whether you're good for whatever you have borrowed from the current lender. If your range is around 100,000, you may not be qualifying for 100 million. That's why you have to bring in the cash flows component to determine how much to give the customer. So the normal credit appraisal continues. You have to look at someone's income, how much is left over, how much is available to cover the loan. Yeah. Default interest, I think it was mentioned here. You can actually add it as part of the TACC disclosures. Yes, so it is allowed. So if a customer defaults, you can actually charge a penal rate. Obviously, some rates can be too high, so you might have a cap, like we have had for the longest time. Most banks have between 5% and 10%. Yeah, so I think that is it. In terms of this is just the way forward. If you have a credit scorecard, clear scores for everyone, or credit rating, you're way ahead. Then, of course, if you don't have, you can use the bureau scores. Bureau scores are very important, but make sure you validate them. Get the scores for even at least 24 months. For your own customers, who you lent money, let's say 2 years ago, 1 year ago, see how they performed. Once you get the data, you may have to see the anomalies. And if you see some anomalies, for example, a customer will say to be at AA, but they have defaulted, check whether internally you have additional data that can help you to identify that fraud, or even data from the telcos and such kind of providers. They can help you to actually build policy rules to create some safeguards, and so that you avoid lending to people who are giving very low rates for people who you already know they are bad. Commercial entities, of course, a scorecard can help. Yeah, that is a starting point for the larger corporates. But for smaller ones, MSMEs, credit score or an expert scorecard can work. You can decide to use Altman Z score, but of course with some cautions, of course. You have to make sure that the financial statements are reliable, especially if they are issued by a top 5 auditors. Those auditors who are high quality, top 5, you can decide to use the Z score. Then you can start with the uniform costs for all segments. That was just a slide repeating what I said earlier. I think my time is almost up. Tenor premium is very critical. As you can see, short-term money seems to have a rate of around 9%. 10-year, you have around 13. So you can see there's a huge difference between 1-year money and 10-year. So that term premium, you can add it and load it. So you can decide to smoothen it so that you take care of these jumps and drops. So you draw a straight line and say for 2 years, I'll give a premium between 9 and that rate of, let's say, 11.1. And then for 5 years, I'll give the difference between 9 and, let's say, 12%. For 10 years, I'll give that as a term premium. But of course, it has to be realistic, and that's why I probably need to emphasize here. You must consider the market structure. For some portfolios, you're a price taker. Other portfolios, the PDs are so low, banks have kind of uniformly adopted one rate, which is almost like the lowest rate possible. So corporate side, checkoff, you'd find that the rates are almost determined by the market. So you figure out then how do you differentiate, because it's a requirement by central bank to differentiate the pricing. Yes, but it will still be a challenge, because sometimes you may be charging a customer a particular price, but they get a lower one out there. You have to decide whether to lose the customer or match the rate. You sometimes have to go below. And you have to document all these exceptions. They are called exceptions. So if you vary from that pricing policy, you say, why did you do it? Is it because of the competition? Or is it because, for any other reason, especially if you go lower for corporate? For checkoff, banks have been adopting a uniform rate, but now central bank seems to expect differentiated rates. Differentiated rates have been happening under checkoff, but not the way you'd expect. I think sometimes you find them picking customers with high cash flows, high income. Sometimes you find them coinciding with the rank at employer side, like headmasters getting 0.5% less. So I think central bank is saying, can you formalize this? But only for the variable rate loans. I think I mentioned IFRS 9, PDs, probability of default, that it's good to consider much long-term PDs so that you tone it down, especially coming from COVID. Some PDs might be pretty high, so you may want to consider longer duration. And if the data for PDs is so sparse, decide what to do. Do you map with an external rating agency, and then you adopt that for each rating band. Yes, for commercial lending, this assessment has to be a specific assessment, just like what we do in IFRS 9. I have to consider what collateral are you giving me, what is your actual financials telling me, the ratings, how is the mitigation, and then you say, well, I think I'm okay with that risk. Then, so policy rules to manage specific risks not easily captured by the models. So especially when data may not be readily available. These are the things I was talking about, the late financials, debt ratios, On the policy rules and the bureau scores, I think I talked about that. You can complement telco data. M-Pesa is literally everything right now. So if you have negative flags on the telco data, you need to factor that in. And you know that these digital lenders are already doing that. When you download the app, they sweep your messages. So if you have reminders about defaults, they will see them. And that's how they're able to cut some of the risks. But you can, so for, I think portfolios like Chekhov have said, still you can offer differentiation, though it may not be as pronounced as you would wish to. It may not be a 1% difference, but it's good to still offer the differentiation. Because some portfolios are known, or even specific customers are known to have higher risk. So I think that one I've mentioned. So TCC was mentioned also by Dr. Sam. He mentioned TCC. TCC is a separate disclosure. Interest rate is one figure you give to the customer, the offer letter. But TCC now includes the other costs that may be approximated, including valuation fees, those fees that are paid to third parties. Negotiation fees can also be separate, but it has to be disclosed in the TCC. Because TCC disclosure, total cost of credit, shows the annual percentage rate after factoring in everything. Including negotiation fee, valuation. If, for example, you're taking a mortgage, there's valuation fees, you have legal fees, which are substantial. They're not trivial. They're significant. So I've said this is a very good point for all players, especially the smaller players, largely because smaller players tend to be also market makers for the high-risk segments. They're able to have enough time for their customers. So, and I think it's a good time for you to be bold now, if you're tier 3, tier 4, to now go out and seek these customers who have been taken over by the other lenders who are non-bank, and probably also bring them to the form of banking the way it used to be before. They would get a higher pricing, but within 1 or 2 years, now they'll be into the bigger banks and be integrated, especially for the SME side, being a relationship business. And SMEs are not really easy to understand, and most bankers are not able to sit down and understand a customer clearly. But for the ones who have been with them for long, you can easily accommodate some risk and even time. There's this element of no CRB checking. You know, this no CRB checks has become a thing right now. There are quite a number of players who are not checking CRBs, but not banks. So this now gives you a chance to say, well, if you are listed, I think I can actually now consider, can I mitigate the risks, and then give you slightly higher pricing, but at least you're able to increase the credit to the private sector. I think that's a slide just to talk about the SMEs. They tend to have a lot of challenges, not easy to understand. SMEs can have temporary challenges which nobody will understand, especially the big banks, but smaller banks are able to listen So things like restructuring for MSMEs is very uncommon among the bigger banks, but for smaller banks it's very common to accommodate them so that you sort out their temporary challenges. On the corporate side, bigger banks are able to consider, because they have the time. You know, restructuring takes time to understand a customer before you agree to, yeah. Thank you.
Thank you. So we'll take a few questions, areas of clarification you may need. Yes, Radha, Stephanie, and yeah, so we can take those three for now. Mike, please.
Hello, thank you very much. Yeah, my name is Radha Upadhyay, Institute for Development Studies, University of Nairobi. I really enjoyed actually the second slide you put on Tiriongo. I thought that was a really good data that I actually did not know about or had not heard about, so it was really interesting. But I just still didn't understand what were the actual steps that CBK took so that the interbank rate began kind of tracking the base rate more closely and they were able to narrow the band. I'm just very curious about that, and if someone's actually written maybe a 2-pager of what were the specific steps taken. And another thing I'm not clear about is, does the Kesonia apply to the Fuliza and Mshwari and other kind of bank Safaricom partnerships in digital lending, or are we going to still continue hiding behind the fact that those are fees and not interest rates? Thank you.
Hi, good afternoon. My name is Stephanie Kimani from I&M Bank. So I have two questions. The first one is similar to Radha's. It's with respect to the overnight rate. So has the CBK undertaken any stress test scenarios that would show or reveal instances when the overnight rate would, stay not temporarily above that window, but sustain? What could sustain the overnight rate above the window? The second question is, what happens to fixed loans, especially for bankers? Can the lending rate be lower than Kesonia? And if not, what steps is CBK taking to work with the banks to work around the fixed rate loans or very low rates, lending rates that we have for bankers? Thanks.
Yeah, thank you very much for the wonderful presentations. My name is Kennedy Gachoki from HFC. I wish to seek two clarifications. One clarification and maybe one question. On Kesonia, I've been tracking it since CBK started publishing the same, and I've actually seen the figure keeps on changing on day-to-day basis, because it's actually based on daily figures. As in the yesterday's figures will affect tomorrow's figure. Okay, now, my question is, we are contracting for loans on day-to-day basis as banks, okay? So what I'm wondering is, if yesterday's Kesonia, I used yesterday's Kesonia to contract for a particular loan, then today it will be different. To have some marginal changes, isn't it? The loans that I'll be contracting today. So what happens to the ones that I will contract in future? And does that mean then, for those that I contracted previously, will apply the current Kesonia rates? I don't know whether that question is, that clarification is clear. Okay? Now, you also need to mind that for us to change rates for customers, we notify them for a certain period of 30 days. So then how does that tie into that as the rates keep on changing? That's one. The second one is on when we're looking at the customer's risk rating, and I've seen what has been presented, is more based on historical data, okay? And their own is more futuristic in terms of the repayment. So how do we tie the two to ensure that this historical data actually communicates to the risk profile of the customer in the future? Thank you.
Thank you. My name is Jeremy Kirini from KCB Group. My question is on the premium K. Have you considered an aspect of capping the premium K, or we might see a scenario where banks collude to have a high premium K? That's my question.
Okay, so maybe we can take those for now. Maybe we can start from the end as I come to the beginning. Premium K capping. There's a whole reason behind not capping K. So that if today a customer walks in and you assess that the customer can be priced at, say, 25%, so that freedom has been granted, that if you have the appetite that matches that, then you're free to lend at that rate for as long as you have priced that customer appropriately. So the whole idea is so that there is no customer is denied credit on the basis of they are outside the band that is approved. By capping, it means anybody outside that then would not be able to access. So our argument at KBA was that allow it full flexibility so that a customer whose risk positions them at a particular price is not disadvantaged by a bound, a capping that has actually been placed. So it supports financial inclusion, and particularly where there is not much information about a customer profile. There are segments of the borrowers that you would perceive to be risky. How do you accommodate them in your books? By pricing them rates that are commensurate with their risk as assessed by your model. So that's behind that. Historical versus futuristic, I think must be an assumption there that if you've defaulted in the past, there's a higher risk that you will default in the future. So it's indicative to a greater extent. But I'll invite Andrew if you can comment on that. In this pricing, say, of credit risk, in the pricing of term risk, in the of course, and the pricing of, say, the costs related to lending, are there models that allow futuristic predictions at that point? Then, as you take the mic, you can also answer part 2 of the question by Radha on the fees and charges and whether there can be misinterpretations around there. The mic, please, Mike.
Yeah, I think on the premium K, there's a lot of transparency. So you can't just say, I'm going to add, just put any figure for the risk premium. It's driven by the data. So it's very easy to see whether you're actually accurate. And of course, even the market itself might not allow you the market might not allow you to push too high. Because I think, as I said, quite a number of segments, banks are fiercely competitive. But this framework, the current framework, is so nice because, remember, after the rate cap, the credit to the private sector dropped significantly. But where did these borrowers go? They went to the Shylocks. I think there's a huge article by Standard recently that Shylocks have had a field day. So protecting the borrowers from 3%, we now throw them to 50%. So you'd rather even just pay this 3% or 4%, 5% more than what they were paying before under the rate cap, but at least allow the credit, the cost to be passed over to the customer. And also the smaller players have higher cost of funding, for example, and even higher operational cost. We don't have the scale benefits. So it's really been helpful to allow them to do the market making for the underserved segments, especially the MSME, which has really struggled a lot with the rate cap. Thanks. The other question was?
I think whether they would follow
Yes,
okay.
I think they are fixed. You can answer.
Yeah, so at the end of the day, are the rates variable or fixed? If, for instance, a bank has partnered with Safaricom and are issuing a 30-day facility, it's known the fees is, say, contracting fees 7.5, the interest is 8%. I'm just using this for demonstration. And it's for the duration of the loan. That's a fixed rate facility. So Kesonia would not apply in that case. Okay, so the notice period, I think you asked about the notices period. There's something called a look-back period that is in the framework. The look-back period has been allowed at 5 days. So it means as these rates change every day, so there is compounding, and that's why perhaps you saw the rates increasing by the day. It's because it's being compounded from one day to the next. So ideally then at any given day, you can actually look back and say, okay, you have 5 days to notify customers. Say, I used the example of a customer took a facility on the 18th of September. So the first payment is, say, 18th of October. What would happen for that customer is that there would be then the accumulation of interest from day one all the way to 5 days to 18th of October. Then they would actually be given a rate that you are due to pay this much based on what has accumulated over the entire month. Okay. So because it's compounded per day towards that day. And then again, the next installment will start off on day, if it was 18th, 13th, on day 14 now. The accumulation from day 14 all the way again to the next day 13. Then they're given notice on what they would pay on day 18th. So 5 days difference to allow customers ample time to be able to actually prepare their cash flows and make sure that they are able to meet the obligation in good time. But discussions on the look-back period and the framing of this and the notice period is still something, a subject matter and an agenda for the working group. These things would be clarified again, and that's why the working group is established for that. If there are any practical challenges in implementing that, then the working group would consider it appropriately. Contracting loans on Kesonia, so it now means that we have to change the loan contracts. It will not carry a particular rate because it is subject to change from time to time based on Kesonia. So that language that has to be adopted, one actually of the working group objectives is to be able to address the language that is adopted for communicating to customers also. And that of course includes the reviews of our loan contracts that are given to customers. The lending rate, whether there is a chance that the lending rate can be below Kesonia, yes, because K can be negative. If you say, for instance, that negotiated facilities and now the premium has actually been negotiated on other terms. So K is not only positive, it can be negative, so that now lending rate can be below Kesonia. Above window, the dynamics around that, the interbank can be on the upper side of that corridor. That sends a message to policymakers, and happy to note that we have a policymaker. We are privileged to have a policymaker in the room. It sends a message of a pressure in the market, and therefore the need for central bank to take action on that, because if it is on the upper half of the corridor, then it means there is tightness in the market, and therefore central bank needs to inject money into the banking sector. If it's on the other, then there is the market is too loose in terms of availability of money, and therefore it needs to mop that money to such extent as to align the interbank rate to the central bank rate. What specific steps did the central bank take to do this? I think with the announcement of the corridor, there was a stronger commitment on the side of the regulator that now I think it's a transition generally from quantity-based monetary policy to price-based monetary policy. And that transition meant that now the central bank does not target the amount of money in circulation in the economy, but it targets to align the interbank rate to the central bank rate. So that means all actions, today the central bank can be injecting, tomorrow they can be withdrawing. So it's not to target a particular quantity, but it's to target controlling the volumes so that the outcomes on the rate are actually aligned to the central bank rate. So that's basically what happened. And even now, that commitment has been made much stronger with the narrowing of that corridor over time, because it means then the triggers for liquidity injections or withdrawals by the central bank have been made more, the sensitivity to trigger change in liquidity is now much more by the central bank. And the central bank has done that over the period of this implementation, hence the results that we have seen. Yes, Andrew, you wanted to add something? Thank you.
Yeah, just want to add that the Kesonia is mostly like a benchmark. It's like what we call in banking, interest key. So, and for for half of the banks I think I mentioned, your cost of funding will be lower than Kesonia. Is that not true? So you're not obligated to charge your customers based on Kesonia as if it's your cost of funds. So if your cost of funds is around, let's say, 4%, you cannot assume Kesonia is your cost of funds. That also means that in the short run, if, for example, there's a major spike in your own cost of funding for a particular month, and if you're required to change the rates every 30 days, but your cost of funds have changed significantly, the central bank will not actually stop you from passing the cost to the customer, as long as the costs are verifiable, actually. And cost of funding is one of those things that are straightforward. Thanks.
Thank you. Thank you for clarifying that part, that it's also expected that there is no double counting. If you've accounted for something in one component of premium K, then it should not be on the other component. So just for clarity's sake, these conversations continue over the next 2 days, all the way to 6 p.m. tomorrow. So we would want, in the interest of time, to invite the next presenter, which is NCBA team, Raphael, Anthony Muli, David Ndwiga, and Samantha, to make a presentation on the credit guarantee schemes and MSME financing in Kenya, a farm-level analysis. It's related to the study that we heard about earlier on, and therefore, even as we look at comments that would be generated on this, we can now put them together, including the ones for the previous study that we did. Anthony. All right, good afternoon. Good afternoon. Okay, I'll take a short while just to take advantage of the earlier paper by Rogers and just build on it, mostly around the background and a bit of the references that we've looked at. So our paper is titled Credit Guarantee Schemes and MSMEs. And in this paper, we are looking at farm level sort of analysis. So we have one specific credit guarantee scheme that we've looked at. And we'll probably just look at some of the info that you're getting from that data and see what we can infer from it. Obviously, as introduced earlier, MSMEs are a key component of this economy. Just looking at about 15 million, people employed in this sector, about 30% of GDP from this sector. Then looking at, although slightly dated, that's KNBS establishment census done around 2017. That sort of puts the MSME enterprises at about 72%. So that tells us that they're quite important into the sort of registered enterprises that we have. Then lastly, which is also more important, we've seen quite a number of innovative ideas and also products come out of this portfolio or this segment of our economy. Then mostly in this study, we've narrowed down around the formal classification for MSMEs by the Ministry of, by the government. By way of introduction, we obviously have high perceived and sometimes actually real risk around this portfolio. Then we've also had the case for presence of collateral, but that collateral is either inadequate or not quite acceptable to most of the FIs, that's financial institutions. Then lastly, we've also had the issue of adverse selection and moral hazard, and that sort of puts us to a de-risking mechanism from which we've seen the government lead at the front, which is just sort of to put in some third-party credit risk mitigation mechanisms. So far into these mechanisms, we've seen the government-backed guarantee scheme, a seed capital about 3 billion, so far disbursed just for 4,000, slightly above 4,000 loans, and slightly above 6 billion. And that means that, well, not to the scale most of us would have had comfort with. And that scheme has also given us the impression that we have about 73, borrowers that are new into the formal financial system. Then on the private sector, we've had a couple of DFIs, that's development financial institutions, roll out several guarantee mechanisms. And one of the guarantee schemes that we're looking at actually borrows from one of these DFI credit guarantee schemes. So far, what we've seen is that despite existence of this credit guarantee mechanism, and if you look at the government one, dates back to just slightly after COVID, late 2020, we've still seen MSMEs continue to get constrained with regard to credit access. So one at this point would ask whether this has improved credit access, and also looking at the numbers that we've seen, especially from the government-backed guarantee scheme, the numbers are not as rosy as we would have liked. And also around 2021, we saw KBA come up with a survey which indicated that still above 50% of the enterprises are reporting constraint with regard to accessing bank loans. And most recently, if you look at credit data from the regulator, one gets the sense that credit growth is still quite low. If you look at media, that's June, about 2.2%. And if you look at the line for the trade segment, which is mostly, call it 80-90% SMEs, credit growth there year on year as at June was just about 3.7%, and that means that there is a real challenge with regard to access of credit for this segment. And just comping most of the literature, which bears evidence across, especially Asia, where this sort of sprang up much earlier, and also South America. Evidence is still inconclusive regarding whether credit guarantee schemes actually enhance credit across most of the key markets. So for this study, our objectives have been as follows. One, we just wanted to examine the performance of this specific credit guarantee scheme with regard to a couple of components. Secondly, we've also sought out to determine whether the credit guarantee coverage ratio actually leads to less default or even less probability of default. And we've also enlarged this to cut across the specific sectors that most of the borrowers are coming from, just to see whether does this probability of default differ across agriculture, manufacturing, or even the other sectors. And hopefully our dream is that this will be useful for the review of a couple of credit standards across most of the key lenders in this portfolio. And the other thing is that we also contribute into a bit of empirical evidence, given that in this market, this should be one or among the first studies to look at very farm level data. And given the discussions that are ongoing with regard to the greater credit guarantee scheme question, we hope that these findings will help in the redesign of these schemes, especially on the government side or even for the DFI side. Then just briefly on the research methodology, the way we did this is we looked at performance. In this, we measured the utilization level and also the portfolio quality, just looking at the data as it is. Then to look at whether, getting on board a credit guarantee scheme actually improves credit quality. We used a probit model to analyze the probability of default, and therein we controlled for the farm level characteristics and also the amount of credit that was disbursed. And we also have data across, the purpose of the loan. We also controlled for that. And specifically, we used data for very close to 2,400 MSMEs. That's 2,398 MSME borrowers. And that was done for the period, 2022, January to February this year. And just looking at the model choice, this enabled us to, look at the unobserved characteristics or behavior of the borrower. And also, the error term did us good in terms of that analysis. So looking at the findings, just briefly, then we can go into the Q&A. Looking at the performance, we have obviously these close to 2,400 MSMEs that were able to access credit above the available collateral. And secondly, if you look at the sort of repeat customer framework, about close to 17%, that's 16.35%, were repeat customers for this access. And that means that the credit guarantee scheme points to improved access for these borrowers. And most of this was actually just for working capital financing. And then if you look at the portfolio quality, we have about, in terms of count, about 198 MSMEs that defaulted. And if you look at the value there, you get a figure of 8.3% being in default. Comparing that with the mainstream or the industry level, SME type of default rate, mostly just looking at the trade portfolio, which is mostly, the wholesale and also the retail and the repair guys. For the industry, that's about 21% as at June, and that means that performance in terms of portfolio quality under this scheme is actually much better than the average SME level type of performance. Then looking at the second objective, which is just to look at the impact of this credit guarantee scheme, we noted from the analysis that about looking at the probability of default, about 30.2%, is the figure we got in terms of the probability of default increase, in the credit guarantee coverage ratio. And that means that there is a bit of moral hazard in that bit, and although that was quite insignificant. And just to display the overall numbers, if you look at the first column, that's the coverage ratio, disbursement amount, and also the age. For Model 1, it tells us that increasing the coverage ratio, add that probability of default, although it's not significant, both at 1% and also 5%. However, we noted high moral hazard effect across some of these sectors. For example, if you look at Model 2, which is Model 2, which is agriculture. If you look at building and construction, which are mostly SMEs around the supply chain, ballast, some queries, and also transport sector within the building and construction. That was also high. And the other one is Model 6, which is manufacturing, which touches mostly around the supply chain with regard to transport and also distribution for some of these manufactured products. Age also gave us, some interesting results, and it indicated that overall, which is Model 1, the probability of default reduces with farm age, which was expected. However, that was different for two subsectors. One is agriculture, so age was, was not in line with the overall model, and the other subsector was tourism. And we think that these results sort of denote the high variation with regard to seasonality in these two sectors. Because if you look at agriculture and tourism, most of them have significant seasonality, which is, in most cases, if you look at weather, that's quite outside, the purview or of the farmer, whether it's a large-scale farmer or not. And secondly, if you look at most of the tourism operators, be it restaurants or hotels, if there's COVID, then they have nothing to really do about it. And the other thing is that any external shocks are usually, cutting across both the small and also the bigger enterprises for these two sectors. Then this sort of gives us a couple of policy recommendations. One is that we see value in these results, providing some incentive to the lenders to either enhance the partnerships or even the guarantee partnerships that they have with various institutions, given the value in this one, which is improving access, and secondly, with regard to lower probabilities of default when farms are covered under a credit guarantee scheme. Then as we get into the season of reviewing some of these credit guarantee schemes, then we expect that this input will also be useful, especially looking at the results that we get across the sectoral view, where it tells us that we need to go beyond the vanilla type of credit scoring model for the credit guarantee schemes, and maybe tailor it across the various subsectors, given the behavior that we've seen with regard to the probability of default. Lastly, which is on the results that we get with regard to age of the farm, we think that this also sort of puts emphasis with regard to financial institutions training on entrepreneurship, or even other trainings that they do offer the young MSMEs in this country. Thanks, I'll pause it there and invite the discussion. So the discussion of this paper is yours truly, and I would want to keep it brief in the interest of time, so that I know a number of other comments. I'll convey them directly to the authors, but ideally just want to emphasize on a few things that are coming up, even as we see from the study. I think the study pursued two main objectives. The others, of course, are beyond this, but ideally around the impact of coverage ratio as a feature of credit guarantee on default probabilities, and the differences in probabilities of defaults across sectors, whether we can see evidence across sectors. But it calls on us to really start thinking about, is there value in using aggregated solutions, or there is value in disaggregations? Because we are now starting to split hairs in terms of whether probabilities of defaults differ across sectors. Soon we'll be seeing, does it differ across products? So they always say, they don't want to say the devil is in the detail, the angel is in the detail, in terms of, by splitting, we start to see some new insights that actually are being generated, and I want to thank the authors for this paper. The fact that even moral hazard itself can differ across sectors, so the behavior of certain customers within a particular sector can be different, is something profound, because it means, is there a sharing of information within a sector, particularly those that, say, in the agriculture sector? Do farmers collude to behave in a certain way? Or is there learning from one farmer to another? Is there learning from one player in the tourism industry to another? So when you start seeing these trends, then it means that the way we treat a particular sector starts to differ when we are addressing this. And this being a critical component of credit guarantee scheme, it actually informs the design of credit guarantees. We start to think about design features, start to think about product and sectors, even as we design this. So if we now get to a point where we can say there is no one size fits all, we must disaggregate and actually look at the detail, because that's where we see a lot of insights that is coming. And it speaks very well to the issues around, even today as we talk about pricing, we are now centering, it's not saying that it will never be on the product, it will be on the individual. So getting back to the individual and assessing the individual on their own standing, it's indicative, because if we can see differences across sectors, perhaps even if somebody was to look at individuals within a particular sector, you may actually start to also see some interesting trends in terms of differences from one individual to another within the same sector. As we group them in the sector, we see differences. As we disaggregate them to specific individuals, we may see differences. So the individual has become the point of pricing, the point of focus, if you want to look at it. Older firms behaving differently with regard to with regard to probabilities of defaults. Is there learning that happens over time that we can start to take advantage of? And then if it is learning, at what point, what is the pivot point? Beyond what level of experience does one start to think about not defaulting on a particular facility. So all this start to indicate that there are behavioral issues, and I want to revisit a paper that once I think was published by Josiah and Jared before about biases, behavioral biases that start to be seen within a particular group of individuals. Now we start to see some differentiated characteristics from one sector to another. And of course, these are trends that would be keen to know, so that we now know we don't use the same paintbrush for all. There is need to start considering solutions that are informed by detail, and therefore that then becomes very, very critical. So I commend the authors for this, for shedding a lot of light on this and alerting us that please, as we consider solutions in the market, there is no one size fits all. There is merit in looking at detail, because there are a lot of insights in there. And of course, once we appreciate probabilities of defaults within a particular sector, and then we start now to design products based on that information. And therefore, we don't suffer losses as a result of applying blanket product features across the different sectors. So I thank the authors for bringing us this paper, very insightful. I would encourage all of us to read it as it gets published soon. And of course, the rest of the other writing details, will make them available to the authors as we go along. But I want to invite comments. Finished to the discussion part. Now I start the chairing part. Invite comments on the paper. I see Jared's hand is up. Okay, you can take Jared and then.
Thank you. I wanted to speak with the music in the background, but I think now I just have a couple of comments that actually run through the two papers, because the two papers are related. The broader one is with regard to the assumption that the assessment you're making on the credit guarantee schemes is that the way they're fit for purpose. Both papers have not made any deliberate endeavor to actually question whether the design issues of those credit guarantee schemes make them useful or not, depending on which corporates they want to target. And that is why I think the first paper by Mwalimu spoke to design issues, but didn't go into the details that one could have expected on what to think about in design. My comment there will be, you look at design beyond the coverage, how much is covered. Because when you look at design beyond coverage, you bring in other interesting dimensions that then can allow you assess effectively the credit guarantee schemes. By here I mean the ownership structure of the credit guarantee scheme. If the credit guarantee scheme is 100% government owned, then that is basically a taxpayer insurance of credit. And that has a dimension to moral hazard, because the moment it's 100% government, any borrower will say that this is our money, pesa yetu, so they may not necessarily be. So that's a design issue. The other design issue is around the participation of the lenders themselves in ownership of a credit guarantee scheme. The conversation you had in the morning is a design issue. And what does that mean to the performance of the credit guarantee scheme? I think that's an empirical question. So design issues are really very critical here. The second comment is around, the nexus between the credit guarantee schemes and the kind of expectations that the financials have on whether they're getting any capital accommodations if they take, guarantees, meaning how much capital hit you take when you have a guarantee, whether that guarantee is 100%, 50%, whatever it is. Now, I want to stretch that conversation slightly further by saying that, yes, you may expect some things around capital if you have a guarantee, but on the liability side of the banks, you not only have capital, you also have deposits. Is there a way in which expectations on what the cost of deposits is linked to a credit guarantee scheme? Why I say so is because the reason why you want to provide credit guarantee is so that you don't have either people not lending to SMEs, or you don't have SMEs building into the non-performing loans in a manner that goes beyond financial losses to the banks, but also potentially to having an implication on financial stability. So in that case, therefore, just like credit guarantee is an insurance on the asset side, we have deposit guarantees. And you may think that there's no relationship between deposit guarantee and credit guarantee until you start thinking about what happened recently in the US, where some banks collapsed, and now the government had provided blanket assurance on deposit side, even though they have credit guarantees. So I think broaden the conversation further to look at how credit guarantee is on both sides of the balance sheet of banks in terms of consideration and conceptualization. I think those are two comments I wanted to make, so that at least as you think about these credit guarantee schemes, we don't assume that they are fit for purpose simply by just looking at what they are and how much they're able to leverage. Thank you.
Thank you. There are 3 hands.
Okay, thank you. I'm Kudachi Sango from Stanbic Bank. One of the things maybe we need to think through and interrogate is the relationship between credit guarantees and probability of default. So in as much as the outcome may be statistically significant, is the probability of default more of a guarantee or collateral play, or more of a cash flow play? Because that's why you find, even where collateral is availed, and then you overlay with a credit guarantee, you may not see, much of a significant kind of difference in the way probably accessibility to credit. Because probably before one is lending, is looking at the cash flow play, which plays much significantly to the probability of default, more than a reduction of loss given default, because that's what creates now the moral hazard bit. If someone is saying, okay, I may default on this, and they may claim from the insurer or from the guarantor, probably that brings the behavioral aspect that's not desirable, but the assessment before the guarantee comes into play, it's more of a cash flow play than probably a collateral and a guarantee play. So that's why you'll find accessibility continues to be a problem as long as one is not doing security lending to reduce loss given default, but one is looking at cash flow play to reduce probability of default.
Thank you. Thank you, Dan.
Yeah, thanks. So my name is Dan Tandas from Tanzania Bankers Association. Yeah, the finding that really interested me was the fact that the higher the credit guarantee coverage ratio, the higher the probability of default. Of course, the analysis show that the result is insignificant across the board, but it's still important, as the previous speakers alluded to. Now the question is, you highlighted about the rationale of disaggregating the coverage ratios and how we go about ensuring the effectiveness of these credit guarantee schemes. I wonder whether the authors found that whether there is an optimal credit coverage ratio, the general optimal level, but also whether through the data it can be established whether there could be disaggregated optimal coverage ratio for these credit guarantee schemes. But the previous paper, speaking about the design issues, talked about the rationale of having independent, sort of adding an independence feature to the governance structure of these credit guarantee schemes. I wonder whether the second paper find that that's also very important, that the governance structure issues of these credit guarantee schemes in our markets, and whether they're best practice in other markets with regard to how these credit guarantee schemes can be governed well. Thanks.
Thank you, Dan. There was a hand up by Caroline.
Thank you. My name is Caroline Kariuki from Strathmore University. So I wanted to kindly ask Anthony, actually the question is linked to what has been asked, but I didn't quite understand the methodology part, perhaps how you came to that conclusion as to that relationship between the credit guarantee coverage ratio and the probability of default. And also, kindly, maybe according to you, why do you think that the default risk reduces with an increase in the loan amounts that are lent out? And then for Dr. Rogers, I had also asked him this question earlier, but because he mentioned that for institutions or SMEs that maybe have collateral and also get the credit guarantee, that doesn't really reduce perhaps the loan amount, or or they don't really benefit much, even if they already have collateral. So I wanted to ask, do you think with the new loan pricing model, like with the introduction of Kesonia and how there's now a focus on the, individualized, perhaps the premium K being more individualized, do you think that will help transfer those benefits to MSMEs when they have their own collateral and perhaps or also the guarantee as well? Thank you.
Thank you. I think we'll go to the authors. Do you want to comment on the same? We can start with Rogers, the other side. Then we come to David and Anthony and Samantha. Sorry, Mwalimu Rogers.
Okay, thank you. Maybe let me quickly respond to Dr. Caroline's question. Indeed, the expectation is the two should complement one another in the sense that if you have collateral and on top of that layer you have you are guaranteed, you should be able to get a low rate. The data that we had didn't seem to agree with that hypothesis. Our quick thinking could be that banks are not passing the benefits of the guarantee to the borrower. But then again, as I mentioned earlier, I do not want to, explore that conclusively because of the kind of data that was available. I remember the discussant mentioned issues like endogeneity, so there is a level to which we can put our consideration on the empirical results. But that is probably if we get more data to understand the characteristics of these firms, perhaps the interest rate, the other considerations that banks are putting in which we are not controlling for. So probably that's a good question, but as we get more data, it would be important to really dig into why that is not the case. Because individually, the collateral and the guarantee, individually they seem to reduce, but when we interact, then that effect, so which means probably banks are looking at collateral more than the guarantee, and that's why we do not see the interaction being quite, it's over, you know, it's not, the guarantee is not adding, it's not complementing its, the collateral. Okay. I don't know if there was any other question for me, but yeah, that's the one I picked directly.
Okay, I think it was about a further discussion around the design issues would be helpful in terms of the sensitivity of the results that we are getting to design issues, whether we can, what can we learn for design based on the empirics that we are coming through. But I guess as we refine it's a comment to take home, as we refine the empirics, then we link it up to design issues that would come up for guarantees, because I think that would be very topical and also very timely around this time when Kenya is considering incorporating a credit guarantee company that is solidly designed so that we expect this to be an input paper. So thank you. I think we'd go to the NCBA team for any quick feedback on the comments that have come through. Mike, please, Mike.
Yeah, I think two issues to respond to. I think much of the issues were on comments on improvement around the issue of the design. And also what Jared mentioned about the issue of the deposit guarantees and how they sit in the bank's balance sheet. A response to Dr. Caro about the issue of the default, the effect of the default probability. That is the loan size. The findings is that as the loan size increases, the probability of default also increases. Now, let me clarify this. I'll tie this with the question asked by the colleague from Standard Bank and also from Tanzania Bankers Association. In the paper, and we know there's that confusion, when it mentioned the probability of default, we don't actually refer to the probability of default as we know from the credit side. That side you get from the bureau or credit scoring. The probability of default here is a binary outcome. So given the data that we have before you run the probate model, if the MSME has ever defaulted, it takes a value 1, otherwise 0. So the probability of default here is the one which is being estimated by the probate model. But I know in this room, the bankers may confuse that with the probability of default as the one that we get from the CRBs or the credit scoring model. So we need to clarify that. So we are not using the probability of default from the credit models or the bureaus. So here we get the data. If the firm has defaulted, it takes a value 1, otherwise 0. So it's a binary outcome. So that takes me to the response to Dr. Caro Kariuki. Our finding here is that as more amounts of loans are dispersed, then the probability of default or the probability that the firm will default increases, which could be explained by two issues. One, of course, when you have a higher loan, then in case of any shock, then you have a higher chances of defaulting because you are high installments as well. But also, if you look back into the data, for those, this could be explained by, if you look at the loan disbursement vis-a-vis the coverage ratio, you'll find that for the firms which are having the firms that you're using, the 2,398 firms, the firms which have high disbursements also have a very low coverage ratio. And therefore, you find that much of this exposure is being covered by the bank, or the bank is more exposed, it takes a higher risk on that. And therefore, in case of any shock, then the same is likely to apply.
Okay, thank you for that feedback, and of course the rest is what you can carry into incorporation into the paper, including whether we can see optimal coverage ratios within the guarantees that we are designing. And the linkage around, I think it was about a further discussion on the independence element in the design issues for Rogers. So thank you very much. I think in the interest of time, we can progress to the next paper. Please remember that if you had any other further comment, please feel free to drop us an email, and we'll be able to channel the comment to the right author for it to be addressed, so that at the end of the day we get papers that speak to all the issues that we have raised and cover all the grounds that we need covered. We now transition to a paper on unlocking MSME credit, sector-specific insights from Kenya by Stephanie Kimani of I&M Bank. The discussant is Dr. Caroline Kariuki of Strathmore University.
Okay, good afternoon. So I'll take you through my paper that's with a subject of unlocking MSME credit, and this is informed by sector-specific insights from Kenya. Now, I'll begin this presentation by grounding it with the facts. 40%, MSMEs contribute 40% to GDP, and the government's ambition is to grow this contribution to 60%. And this makes us just understand that MSMEs are just not going to be participants in this economy. They're also going to be key strategic levers to the government's growth agenda. Now, one thing we have to appreciate is that this ambition makes sense, given that out of the 7.4 million SMEs, although this data is dated, about 1.5 million are licensed. This means that there is a massive 80% of MSMEs that operate in the informal sector, and this informality means that there are repercussions around the access to credit as well as weak regulatory oversight. And this just suggests that for the government to meet this ambition of growing the MSME contribution to 60% of GDP, it means that more MSMEs need to be formalized. And also, if we as a country want to actually achieve this inclusive growth, the MSME sector is where it's at. given the fact that they're socially indispensable, already contributing about 85% to non-farm jobs. This means that 9 out of 10 livelihoods, especially for underserved segments such as women and youth, actually rely on the MSME sector. Now, when we dig a little deeper, we see that the MSME component comprises micro-enterprises, small enterprises, and medium-sized enterprises. Now, 98% of that is micro-enterprises who are largely very informal, have very low capital, as well as being survivalist in nature. And this may actually explain why Kenya has a near 2.2 trillion financing gap for MSMEs. And some of the responses I got from industry players as to why this financing gap exists is that these businesses don't look creditworthy, and thus we avoid them altogether. And for the businesses themselves, the issue is, at least the main issue, is around the fact that bank products don't fit their needs. Now, when you dig a little deeper into why banks or financial institutions are saying that these MSMEs don't look creditworthy, it's largely on account of the fact that a majority of these businesses, as has been mentioned before, lack collateral, as well as not having business accounts, as well as proper records. And with respect to avoidance, this stems from the fact that there is a high cost of appraising, monitoring, as well as recovering loans from microfirms. And as such, a majority of financial institutions prefer to lend to the 2%, that's the small and medium size, who are more formal, traceable, as well as bankable. Now, we have to appreciate that MSMEs are getting funding, and their proportion to the total banking sector loan portfolio has grown steadily from 2017, from 19.2% to 21.4% as at the end of last year. Now, it comes as no surprise that a majority of the MSME loan accounts are actually from micro-enterprises, given the fact that they represent 98% of the MSME sector in Kenya. But when we shift our focus from number of accounts to total value, we see that there's a staggering gap. These micro-enterprises actually only got, at least as at last year, about 89.4 billion in funding, as compared to the small and medium-sized enterprises that got about 695 billion combined. Now, this is nearly 8 times the value that is going to a segment that constitutes only 2% of the MSME population. So while we may see that the banking sector ticks the box in terms of inclusion and based on growing reach, it fails the equity test on depth, as the smallest businesses, that is the micro enterprises, are starved of meaningful capital. Now, my paper. We're breaking down further just to better understand the sectors that benefit from funding from this, from this funding across the 3 segments. So we find that over 60% is spread across the 3 sectors, key sectors, that is trade, real estate, and transport and communication. Now, while at first glance, as I've mentioned, it seems as if there is a micro access problem, this study does appreciate that, yes, the micro story is very real, but it's best to understand this from a sectoral lens, which is more analytically sound, but also aligns in the way in which banks allocate credit to the MSME sector, as well as how policymakers structure interventions. And that's the reason why I have used the sectoral analysis lens, so that I'm able to capture heterogeneity within the MSME sector, align with the GDP contribution trends, as well as identify any policy levels and targeted credit tools that can uplift the MSME firms. Now, the study is therefore trying to understand just the main financial and policy-related drivers of MSME credit across these 3 key sectors within Kenya, and how also the perceived credit risk as proxied by sector-specific NPL ratios affect banks' willingness to lend to these MSMEs, as well as the role in which sectoral economic opportunity, which is proxied by sectoral GDP, plays in credit allocation, and as well as the impact of the interest rate capping period. The objectives, just to evaluate the impact of financial health indicators on how this influences lending behavior to MSMEs, as well as assessing sector-level economic performance and how this correlates with MSME credit allocation, as well as to analyze the impact of the interest rate cap period. Now, briefly, when I look at the literature, I won't go in-depth into this. I'm using 6 key variables. Start with the dependent variable, which is sector-specific lending across the 3 sectors, that is real estate, trade, transport, and communication. I also look at the sectoral GDP across these 3 sectors, which is a proxy for credit demand, as well as the economic opportunity within each industry. I'll be looking at also the NPL ratio within these 3 key sectors, and this will be a proxy for credit supply risk. I'll be using the weighted average lending rates because the study was unable to get lending rates specific to the sectors, and this will just be the proxy for price of credit. I'll also be using the bank-wide liquidity ratio just to capture the bank's ability to extend new credit, as well as an interest rate cap dummy just to proxy regulatory regime shocks. Now, this is just a blueprint of the model. I use an ARDL model, and I will speak to the pre-estimation techniques. I just came up with this just to show the flow. As I mentioned, key variables of interest is MSME lending, a demand-side variable, that's the GDP, supply-side variables, which is NPL ratio, lending rates, and the liquidity ratio, as well as the interest rate cap. The key pre-estimation techniques were the unit-root test, all variables except for the interest rate cap dummy, which is assumed to be stationary at I0. That's the only one that is stationary at I0. Also looked at the optimal lag selection, as has been seen on the screen, as well as the ARDL bounce test, which looks at detecting long-term co-integration, that is a long-run relationship between the variables. Now let's dive into the results. When we look at the real estate sector, it is highly rate sensitive, and the model suggests that credit to the real estate sector is extremely sensitive to lending rates both in the short and long run. When looking at the short run, higher lending rates are associated with higher levels of credit to the real estate sector, and this may suggest that developers rush in to just secure loans before any further rate hikes, which is a form of what I would say opportunistic borrowing in that sector. Now, when you look at the long run, we see that there is a very large negative coefficient, which is highly significant, underscoring how acutely real estate credit contracts when the lending rate rises. This just may be linked by the highly leveraged nature of the real estate sector, especially for those medium-sized enterprises within that space who depend on project finance as well as construction loans for the success of their projects. Therefore, higher lending tends to result in many developers lending rates, that is, results in many developers either postponing their projects or scaling them down because the cost of borrowing outpaces the returns, therefore resulting in balance sheet risk. When we look at liquidity, there is a negative relationship. That is, higher liquidity doesn't necessarily translate to higher lending to the MSME space, and it's generally in the credit space anyway. But this implies that when banks are flush with cash, they choose to park those funds towards safer, higher yielding alternatives like government securities. The interest rate cap period, no surprise there, shows there was a negative impact towards disbursements to this real estate sector, and this is because I believe that the interest rate cap discouraged risk-based pricing and forced banks to just pull back lending, especially for those sectors that they perceived as risky. We also look at the error correction term, which is appropriately negative, which just suggests that there is a long-run relationship between the variables. But then, as you can see, it's only 9.4%. That means that only 9.4% of shocks within the credit space towards the real estate sector come back. Are corrected each quarter, just suggesting that there are some structural rigidities that need to be taken into account. Now, when we're looking at the trade sector, more specifically wholesale and retail sector, we're finding that sectoral GDP does support credit to the trade sector in the long run, but the volatility and seasonality effects come into play in the short run, and that negatively impacts credit to that sector. This just suggests that the trade sector tends to grow steadily, but banks become more, it just suggests that when the trade sector is growing steadily, banks become more confident to lend to that particular sector. Now, in the short run, as I've mentioned, there is a negative relationship where we are finding that better performance in the trade sector doesn't really relate into credit to that particular sector and vice versa, and this can just be reflective of erratic revenue cycles as a result of seasonal demand, as well as maybe exchange rate shocks, especially for those that are doing exporting. Now, statistically, Kenya's trade sector, as you may all need to appreciate, is highly informal and thus very vulnerable to any shock onto the credit space. Now, in terms of lending rates, similar to what we've seen in real estate, we see that lending rates are a significant barrier to the trade sector in the long run, suggesting that a reduction in those lending rates could unlock credit access, and even marginal changes in lending rates have large effects on credit to trade. Now, the interest rate sensitivity to the trade sector could also imply sensitivity around, or rather related to low profit margins. Bank liquidity, again, no surprise, it seems to be a case that cuts across all sectors. Higher bank liquidity doesn't necessarily translate to higher credit, and this just suggests that banks are utilizing these funds, either lending to safer borrowers or parking those funds in government securities. Now, for the NPL ratio, we are seeing it being, or rather credit risk being a key deterrent to credit access for those in the trade space, both in the short run and in the long run, albeit not as significantly in the long run. This is what I would call a self-reinforcing loop, where you're finding that high NPLs result in increased bank caution and then credit contraction in that specific sector, and thus the increased chance of more businesses failing, thus sustaining or elevating credit risks within the trade sector. For the interest rate cap, again, no surprise, negative impact, but again, for the error correction term at 11.2% means that the credit to the trade sector reacts more slowly to shocks. When we look at transport and communication, again, highly sensitive to lending rates in the long run, and this just reflects the nature of MSMEs within this space, as they often operate on thin margins and short cash flow cycles. We also find that the bank liquidity ratio as well is negatively correlated. Again, banks with flush with cash either park these funds with safer borrowers or in government securities. GDP is positively significant in influencing credit to this sector. This is no surprise because at least you're able to monitor movement or rather traction within this particular sector. Interest rate cap negatively impacts credit, no surprise there. Now, what does this all mean? As I've mentioned, lending rates across the board seem to be the biggest bottleneck across all sectors, and the model results show that credit uptake is highly sensitive to lending rates, confirming that MSMEs' access to financing is meaningless if pricing makes loans unaffordable. The second point is that even though banks may be liquid, this does not necessarily correlate with higher MSME lending, at least from the results across the three sectors, and this suggests risk aversion and crowding into safer assets such as government securities rather than flowing funds to the small businesses. Another key point is that the model shows that the GDP effect on credit is inconsistent, which could possibly reflect delayed transmission, seasonality, and of course the informality of a majority of MSMEs, given that a big chunk of MSMEs are micro enterprises. This suggests that when shocks hit MSMEs, they feel it fast, long before GDP numbers actually catch up. Now, with respect to NPLs, Credit risk only has a significant relationship in trade, where a high NPL ratio tends to tighten credit conditions in the short run. And the study reveals a very slow recovery after a shock across all sectors, suggesting that MSMEs remain fragile. Practically, this confirms what we already know, that a majority of MSMEs collapse within just a few months of a financial strain, owing to inadequate buffers. So the action points for banks and policymakers are these. The paper, or rather the study, recommends that banks deepen the adoption of sector-linked risk-based pricing models, ensuring that MSMEs are priced based on cash flow patterns. Banks must therefore also invest in data systems that reward positive, albeit informal, financial behavior. Secondly, the study recommends that banks should redesign their what I call treasury-happy balance sheets to favor productive risk-mitigated MSME sectors through blended finance as well as partial guarantees. The study also recommends that banks incorporate sectoral GDP dynamics and cash flow cycles into their credit scoring using transactional data to predict repayment capacity more accurately. Also, banks should adopt sectoral credit exposure dashboards with early warning triggers. And just like what the EU does, internally, banks should deploy NPL heat maps and limit exposure in overheated or highly volatile sectors while maintaining flexibility in others. The study also recommends that banks should increase the use of shock-absorbing products such as seasonal loans, invoice discounting, as well as revenue-linked repayment plans. And as well, policy should promote MSME credit insurance or emergency credit facilities through fintech partnerships. And also, the study recommends that banks should deepen co-created embedded financing solutions, especially with large off-takers, so as to serve MSMEs in their value chain with pre-validated credit. Now, as I end, this is something I've been thinking about for some time, and I just wanted to propose an alternate way of truly supporting MSMEs, given that in reality, MSMEs are very diverse. So the question I've always had is, who are really MSMEs? Who are these people? Who are these businesses? And like I earlier mentioned, MSMEs are categorized either as micro, small, or medium. And of course, whether they are formal or informal. But I believe there are other categories that we need to appreciate. And these are three. The survivalist MSMEs, and this is the mama mboga, the boda boda riders, whose businesses are their sole livelihood. And so if it fails, the household income collapses. And as a result of that, they are highly vulnerable and have very low buffers in the event of shocks. The second category is around the growth-oriented or opportunity-oriented MSMEs. And these MSMEs are run by entrepreneurs who see a scalable market, and as such, they may reinvest their profits to expand, hire staff, as well as formalize over time. The third category I see is the side hustle MSMEs, the hustlers. But these hustlers, from my point of view, is those who tend to be, or rather the side hustle MSMEs are those that tend to be run by formally employed individuals who run a business on the side. And thus, they don't really rely on business income for survival, but that does not stop them from borrowing to expand their business. And as a result, they often have better repayment capacity since they can cross-subsidize with their salary income. So to me, this distinction matters because obviously the risk profiles differ. Where the survivalist MSME missing 1 week of sales, this MSME may default. But the side hustler may cushion this miss with their salary. Yet many credit policies as well as banking policies altogether just lump them together. And also, this has an impact on policy targeting, whereby if a government subsidy or guarantee is, in my opinion, if a government subsidy or guarantee is really meant to uplift the livelihoods of these MSMEs, then it should, and this is my opinion again, target survivalist MSMEs. But if the aim is to spur innovation and growth, then growth-oriented MSMEs should be the priority. Lastly, it impacts, obviously, the distinction, how banks strategize around MSME lending, whereby banks should not just equalize these MSMEs, but instead design differentiated products such as microloans with flexible repayment for these survivalist MSMEs, or salary-backed SME credit lines for side hustle MSMEs, given the fact that, quote unquote, they have lower risk. So all I'm saying is that MSMEs are not equal, and lumping them together hides the fact that a salaried person with a side hustle has far more resilience than someone who relies on that business for their livelihood. So strategically, banks and policymakers need to rethink segmentation within the MSME sector just to score highly on equity as opposed to equality. Thank you.
Okay, thank you. So you ask yourself, are you a side hustle SME? Whatever you're doing, are you growth oriented or opportunity oriented? All those, or are you survivalist? The people we know doing business, we can classify them as we go. Thanks for challenging us. I want to invite the discussant who has promised to be very brief also, in the interest of time, so that we also listen to another exciting last session for the month, for the day. Thank you.
Thank you. So I'll be brief as requested. Yeah, so thank you so much, Stephanie, for that great paper. So I'll just go straight into it and just share some comments from reading that. So I had the opportunity to read the paper, and I would say that it was a well-written paper, and it provided good insights for the MSME sector in Kenya. And really, from what she's presented, I think we have a better understanding now of the factors that can influence the credit allocation to MSMEs. So I would say when Stephanie was presenting, she also started off with some good insights, which I thought she can incorporate even in her written work, because I believe that as someone who will be reading your work, they will be very interested to know about the landscape in Kenya, how many MSMEs operate there, how much is lent. You mentioned that in your presentation. You know, what is the proportion that is lent to the different sectors or to the various sectors? And I think that can also build a case for why you focused on the 3 sectors. I was personally wondering, for example, why you didn't include manufacturing. I believe that's also another large MSME sector or another area that is also quite large. Also, perhaps even the role of government institutions like the State Department for MSME Development, have they played a role in helping the MSMEs get financing? And also, you mentioned about some MSMEs and where they get their financing. Are there other avenues apart from the banking sector? So I think that would really add value to your paper, and I'm glad that you did mention some of those in your presentation. Now, in terms of some of the technical things, I would say your objectives and research questions would need to match. And also, I wasn't quite sure, you mentioned it in your work, how the results from this research can inform monetary interventions. Maybe I was thinking of monetary policy, but maybe that can come out more clearly. For the literature review, I thought that you did a good job. Probably just to summarize what I have, the bank lending channel of monetary policy transmission, again, you mentioned that as one of the theories or theoretical frameworks. Again, I wasn't too sure how that really relates to this research. Also, for the papers you've cited, indeed, your paper is unique in that it's disaggregated, looking at the different sectors and how credit to these sectors, or what influences credit to the various sectors within the MSME framework. However, it would be nice to also see what has been done in Kenya just to build the case for your research, which indeed is unique, because I also tried looking and I didn't find perhaps similar papers. And I also found a paper that had been done in India looking at the sectoral analysis. Perhaps you could also gain from that as well. Probably, maybe as we end, is the methodology I thought was appropriate. For the models, there's some notation I thought you could look at again, because some of your variables do not vary across the sectors. But perhaps what I wanted to find out was, because I had the privilege of seeing the results that you have, is that I saw in the correlation matrix, there was a very high correlation between the lending to the various sectors and GDP, correlations of up to 0.97. So I thought, might that present a multicollinearity issue? And if that's the case, are your results reliable? Or are there other ways you can check for this multicollinearity among the variables? So that was one thing. And also, another issue was now with the interpretation of the models that I kindly request for you to look into. Maybe if someone else points this out, was your Y variable, which is your credit extended to the MSME sector, is in natural logarithms. However, you have some independent variables not in natural logarithms. This would be a log level model. And so I was now wondering, does it then call for a semi-elastic interpretation? In other words, the coefficients, do they have to be multiplied by 100 for them to make sense? So, and if that's the case, then that changes the numbers that you're presenting now in terms of interpretation. And perhaps I had two questions on the results, but probably the one that I'll ask now is, why might there be a negative relationship between credit extended in the previous quarter and this quarter? At least that's what I believe I saw from the results. Why might that be? And finally, just to end, you spent good time giving us recommendations, even in your presentation. And I also thought to strengthen that, we could also learn from other regions. And I think you can add that in your paper. So, for example, I saw that EcoBank, Ghana, uses mobile money transaction histories as a credit assessment tool. Maybe that may be something that banks could learn. In other jurisdictions like India, they've created platforms where MSME invoices can be traded to get financing. I wonder if we can also learn from other jurisdictions, even also as we also support the findings from your paper. Yeah, so thank you. Overall, it was a great paper and I enjoyed reading it, and indeed very practical implications for the banking sector. Thank you.
Thank you, Dr. Caroline, for that, keeping it brief and to the point. Now we can take maybe 2 questions, comments, suggestions before we progress to the next phase, the last session of the day. Oh, was it that clear? Yes, done. And okay, you can take Dan's comments and then
so as I introduce myself from TBA. When you were presenting, I didn't hear anything to do. First and foremost, congratulations. You have really covered a lot about the disaggregated. You have deployed a disaggregated approach, which is quite insightful and useful. But I didn't hear about any sort of, whether I looked at the gender disaggregation, whether there are differences when it comes to access to credit between male and female entrepreneurs or other enterprises, SMEs. That would be very useful if it was not covered. The second question is, rather comment, is I think it will also add value to the paper if you have a bit of discussion about what you refer to as banks' preference to park the funds in safer investment like government securities. Are we observing a trade-off with these preferences, which end up penalizing SMEs? Just a bit of that discussion would add value to the paper. Thanks.
okay. So, without any other additional comment, do you want to comment? Okay.
So I'll start with the last question and comment. With respect to gender, no, I didn't look at gender. In fact, one of the things I should have mentioned is that in terms of further research, it would be important for whoever does this research to also look at not only just the micro enterprise angle, which is important, but also gender, because that influences. One other thing I noted as I was conducting this research and speaking to various industry players is in the manner in which they classify MSMEs, how they truly classify. And that's why I came up with that thought of salaried side hustle employees, because if Stephanie walks into ABSA, I do not want to let them know that I'm employed at I&M. I will tick the box of business and tick the box of this various income range. How then do you verify that I actually earn this much, and will you actually classify me as an MSME if I state that I have a business, my source of income is business, and all that from income. So I just wanted to highlight that as an area of further research, as well as gender. In terms of bank liquidity, I think there's been a lot of research here in Kenya, not even research, commentary, evidence-based research on the correlation between bank liquidity, higher levels of bank liquidity, and packing into government securities. Even when financial results are released, you actually see that correlation. There seems to be a correlation, but perhaps it would be insightful if another author is able to look into this. Now, in terms of Dr. Caroline, thank you so much for your comments. And yes, with respect to let me talk about the natural log. The natural logs were on GDP and credit. Everything else was a ratio, or either a ratio or a percentage, which I put in a decimal format. So yes, I'll take that into consideration with respect on how to interpret the results, especially between those in natural log and GDP and now the other ratios or the percentages. The rest I will look at and let you know. Thank you so much. Yeah.
Thank you. Another round of applause for Stephanie from I&M Bank. Okay, so we usually consider in our research conference sessions that give us insights, that give us an introduction of a new technique. If you have something unique that you would want the entire industry to learn, please let us know. We accommodate if you have groundbreaking innovation within the banking sector and you want to win a Nobel, it starts here, and so we give you a chance to present it and share your insights with the bankers for recognition, and of course just you're contributing to the good of the industry. So we have partnered with FSD Kenya to bring to us gender disaggregated data, and to the point that Dan did mention, whether gender issues come up, particularly in credit markets and also in MSME space. And it speaks to the issue again of, do we need to keep things aggregated, or we need to disaggregate? Let's hear some insights from the project so far, because this is a developing project. So what so far we've been able to see even as KBA, and again, we would want to encourage you. What will be presented today would actually show average levels for the banking sector, but it would be possible going forward to start showing bank level. How are SMEs performing in Bank A, Bank B, Bank C, and how do they actually perform based on gender? So that we see these arguments that have been there. We'd ask ourselves, are women in business, do they perform better than men? Who says yes? I've seen a few women who are not sure who are. Okay, let's see some insights from what we have processed so far. Christine.
Hello. Okay. Good evening, everyone. My name is Christine, and I'm the one with the groundbreaking innovation, as mentioned by Sam. So today I'll be going through a data-driven inclusion, that is through the use of gender disaggregated dashboards to strengthen MSME financing. Okay. All right. So just to give a brief highlight of what we'll be discussing today, I want to present a case for women entrepreneurs financing, just to highlight the opportunities that are there, the gaps that these women entrepreneurs are facing. I'll also show the power of gender disaggregated data from both supply side and demand side. I will explain how we are collecting data on the supply side and analyzing it just to show where the gaps are and to elicit questions on how we can solve for these gaps. I'll later be showing a dashboard on how we are on the same. So let's begin. Okay, we'll start from a global perspective. This is a slide that has been borrowed from the Women Entrepreneurs Financial Initiative by the World Bank, or WIFI. So according to the World Bank, women in developing countries aspire to be entrepreneurs at similar rates as men, but then they face barriers which limit their potential to realize their full potential. And some of these barriers are like social norms. We all know that women are expected to offer free domestic labor, there's nothing wrong with that, but then this is at the expense of their financial security. Women are expected to be the primary caregivers. This is information that has actually been confirmed by the Kenya National Bureau of Statistics. When it comes to ownership of property, especially agricultural land, especially in Sub-Saharan Africa, Kenya included, women own just 30% of agricultural land. Again, in terms of legal rights, such as inheritance, property rights, gender-based violence, I think we all know that women are usually the most affected. This one, the next point, I think we can confirm from the data. Women are twice more likely to get their loans rejected. We need to ask ourselves, why is this the case? Less than 2% of venture capital funding goes to female teams. So all these barriers, they limit the women's ability to realize their full potential, and this is seen in the fact that 25% fewer women start businesses as compared to men. And when they do, there's usually about a 36% growth gap expectations between the male and the female counterparts. So all these barriers, the limitations, they translate to a 1.7 trillion loss in revenue opportunity for financial service providers. Stephanie confirmed that in Kenya it's about 2.2 million, but this is for all trillion for all MSMEs. For women, we are not able to quantify that yet. And 5.6 trillion is lost in value addition globally. So now let's look at the Kenyan context. So this is according to a study that was done by the KNBS about almost 10 years ago. I'm sure these numbers have grown. We have about 7.4 million MSMEs who employ about 90% of the labor force and contribute to about 40% of the GDP. Women own more than half of those MSMEs, and yet they access only 36% of the formal credit. And this is even despite the fact that there are better repairs. This is confirmed by 60 days past due, which is 4% compared to men at 5%. Okay, as a result, about 54.9, actually almost 55% of women don't get to celebrate their first anniversary. And then another key issue that is affecting women is that although we have 80% of women, of MSMEs being unlicensed, women form majority of that group. That could probably explain the reasons why they have limited access to credit. So we've grouped the barriers into supply side and demand side barriers. The demand side barriers, they've kind of been proven by the FinAccess study. The supply side barriers, they'll be confirmed by the dashboards. So some of the demand side barriers, we have lack of collateral, including land and property. Business informality, we've seen that women are at 61% of the informal group. There's financial literacy gaps, time poverty, the fact that women are always busy with their care burdens. So that limits their ability to access credit. And then we have social cultural constraints, such as the caregiver roles. Now, on the supply side, we have rigid collateral requirements, lengthy and restrictive loan procedures, gender-blind scoring systems. I'm sure besides the few banks that have gender-specific products, even in the room, like the KCB's Flame, I'm sure most of you don't apply gender into credit scoring. Is that the case? Okay, so silence means no. Again, we have a perception that women are risky, which is not always the case. So some insights from the demand side, and actually this will show you the power of disaggregating data. So, previous. So when you look at the financial inclusion based on account ownership, and this is data from the FinAccess, when you look at financial inclusion, overall inclusion, it has grown all the way from 20s in 2006 to over 80% in 2024. The gender gap is closing. It's actually at 1.7, which is really interesting. But when you look at the key components that are contributing to this overall growth, of course, mobile money has contributed really positively to growth. But when you look at all the components here, mobile money, bank, chama, pension, insurance, SACCO, only the informal one, where we have women having a higher percentage than men. So what does that say about the opportunity that is there for financing women? Okay, when we drill down further to county level, in most cases, we find ourselves solving for the average, and yet when you look at the average, the 1.7 gap, it's telling you that there's no gender gap really. But then when you drill down into county levels, you can actually see it's almost half-half. So half of the counties, they have more women being included than men, and then half shows that we have more men than women. But when you go to the traditional bank, this is how the chart looks like. In almost, I'd say 98%. In 98% of the counties, women are less included. And even the ones where women are more than men, can you read those figures? 0.4 and 0.1. So this is to say that in the traditional banking model, women are often less included. Okay, drilling down to businesses now. According to the FinAccess survey 2024, we had about 3.7 million business owners, and among them, as I mentioned earlier, women are more. This is about, they form more than 50% of the businesses that we have out there. But then when we look at, there's a slide that is missing. When you look at account ownership, I don't seem to find that slide. When you look at account ownership, as Tamara mentioned in the morning, we have about 35% of businesses have formal bank accounts. And among the 35%, the proportion for women is only 27%, right? 27% of women have bank accounts, 27% of women entrepreneurs have bank accounts, compared to 47% of men, right? Okay, now looking at the median monthly income for business owners, I'd say as expected, you can see that women make less monthly income compared to men. Okay, now looking at financial health. So financial health, it's the security that comes from being able to manage day-to-day expenses, being able to manage shocks and have some money left out for investments and savings. So when you look at businesses in general, comparing 2021 FinAccess and 2024 FinAccess, the financial health for businesses dropped significantly, and I would say women were most affected. Theirs dropped from 59.7% to 21.4%, and this is in their ability to invest. Okay, so now that we know the problem, how are we solving it? Okay, so looking at our conceptual framework, connects the financial inclusion pillars, that is access, usage, quality, and impact, to a theory of change through a gender disaggregated dashboard. So the dashboard is our groundbreaking intervention. So it will measure the metrics of financial inclusion in access, for example, like the ability to obtain credit, the ability of women to obtain credit in the first place, the intensity of use of those credit products, the affordability. We want to see whether women get terms that are favorable to them, whether they're getting more expensive credit, their impact, the ability to grow from maybe micro to medium. So the dashboard will be fed by data from CRB as the data aggregator, and that is mostly the credit data, and then the deposits data will get that from banks. So the dashboard is expected to create visibility, first of all, into where the gaps are, what the gaps are in the first place. So the visibility will create insights which will drive inclusion and then finally growth for all, for both the financial service providers and the women entrepreneurs. So this is how we do it. We collect data from CRBs and deposits data from banks, but for now we are starting with credit data from a CRB. I keep messing with the, Okay, we are starting with credit data. We've created two major files from the CRB data, that is the active loan file and the credit application file. In the dashboard, I'll be showing the active loan file. That's what we are starting with for now. The key processing that is going to this data is first anonymization. We've hashed all the personal identifiers from this data that we've created gender tags based on ownership. So we've also tagged MSMEs based on whether they are sole proprietors or registered under the BRS. I want to skip all this and just go straight to the dashboard. So as I had mentioned earlier, it's just a demo. It's not the main dashboard. I've been told it's called the pre-alpha, the before, yeah, it's called the pre-alpha dashboard. It's not the main, yeah. So we've started with a random sample. I don't know what's happening. Okay, yeah. So we've started with a random sample of borrowers reported in the month of August, selected from the CRB dataset to establish a baseline for testing gender disaggregation analytics. The sample is exclusively on users with business loans. So we have three types of loans that considered for the selection of the sample. So customers with working capital, business expansion loans, and trade finance facilities. So this is loans that are issued both to individuals and businesses that are registered under the BRS. So as I mentioned, we have two classes of businesses. We have the sole proprietors. So these are the individuals with the above loans, the working capital expansion and trade finance, and the registered businesses. So next we added gender tags. So for sole proprietors, gender was assigned 100% of the registered owner. So if I, Christine, have a business expansion loan, then I would be tagged as a sole proprietor that is 100% owned by women. If it's less than 51% or 50-50, then it's joint ownership. Okay. For registered businesses, it was pretty straightforward. As long as you have a business registration number, then that's obviously tagged as a registered business. Okay, so for the gender tags, as I had mentioned, 51% female-owned MSMEs are defined as businesses with greater or equals to 51% female ownership, and then male, 51% of male ownership. And then all the monetary values in this dashboard are presented in Kenya shillings. Okay, so let's have a look at what we have here. So this is the demographics, or how the sample has been distributed across the various genders and categories. Okay, so we have 1,200 individual users. So this would be the sole proprietors, and then 1,600 legal entities. And as you can see here, we have 47% of the sample is from male-owned businesses, and 32% female-owned, and then we have 21% that is joined. This being credit data, there's no way we could have made this 50-50, because a sample is a representative of the main data, right? So this actually shows that we have, it's actually proving our hypothesis that we have less women entrepreneurs represented in the data, right? So when we look at the total number of loans, the divide becomes even bigger, because now from 32% of women, they only get 26% of the credit. Okay, are you seeing it's already confirming what we thought, right? Okay, it's split by 42% individual users or sole proprietors, and 58% of the legal or registered businesses. So when it comes to business age, majority of the registered businesses, I would say they are mature for more than like 10 years in operation. What we need to ask ourselves here is why the younger businesses are not getting credit. I don't know, the bankers in the room maybe have an explanation for that. And we see the same trends for sole proprietors. The youth and the very, okay, not the very old, but the older people are not getting credit. Okay, when you look at credit distribution, so from this sample of 2,800, we have 98 billion outstanding loans. This is from a count of 15,000 loans. And now when we disaggregate by gender, in terms of the outstanding value, you see that women only get 6% of that credit. How many times? This is how many times what men are getting. You can do that math, right? When it comes to the average loan ticket size, Again, female-owned businesses are getting lower value ticket sizes compared to their male counterparts. Now comparing loan by purpose, the most common loan type, the business working capital, of course, it's the business loans that I had mentioned before. Yeah, of course, women are getting lower still. Next, we have the regional distribution of these active loans. The darker colors represent those counties that are receiving less credit. When we disaggregate this by gender, we have filters here. We can see that there are some counties that completely disappear once I select female-owned businesses. So what is that telling us? These are questions we need to ask ourselves. Yeah, the questions are to you. For me, I just give visibility, and then you ask the questions yourselves and solve for the questions. Now looking at loan performance, again, this is confirming our theory that women are less risky. They are better at repaying. Looking at the NPLs of male, 13.78 compared to females at 12.78, even though the difference seems small, it's a lot, it's significant, right? Now ordering the NPLs by institution, yeah, trade finance seems to have very high NPLs. Again, questions I cannot answer. Next, let's look at institutional performance. Majority of the loans are from banks in both count and value. And looking at the average loan sizes per institution, again, even for banks, the amount that goes to women is way significantly lower compared to what goes to male and the joint businesses. Okay, next, we look at product analysis. So here we were looking at how indebted our businesses are, comparing the number of loans that each business has. Like for example, female-owned businesses, they seem to have about 6.7 loans per user, compared to males, which have almost nine loans. We're also looking at the loan terms. Again, you can see the disparities everywhere, right? Female-owned businesses are getting shorter term loans compared to males. Yeah, even the loan ages. Okay, majority of the loans are less than 5 years. Yeah, and the disparities still persist even for the age of loans. Okay. There's something that I actually just remembered, forgot to show you. Yeah, here. So Dr. mentioned that institutions will be able to benchmark against their peers on how their loans are performing. So we have institution filters here. Don't worry, it's completely anonymized. So a bank would select. We already know what the NPLs for banks is. It's at 11. So a bank like, let me select a random bank here, Bank 10. Yeah, you can see Bank 10, the NPLs are really low. So banks would investigate this and just try to see what this Bank 10 is doing that is making their NPLs very, very low. I can select another bank here just for demonstration. Yeah, this bank is not represented at all. Yeah, Bank 1, it's higher. I want to see one where the NPLs are really high. Yeah, like this one. So this bank would have lots of learning to do from the banks that have very low NPLs. Yeah, so, but this is for the demo purposes, we have filters, just filters. But for the main dashboard, we'll have a role-based access. So each bank would be given a specific link where they can see their own portfolio compared to the industry view. Okay. So where were we? So investigating sole proprietors. So we have both male, female. We don't have any joint here because the way we tagged our data. So again, the disparities, they are continuing everywhere. They are everywhere, both in sole proprietors, in the entire book, and I'm sure we'll see the same when we're investigating the registered businesses. Yeah. Okay, so looking at collateral requirements. So from this specific sample, the number of loans or the proportion of loans that required collateral, it's only 12.6%. And even in those loans, as you would expect, orange represents women. They're getting the least share of those loans. But I do have a question. I know we keep saying that collateral is the main issue that is the main reason why women are not getting collateral. But then, if you look at this data, only 12% of the loans are collateralized. So what does it mean? So women are not even getting the unsecured loans. What could be the issue? Again, questions we need to ask ourselves. So majority of the most popular collateral types, as we would assume, it's property and buildings. I'm sure land is somewhere on top here. Oh, vacant land, it's number 3. And we all know that women are struggling to have these types of collateral. So the next one, we have the business risk classification. This is based on CRB's scores. We have categorized these scores into 10 groups. I see this differ from what he was presenting earlier. But this, from the CRB that we are getting data from, these are the risk classifications that we have. We have A's as the best customers risk-wise, and then D's as the last. So this is the distribution of our data on risk. And then I've overlaid the NPLs based on, categorized by each risk category. So as we can see and expect, actually, the NPLs are way high for the D classes, or the lower classes. And this is for both male and female. This is actually very expected. But the question we need to ask ourselves here, do the customers get bad after getting the loans? Do the loans deteriorate? And then, questions like that. Okay, so finally we have distribution by sector. For this specific sample, the financial sector had the highest outstanding loans. And then on this other side, we have the NPLs by gender and cumulative NPLs. Okay, so besides this specific sample, we all know that the highest loans go to trade, right? So when we look at the NPLs for trade for both men and women, the NPLs for the female-owned businesses, it's about 7.7%. And this is compared, let's compare for the men, it's 27%, almost 3 times. So let's look at another sector, the building sector. So So the building sector, for the women who venture into the building sector, their NPLs are they're considerably higher compared to the male. Again, it raises more questions than answers. Yeah, so this dashboard has just been a demo on what's coming and what we can expect to see from the entire database. And I've listed some of the questions that we need to answer. So we need to ask ourselves, are women entrepreneurs applying for loans in the first place? It could be that we are trying to solve for a problem that is, and if they are they getting rejected? Okay. Are there loan types that are less accessible to women entrepreneurs? Are they getting lower value? I think we've already confirmed that they're getting lower value, lower ticket sizes, but we need to see whether this is the case for the entire database. How do collateral requirements differ for both genders? And do we have alternative collateral for women? Do we have to always use land or property? Which regions are left out? I think we've seen a bit of that. We need to confirm whether women are less risky. So we need to confirm whether these barriers are they behavioral? Are women ready to receive credit? Do they want it? Or are they systemic barriers that we can actually change, the people in this room can change? So those are some of the questions that this dashboard is. The beauty about this dashboard, it's not about how pretty it is, it's about what it's making us question about the way we finance women. Yeah, so that's it from me. I'll take any questions from the room. Thank you.
Okay, thank you. Very interesting insights in terms of, you can see there's a difference between women-led and men-led MSMEs in almost virtually everything that we can categorize. But there was an interesting feature about the performance of joint NPL levels of 12%, 13% for male, female, but joint is 9%. Does it tell us something about accountability when it is joint? That there is a better performance in terms of management of loans and other features. Women in trade, Mama Mboga does better, NPL levels of 7.8%, and for lack of a better word, Baba Mboga would do 28%. Clearly, so men are risky. I think that's the conclusion that we are going home with, and it's a dangerous conclusion. There's a comment by a man. Yes, sir.
Yeah. These are very interesting insights. One of the questions I wanted to ask you is whether you could probably build for next time so that you pick the approver's bias, the credit officer's bias. So at the branch level or at probably the head office credit level, how are the two genders approving for male and for female? Or could then that inform, maybe you then say, can you have then more credit officers who are female to see whether it can equalize? Yeah, that is one. On the risk, I don't know, are men more likely to take risks that women are not likely to? Perhaps it's true. Maybe that could also explain part of the reason why there are larger ticket sizes among men, but only partly than for women. and even the risk also. Women are likely to do something if they're almost sure of it working. And I think that has been proven even in career choices. Women, even if they have attained almost 80% of the checklist on the job description, they are likely to apply. They want to apply when it's almost 100.
Thank you, thank you. Yes, Ruben, Stephanie.
Yeah, thanks.
Okay, now that the mic is that side, David.
There's one question that Christine raised about the issue of, in as much as you're saying that women don't access these loans, the question is, do they first apply for these loans, first of all? Maybe you can go back to FinAccess and find gender disaggregated data about the issue of how enterprises finance their businesses. Because typically, even up country, women are so much active in a lot of economic activities, and when you hear them, they finance them through chamas and table banking. So perhaps before we make a conclusion based on the data, the first question is, do they really apply? And if you look at the loan applications, I don't know whether you're able to get at the bank level, because you have loan applications, approvals, and disbursement. Perhaps you could be judging that they get the least share, yet they have other ways of, informal ways of financing their businesses, especially chamas and chamas, circles, friends, table banking I think would follow around chamas and those type of groups.
Precisely, I think the FinAccess data was showing women utilizing more of chamas, the point that she brought about utilization of informal funding options. And that tells a lot in terms of can there be group products, can there be group lending products that banks can start considering. Something organized around a chama. So that to take advantage of that element. Maybe there is safety in being in a group, and therefore the financing among those that are known to each other is treated as safer. Inside there was a hand up by...
Good evening, over here.
Okay, before we come to this side, thank you. Please.
My query is that she's done a great presentation, and the key thing which I've picked is that she stated to us that majority of the ladies who are taking loans, unsecured loans, are getting rejected. She had that slide on, that ladies are taking up unsecured loans, but it's getting rejected. What was the criteria that it was not getting approved, and it's unsecured?
Okay. Christine, whether you're able to tell that from CRB data is also... You want to come back on that before we progress? Or maybe you'll come in later. Let's get all the questions, then you'll come.
I liked the presentation. First, to caveat, the first newspaper op-ed I ever wrote, I wrote about women in management and tokenism. And I have never gone back to that topic again. It proved very hard to tackle, so I'm happy to see an initiative that is actually tackling issues to do with gender bias. I had tried, but I never went back. Just on a light note. Now, my question is one, and I'm trying to invert the problem. So there are a number of things that have been mentioned by the two gentlemen that have asked questions, and also you alluded to, that there's an hypothesis of an inherent gender bias. It could be women are not getting particular loan types. That's one I picked. It could be there's a bias when it comes to ticket size. There was the leading of the question the lady asked. There could be a bias when it comes to collateral requirements, the question on unsecured loans, and also a bias to do with risk types, which I'm calling here risk types of credit scores. So my question is, if we repeat this analysis, conditional on these elements we are assuming are the bias, whether the results hold. So practically that would be maybe take one particular loan type and see what the results look like for a particular loan type. And maybe take the same sample, but for loans that are within a particular ticket size. And then see whether the gender differential holds. Same to the same sample for businesses with the same credit rating or credit score. And on the collateral and unsecured loans, maybe just take loans that are all unsecured instead of the split. So you just take all unsecured loans from the sample and just repeat that. Because I feel if you conditional every bias that we are thinking is driving this, if we conditional the analysis on a subsample that already accounts for that, then redo the analysis and see whether this gender-based differential still holds. I would be interested to see that. Thank you.
Okay.
Good evening. My name is Adam Mukubi from the Credit Information Sharing Association of Kenya. What she also mentioned about the We Finance Code, I also sit in the Advocacy and Governance Working Group of the We Finance Code. Now, when we had the launch of this code in Rwanda, one of the issues that were raised from Uganda, actually from a study that was done in Uganda, is that there's an issue of consumer awareness, whereby when a woman walks into a bank and she wants to take a loan, the first thing that is done to her, you're just given a form to fill. Nobody asks more questions aside from the fact that you want a loan. So majority of these women walk into the wrong lenders and they are given the wrong loans. And so these loans end up not satisfying their actual intended need, so they become a burden to them. Now, with these dashboards, is there a possibility that we are going to have lenders be able to say that from where I sit, I cannot offer you the loan that you need, but Bank 10 can offer you what you need, so that these loans don't end up being burdens to women and they actually are able now to pay them. Thank you.
Okay. I think Stephanie's hand was up. Stephanie, right behind you there.
Hi, I think I mentioned this the last time during our caucus, is how this platform will relate to what the CBK is doing with the granular data integration project. Because one of the factors that they're looking at on the loan application, like what you were saying, are women actually applying for these loans, is that they're looking at the loan application, whether it's approved or rejected, as well as disbursed. So that, and they're looking at it from a business lens as well as a gender lens, which will provide such granular data, which will be more insightful for everyone. But what I'm not clear about is whether the CBK will be sharing this information on an aggregate level once they integrate with bank systems. I was not clear on that. That to make it useful for other people to use. Yeah.
Okay. So we must give a disclaimer here that the data we are using is as supplied in the data submission template to CRBs. So this is limited to that extent. Whatever fields are provided in terms of data to the CRBs, because we are tapping from an aggregator, who is actually a CRB, and therefore it's only data that is, to a large extent, is credit data. So it's not KYC data in terms of other performance indicators are not necessarily captured. So it's to the extent that it is shared once a loan has been granted. So it's really post-loan kind of analysis of performance and things like that. But the second phase of it is we will try to now compare this with deposit data so that we are able to demonstrate the ability to service facilities and other KYC indicators. So the next phase of the project will bring in deposits from banks. Okay, there was another hand. Oh yeah, David.
It's actually an additional comment that has come through. I don't know from the data, unless I missed it, you have ownership, but do you have in terms of operation? Because maybe for the registered, if that data was there, I would be interested to see if you have a male-owned enterprise, but is female-handed in terms of operations, and vice versa. I know in this Kenyan market, if you are for locally owned vehicles, I've actually seen the end when the advertisement is that the car is female-owned, and but then the other question I normally ask, it could be a female-owned, but male-operated, because if it's an Uber, and it's owned by the lady, but it's operated by a male driver, the question is when you go to see the vehicle, whether you really expect the lady to be more careful in driving. So it might be the owner, but being driven by a male. So perhaps if we end that data, then we could be able to check. And that is the whole essence of the studies which have been around the issue of women representation in the boards and senior management. Does it mean that when you look at those corporates which have more women involvement in terms of board representation and senior management representation, they are based in decision making, and that transits into the output, that is profitability and other things?
Yeah, I think, of course, another disclaimer is the data categorization is really based on the owner of the account. And so the owner of the account, if it's male or female, by gender, because that's captured within the data submission template. Where we have endeavored to also look at shareholding is really for the legal entities. The legal entities now is look at if it's about 50%, consider it joint. Over 50% female, you then consider it as female-owned or female. What was the categorization? Over 51% female is considered female. Yeah, so that's the 50-50 is joint. Of over 51% is still categorized as female, because then it's a control over the institution to a great extent, in which case then it would speak to issues around risk management, operational standards, and how business is conducted. Okay. There was a question around rejections and loan rejections for unsecured facilities. You had that? Yes, you can.
It was actually all, not necessarily the unsecured, but this is data from the World Bank. For us, we are yet to get the, what is it called? The credit application file. That will be in the next phase. So when we get the credit application file, then we can tell from our end, are the numbers the same? Are women less likely to get approved? But for now, we only have the credit application active file. Yeah, so those are numbers from the World Bank.
Okay, a hand for Christine for this. This is work in progress, and soon you'll see more refined dashboards, and as she mentioned, each bank will be able to see how they fare relative to the entire industry, and of course that speaks to the whole reason we are doing this is so that product designs, and I think Stephanie did mention in her conclusion, is that do we have data-driven product designs? And of course, all this is to inform the same. So next time you're designing a product to serve women entrepreneurs, then you are better informed in terms of how best to structure it, in terms of how the NPL ratios are likely to fare, and therefore you can predict performance of that product. And even including to the county level, you can know which county has some biases that are not so pro-business and others that are. So conversations continue, She's here until end of tomorrow also. So any thoughts that may develop even beyond this session today, please feel free to give her your comments, because the dashboards are developing. What sort of indicators would you want to see? I want to believe maybe not all that she presented is what are the critical pillars. Are there filters, like Ruben did mention, are there additional filters that you want to see, or assessments in the light, through the lens of something that you want to see, if it's through product performance, and so that then you can be informed by those product features and what exactly to design. All this again become information packs to inform our decision making and strategic planning ahead. Ladies and gentlemen, we've come to the end of our day one session. Thank you very much for staying on. I know it's been a long day. We expect to start our session tomorrow at exactly 8:30 in the morning and end much earlier than what we have seen today. And I must thank you for remaining very, very patient and staying on to this time. So enjoy your evening and see you tomorrow at 8:30 in the morning.